Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Ningwiri, and today, ladies and gentlemen, we are discussing about the business data analytics, December 2023, question 22. It reads as follows: Safari Limited is evaluating a project with the following details. You've been given the initial investment, 100 million, residual value, 10 million, year one projected project cash flows is 25 million. The annual cash flow growth rate from year 2 is 10 million. The project life is 5 years. You are required: A, compute the following project metrics. Payback period, number 1. Number 2, the net present value, assume a discount rate of 12%. Number 3, the profitability index, assume a discount rate of 12%. B, using a graph, determine the project's internal rate of return. And this totals 30 marks. So trying to answer this question gives us or gives you 30 marks there in total. So to start us off, we are first of all going to do the following. We're just going to first of all come right here and we say we have the year given to us over here. And this solution over here, I can just drag this one down over here. This is A, and this gives us year. So we have the years given to us. They're from year 0, 1, 2, and of course you know what happens. Once you put it like this and then you have that plus sign like that, you can drag it up to the number of years you actually want like that. So let's assume it goes all the way to year 5. Not assume, we've been told it goes to actually to year 5. And you can be able to see the project life right over here is 5 years. So from year 0. And we are saying from there, then we need then to put the value over here. We're dealing with Kenya shillings, so shillings. Put shillings, and we are saying we can put them in thousands. That all of these need to be put in terms of thousands over here. That why? Because we're dealing with thousands. We just do not want to deal with very big figures like that. We just want to deal at least with manageable figures. And from there, we can put over here the initial investment. That. Then we can put the initial investment right here as 100,000. Why am I putting 100,000? Guys, because you're saying that we are expressing it in terms of thousands over here. Yes, it's 100 million, but if you remove those 3 zeros there, we're saying we're dealing with 100,000. And because we want to deal with values that are in terms of the accounting format, so let's put it like that, then just do it sort of something like that. That looks at least well presentable, I mean. So initial investment is that. Then we have the residue value or residual value. That. And the residual value is assuming that you sell the asset at the end of the project or after 5 years there. So right here I can put over here in terms of the residue value, you can put 10,000 here. You sell an asset and you realize 10,000 in terms of value. Once that happens, then we can move ahead and look at the values over here in terms of the net cash flows over here, the cash flows. And we're saying the cash flows over here, we've been given the initial investment is 100 million. You're seeing the project 1 cash flows is 25 million over here. So assuming that this is, of course, is the initial investment, we can put a negative value over here like this. We're saying that we can be able to put, so it's negative, I just sort of put negative, enter, it can be able to appear, and that it's an outflow. We can put the values over here as follows. For year 1, we are saying is 25,000. Not right there. You can put, because this is the residual value, the cash flows here, 25,000. That. And we are saying this 25 million or 25,000 over here, in our case here, is going to grow at an annual rate of 10% from year 2. So from here, we can do sort of something like so. We add that value and multiply it by a factor of 10%. So times 1.1. That. We get 27,500. Then we just drag it, because this has got a formula. We drag it sort of like that, and we make sure at least it auto fits within the cells. So from there, we are saying that what is going to be our net cash flows? Our net cash flows are going to be as follows. Flows. So here we're going to pick this value here. The ones we're going to discount, these ones are going to use this value here. And then we are saying we're going to use, just going to pick the residual value plus the cash flow itself over here, if any. So that now it, after period 5, we expect this cash flow to be 46,603 over here to be the cash flow you're going to discount back to period 0. So we drag it and it picks. You can see now these are the cash flows you're going to discount over here. You can put them in bold, Control B. That, of course, we can be able to expand it by sort of clicking, double clicking like that. Those are the cash flows. Once we have that, we can then get the payback period. So over here, I can write now the payback period. Because that's what you're looking for, payback period. This means that we need to get the cumulative. Cumulative values. I can be able to just put it sort of like that, and we come right here and put it maybe in form of a box like that. So that's what you're interested in, the cumulative cash flows. So here it's just going to be that value, and then we are going to pick plus that value plus this net cash flow here, comes to 75, and then we reduce it. We continue, we drag it because it's got a formula. We continue up to there. But if we continue over here, if we get 33,000, we subtract, because of or 17,000, we subtract 33,000, we should be able to get a positive value. What the payback period tries to measure is how much you can be able to recoup this original investment of ours over here of 100,000. So clearly over here we'll be able to get a positive cash flow, yes. But in terms of the payback period, in terms of years, you can see the number of years given to us right here. We can say that the payback period, so payback period over here will be given to us right over here. So this is year 1. We can say year 1, indeed, we're still getting a negative cash flow. Here, year 2, we're still getting a negative cash flow. Year 3, we're still getting a negative cash flow over here. But when we reach year 4, we are going to get a positive cash flow. This, let me just demonstrate. We're just going to get a positive cash flow over here like so. And that's not what we want. We want to recoup this original investment. We do not want a positive cash flow. We want to see the exact number of years we're able to recoup this 100,000 right here. So just delete that. We know it is going to be 3 years, but 3 years and how many months? So we can be able to put the number of months right over here, or we can be able to compute it right here. So it's going to be that value over this value, and then we multiply by 12 because we want it in terms of months. Like that. So 6.22 months. So the payback period you can see is, we can say, is here. Payback period is 3 years, 6.22 months. That is what answers our first part right here, the payback period. So we can move ahead to part B, the question over here. And part B, we can just go down right here. B. It's a similar fashion or a similar format. We are looking for the net present value right here at a discount rate of 12%. So net present value. Net present value. And we're saying the net present value is, just given, is just how much we are able to get. Are we going to realize a positive cash flow or a negative cash flow based on discounting? You're using a discounted cash flow technique so that you can be able to get the present values. And in a similar way over here, so we're not in B, we're doing part A, part 1. So this is A, part 1. I can just put it like so. This is A, part 2. A, part 2. Like that. So that now we can be consistent there. And to get the net present value, what we'll need to do, if you allow me to copy this over here like this, cash flow, the cash flows over here, I can be able just to copy these ones the way they are like that. Copy, just put them just down here. So, and of course, I'll be able to also copy this. Allow me to copy this. Copy, put it just down here like so. And this I can drag it maybe down. I can just drag it somewhere down there like that. So the initial investment, we pick it from above here. That's the initial investment there. No problem. The residual value, we just pick this from above here. And then we're saying the cash flows, we're just going to pick whatever we have right above here. So we're linking it like that. And we're saying these cash flows are the ones which we will need then to discount. So this is how we're going to discount it. So the net cash flows, we still pick them from above there. Net cash flows like that. And then we have this value like that. And this is what we're going to discount. These ones over here. These net cash flows. You see, like the way I've did over here, the relevant values, these are the ones which are we're going to discount and get the present values right over here. So present values. So the present values will be, we're going to get this value over 1 plus r over here. But for us to be able to get the present values, or in Excel, there's always a way we can be able to get the present values. Always. There's always a way how we can be able to do it. And we can just say the NPV. Instead of discounting this value over 1 plus the discount rate power 1, this value over 1 plus the discount rate power 2, power 3, power 4, and power 5 like that, we can just go to the to a formula NPV like that, and we are saying we open it up right here, and we can see the rate. The rate is just 12%. And once we have the rate as 12%, under the value 1 here, we put in those cumulative cash flows like that. And then we will need then to subtract the initial cash outlay. So would it be correct for me to add right over here? We add the initial cash outlay there, like that. That's the initial cash outlay. So that's what we are saying we are going to have. 13 million, of course, because we're dealing with millions, 13,365,099. That is what you're saying represents NPV. And so you can maybe highlight the answers maybe in red like that, so that you can be able to know that these are the answers. We can move on and discuss about the profitability index. The NPV, before we move on to the profitability index, the NPV is the net of present values to try and see whether you're able to get a positive cash flow or a positive value or a negative value. If NPV is positive like this, we accept the project because the project is going to yield us positive values in future. But if you get a negative NPV, then it doesn't make any sense to us here. So here, part 3, I can move ahead right down here and now click this one to be 3, the third one. That. A, part 3. We talk about profitability index. That. Under profitability index, we are going to get the present value of cash flows divided by the initial cash outlay. That gives us the profitability index. Any number greater than 1 gives us positive, or we are supposed to go ahead and invest in that project. If it gives us anything less than 1, then we reject the project. And we are told to assume the discount rate of 12%. So what we do is that we just go ahead and use similar values right over here. Copy. We come right here, or rather I should have copied from here, sorry. Copy, and you put it right maybe just down here. Paste special, we want to paste special formulas and all. Oh, it's refusing, so we just look for an alternative way, put it like that. So with these values, we can just link it with the first value right over here. So just link it with that one, that, and we can just drag it moving across like that. The residual value picks from here, that. So these represent the net cash flows. So this is what we're saying is shillings, so we just delete this and it's okay. But the initial investment picks from here, the net cash flows, that value there. So once we have that, then we can be able to get the profitability index. And the profitability index, we are going to get the present value of cash flows divided by the initial divided by the initial cash outlay. So we're going to use NPV rate 12%. The values, we are saying we're going to use these values here. And there's one thing that we needed to change here. We need to add the two values, these two values here, before we continue. That one plus that one there. See the profitability index, NPV. See here, double click it. Then we open it up right here. And you see the rate is 12%. And then with 12%, we can put in the values over here like that. We are getting that value, the present value of cash flows, and we are going to divide this against the initial cash outlay. So minus, open the brackets, this one. Enter. That's what we get as our profitability index, 1.13. So in this case, we accept this one based on NPV, we accept, and the payback period, if it's the shorter the payback period, the better it is for us. So here, just like for consistency purposes, we put it in red like that. And we can see that we're moving on well, and we now move on to part B of the question. Using a graph, determine the project's internal rate of return. The project's internal rate of return is at the point where you get, the NPV is equals to 0. Where the NPV is equals to 0 is where we are saying our project's IRR is going to be. And so we're going to use a graph. So first of all, you're going to test it using the IRR formula. So IRR, or internal rate of return. Rate of return. The internal rate of return, IRR, is going to be, we open it up right over here, the values. So we put the values right over here, all of the values, including the negative value here. And we say, okay. So it's around 17%. And that's what we expect, or 16.75%. That's what we expect from using the graph, around thereabout. So we pick arbitrary rates, so 12%. You can put 12% over here, 13%, like that, and so on and so forth like that. So we just drag it. So we can just get arbitrary rates over here, and we get the corresponding NPVs. So NPV over here, 12%. The rate is 12%. You can see from right over here, 12%. The values over here are these ones here, the net cash flows here, like that. And then we do what? We add the initial cash outlay. The initial cash outlay in this case was negative here, that, and we get that value. So it's the same as what we got above over here. That's fine. But because we want to ensure that we want to get the corresponding NPVs at different rates over here, I need to lock the formulas over here. So I press F4 there. I click over here, I press F4, and I press F4 over here, so that I can be able to lock and ensure that everything is okay. So if I drag my formula over here, it should be able to work. So that's what I'm going to do right here. So shift, Control D. But it's picking 13%, or it's because I didn't change. You see, it's still at 12% here. So what I'll do, I'll just change this to 13%, 14%, like that, 14%, 15%, and so on and so forth. Just come and change here, 16%, 17, that, then 18. So don't worry about that. 19. Then here we got 20%. 20%. Like that. So you plot a graph over here. This is the NPV. NPV, that rate. Like that. So just sort of put it center to make it look presentable, and like that. Then you can just draw a graph here. Insert. Then you come to recommended charts, and you can be able to see, based on this graph over here, that point, okay, just place it somewhere right here, that at around 16% over here, you can see at around this point here, if you click right here, it will give you the point. At around 17% is when you're going to get negative NPV thereabout. 17%. And you can see it's 16.75 right here. So the exact rate should actually be somewhere over here where it's next to. It's along just this curve over here. It cuts it along this axis over here like that. NPV indeed is at 16.75. So once you draw the graph like this, it should be able to, and then you just highlight like this, you can be able to see thereabouts around approximately 17%. You can be able to get the IRR. So ladies and gentlemen, this brings us to the end of the class. We have done question 22 of the business and data analytics paper, which came in December 2023. Hope you have enjoyed it. God bless you all. Bye bye.
How are you over there? My name is Patrick Kamau Kamure. You are lecturer in taxation. Welcome to today's lesson of public finance and taxation, where we continue looking at the taxation of the business income, where, if I can give you a little of recap of what we did, is that we said that there are three businesses that we need to see how they are taxed. One of them is the partnership, is the sole proprietorship. The other one is the partnership, and the third one is the limited company. In our previous lesson, we did the taxation of the sole proprietorship. So for today, we want to go to the next business, which is the taxation of the partnership. So partnership is where we have two or more people who come together to do business together, and they don't register their business as a company. Because of that, we normally say that partnership do not have a separate legal entity from the owners, and that will mean that when you are taxing the partnership, you tax the partners themselves, not the partnership itself, because it is not separate from the partners. They are partners, and the business, they are one and the same thing. So now we want to see, how do we normally tax the partnership business? First of all, I want to write over there the introduction or definition of the partnership as I've illustrated. So we have partnership is a business owned by two or more people which is not registered as a company, and so does not have a separate legal entity. That is the definition of the partnership. But our objective or goal is to know how we usually tax the the partnership business. So these are the items that you need to consider when you are taxing the partnership business. So areas to consider, or items to consider. While taxing partnership business. Number one, determination of taxable income. Determination of taxable income, and say this is done using either or A, gross profit method, or number two, or B, net profit method. What we are saying is that when you are determining the taxable income of the partnership, just like other business, and as we introduced earlier on when you are introducing to the taxation of the business today, any business, when you're determining the taxable income, you either use the gross profit method or net profit method. So the same criteria apply to the taxation of the partnership. You either use the gross profit method or net profit method to get the taxable income. We have Roman 2. Another items that you need to consider when you are determining taxable income of the partnership or taxing the partnership is the following expenses. Are not allowable in partnership. I.e., salary to the partner, to partners, interest on capital, interests on capital from partners, to the partners, commission and bonuses to partners, drawings by partners, and any private expense of the partners. That is the second thing that you need to know, that those expenses, when they are incurred by the partnership, they are considered to be non-allowable expenses. Salary to the partners, interest on capital, bonuses, the commission, the drawings. In short, we are saying any expense relating to the partner, like private expenses of the partner, we don't allow them when you're determining the taxable income. The third one that you need to consider, the following incomes. Are non-taxable incomes in partnership, i.e., what are those incomes that are not taxable? Interest on drawings, profit on goods sold to partners, and any other income any other income from partners. That's another thing, that when you're determining the taxable income of the partnership, if there's any income that the partnership received from the partners, we treat it as non-taxable. This you hear like interest on drawings, like when the partner withdraw anything from the partnership, like goods, the cash, they charge interest. That is an income to the partnership, but it is usually not taxable. Another thing is like sometimes they can have a provision, or the partners can have a provision that if a person wants to buy goods from the business, can buy and they are going to be charged a profit like any other customer. So that profit is not taxable in the partnership, and any other income that the partnership may get from the partners. The fourth one is the income distribution schedule. Distribution schedule. What does that mean? Once taxable income of partnership is determined, it is distributed to partners using income distribution schedule where they bear individual tax burden. They are taxed individually at graduated scale rates in the same way as employment income. After the distribution. The gross tax. The gross tax, once determined, then set-offs such as personal relief, insurance relief, and withholding tax on investment incomes are deducted. Income distribution schedule has the following format. So what we are saying is that about the income distribution schedule, once the taxable income of the partnership is determined, either using the gross profit or the net profit, we tax the income on the partners themselves, and we tax them at graduated scale rates. Graduated scale rates is the same as the employment income, the way we taxed the sole proprietorship, where once you distribute to the partners, because the partners are the one who bear the tax burden, you tax them individually. It is partner A, how much is the taxable income, tax individually at graduated scales. Partner B, how much is the taxable income, tax them individually. And then once you get the gross tax of each partner, use the actual tax they are supposed to pay, and they are like personal relief, the withholding tax on investment income, and insurance relief if they have life insurance cover, education insurance cover, or NHIF. Now, I want to show you how the distribution is done through the income distribution schedule or allocation schedule. So it has this format: income distribution, stock allocation schedule. We start by distributing the taxable operating income, and then we list the partners. Partner A, we are assuming partners are A, B, and then we have a column for the totals: shillings, shillings, shillings. So the taxable operating income you would have determined using either gross profit method or net profit method. You can distribute it this way. The first one is usually the salary. So salary to partners. If partners have the salaries, if this one had a salary, you put there this one and the total. The next one is interest on capital. Interests on capital. So interest on capital for this partner, for this one, and this, if there is any. Then commission or bonus. You put on this, this, and this. After that, those three are the one that you usually post. If there is commission or bonus, interest on capital, salaries to the partners. Then you less interest on drawings. Interest on drawings. So interest on drawings here, you less if anybody withdrew the goods and they were charged interest there. Now, after you have distributed those one, the taxable operating income you'd have determined, you minus what you have distributed, minus this, minus this, minus this, but this one you add. Then whatever remains you share according to the profit sharing ratio. We call it profit share. Shared according to profit sharing ratio. So you come, how much is this? This total. And then after that, get the total taxable operating income. Total taxable operating incomes means we take the salary, the interest on capital, if there is commission or bonus, less interest on doings, profit share, you get the total here. You do the same for this, you do the same for that. Now, you have just distributed the operating income. Then you add taxable investment income. Taxable investment incomes shared according to profit sharing ratio. Sharing ratio. So if you have something like rent, non-qualifying dividend, non-qualifying interest, royalty, all those, remember, withholding tax is not final. You come and share here according to the profit sharing ratio. This one, total. And then now from there, you can get total taxable income. Total taxable incomes, which will take the operating income plus investment to get the total. Operating plus investment, operating plus investment there. And now, if you're asked about now taxing, getting the tax payable by partners, you will tax this one A individually on this using the graduated scales, the way we tax them sole proprietors income. The same case, this one, B, tax on this one to get the tax they are supposed to pay. So that is what you need to know when you are taxing the partnership business. And from there now, I want us to look at a question. So I read the question, then I'll show you how it is solved or computed. This is what the question says. Hi there, my name is Patrick Kamau. Welcome to today's lesson of public finance and taxation, where we look at the taxation of farming activities. So farming activity is somehow connected to the taxation of the business that in our previous lessons we have covered, because all matters is how is the farming activity carried out. Is it done by a limited company, a partnership, or a sole proprietorship? So when it comes to the taxation, determination of the taxable income, everything remains the same. So the only difference are just two things that you need to know. Additional taxable income in farming. Those are incomes that are specifically for farming, in addition to the one that we said are taxable under normal business, and also additional allowable expense. The one that we talked about are still applicable, and now they are those specific in farming because farming is a special activity. So I want to write something about the taxation of the farming activity here. Before then, at the end of it, we look at a question. This is what you need to know, that farming is also called agriculture. And it involves keeping of animals or growing of crops for food or commercial purpose. When farming is done for commercial purpose, then the income generated become a taxable income. Another point is farming is taxed depending on how it is carried out, either in partnership, by a limited company, or by a sole proprietor, where it is taxed in the same way as these businesses as already covered. However, the following apply specifically in farming. So we have number one, the following specifically apply in farming. We have additional taxable income. This includes all incomes generated in farming, i.e., income from selling of crops, livestock, farm produce, animal produce, etc. Before we continue, what we are saying is that, as I had introduced, that you do farming either for food, for commercial. If you do farming for commercial purpose, then the income you generate become taxable profit like any other business. Now, how do you tax the farming activity? It depends on how it is being carried out. Is it being done by in partnership? You tax it in the normal way, like a partnership, the way we have covered in our previous lesson. Determine the taxable income, then distribute the income to the partners, then tax them individually. Is it done by a limited company? It is a company, determine the taxable income of the company, then tax the company, just normally. Is it done by a sole proprietor, where you determine the taxable income of that sole proprietor, then tax him? However, we are saying the following specifically apply in farming: additional taxable income. Like that, any income that come out of farming activity, like selling of crops, livestock, animal produce. Animal produce are like eggs, milk, hide for the animals. All those are supposed to be taxable, and any other income that come out of farming activity. Then we have number two, additional allowable expenses. Additional allowable expenses. This include, we have A, costs of purchasing seed, fertilizer, and livestock. B, we have farm operation expenses. Such as cost of water, electricity, transport, etc. Then we have C, costs of clearing land and planting permanent and semi-permanent crops. D, costs incurred to prevent soil erosion. I.e., construction of gabions, terraces, and making of windbreaks. The last one, capital allowance. Capital allowance on capital expenditure or farm work costs. This one, check capital allowance computation. So what we are saying is this: when you see these expenses and they are incurred in farming, treat them as a allowable expense. One we are saying is the cost of purchasing seeds, fertilizer, and livestock in farming. They are allowable. Treat them as a allowable expense. Farm operational expense, just like any other business, water expense, electricity, transport, and any other expense incurred in farming, allowable. Cost of clearing land and planting permanent and semi-permanent crops. Permanent crops are the crops that can be in the farm in the long term, like coffee plants, tea plants. The cost of planting them are allowable. Semi-permanent are like pyrethrum. They're usually in the short run, but 2, 3, 4, 5 years. They are all allowable. Cost incurred to prevent soil erosion, like construction of gabions, terraces, making of the windbreaks. All these are allowable as long as they are to prevent soil erosion. And capital allowance on capital expenditure in farming. Capital expenditure in farming is also called farm work cost. So when you see farm work cost, claim capital allowance under farming. And this I'm reminding you to go and check the capital allowance computation because we learned about it. Now at this moment, I'd like us to look at a question to see what we are talking about. So I read the question. This is what the question says. Mazao Ranch Limited practices mixed farming and milk processing. The following is the company's statement of profit or loss for the year ending that 1st December 2020. We have the revenues consisting of sale of milk, sale of livestock, sale of manure, proceed from the sale of an old tractor, discount received, expenses, which we have general expenses, construction of water tank, vaccine for livestock, loan repayment, depreciation, electricity and water, conveyance fee, construction of chicken sheds, animal feeds, salaries and wages, bad debt provision, repair and maintenance, professional fee, net profit. Additional information number 1, farm work acquired on 1st July 2020 comprised of the following: granary, labor quarters, cow sheds. Number 2, general expenses include subscription to a farmers association, acquisition of a 50-year lease, staff Christmas party, parking fine. Then number 3, repair and maintenance comprised, provision for fencing expenditure, repair to machinery, other repairs. Number 4, professional fee include 500,000 paid with regard to pursuing a dispute with the Kenya Revenue Authority, VAT department. Then assume corporate tax rate during the year was 25%. Required adjusted taxable profit or loss for Mazao Ranch Limited for the year ending that 1st December 2020 and the tax payable if there is any. So in this case, we take note. Yes, it's a farming activity, although they are mixing it with processing, but the key thing is farming activity. And then the farming is done by a limited company. So whatever we have been saying about a limited company apply with addition of this additional taxable income we have talked about and additional allowable expense. So we treat it as a normal, it's a company actually. So the next question should be, which method are we supposed to use to get the taxable income? Like any other business, for this one we use the net profit method because we have been given the net accounting profit after the income statement. So this is how we go about it. For the year ended 31st of December 2020. So we start with net profit provided, which we have 157,000. Then when you are using the net profit method, we said you add non-allowable expenses in P&L and taxable operating income not in P&L. So just like we have been using the net profit method, we'll go through the P&L, look for the expenses that are not allowable in the P&L first. So which expenses are in the P&L? General expense. General expense you have been saying is allowable is for the business. Construction of water tank, we don't allow. Water tank, that's a fixed asset. So construction of water tank, a fixed asset, we don't allow. Of which case we have 240. Had been deducted, isn't allowable. Next, vaccine for the livestock. That is a allowable expense, vaccine, because it's a farm operational expense. Loan repayment. We said loan repayment is not allowed. What we allow is the interest on loan, not the loan. So we disallow that. Loan repayment, 350,000. After that, depreciation. Depreciation isn't allowable, so we add it. Depreciation, which you have 180,000. Electricity and water, that is allowable expense. Conveyance fee, no. If you go to the regular expense, we said conveyance fee is not allowable. And which we have 156,000. Then construction of chicken sheds, that's also a fixed asset, you know, a structure. We disallow. Chicken sheds, a fixed asset for 80,000. Animal feeds, that is an allowable expense. We said an operational expense. Salaries and wages is allowable. Bad debt provision. Provision we don't allow unless there are specific provision. So we disallow that. Bad debt provision, which we have 150,000. 150,000. Repair and maintenance, that is allowable, and also professional fee are allowed. From there, we go to the additional information we look for, an income not in P&L. If an income is not in the P&L, can only be in the additional information. And if it happens to be taxable operating, we add. And at the same time we go there, we look if there is an analysis of the expense in P&L. In the analysis, if they do happen to be non-allowable, we add still. We start with the additional information, number one. Farm work acquired on 1st July 2020 complies of the following. Now, farm work, that's a fixed asset. We said here, it's a capital expenditure. We don't allow capital expenditure. We claim capital allowance. But those expenses, if you look at them keenly, they are not in the P&L, so we cannot touch them. Then number two, general expense include. Now, general expense is one of the expenses in the P&L, so we look for the non-allowable expense in it because it's an expense in the P&L. Subscription to Farmers Association, that's a trade association which we allow. Acquisition of a 50-year lease, that's allowable. We said up to 100 years, up to 99-year lease is allowed. Staff Christmas party allowed for welfare. Parking fine, we don't allow fine. So in this case, we disallow. Which we have 129,000. Then after that, we go to number 3. Repair and maintenance complies. Now, repair and maintenance is in the P&L. So we look for the non-allowable in it. Provision for fencing expenditure. We don't allow provisions. So we add provision. Only specific provision for bad debt do we allow. This provision for fencing, it's not specific provision for bad debt. For fencing, which we have 145,000. The other one is repair to machinery, that is allowed, together with other repairs. They are all allowable, revenue expenditure. Then we go to number 4, professional fee include. Now, professional fee is in the P&L. If you go to the P&L, the last expense is actually the last one, is in the P&L. We look for non-allowable in it. It includes 500,000 paid with regard to the pursuing dispute with Revenue Authority VAT. We said any expense relating to tax we don't allow. So we'll have a professional fee for VAT. $500,000. We don't allow. Number 5, assume the corporate tax rate during the year was 25%. That's not an income, it's not an expense. So we are done with an allowable expense in P&L, an income not in P&L. Unfortunately, we didn't come across any. Now we now come to the deduction. Remember, we deduct 3 items: non-taxable operating income in P&L or investment income in P&L and allowable expenses. Allowable expenses not in P&L. So first thing, we go to the P&L. We look for non-taxable operating income there. And also the same P&L, we look for all investment income there. Let's see. In the P&L, these are the incomes. Sale of milk. We said sale of milk is a taxable income. Taxable operating in farming. Income from selling of an animal produce. We said here under taxable operating income. Sale of livestock, a taxable operating for farming. Sale of a manure, that's an animal produce, a taxable income. Proceed from the sale of an old tractor. Under normal circumstances, we don't tax income from selling fixed asset. That's a fixed asset. So profit on sale of tractor, which we have an amount of 820,000. We remove not taxable. The other one is discount received. Discount received is a taxable operating under normal business. That's what we said. So since we are done, there is no other income in P&L that we have not considered. We now look for allowable expense not in P&L. An expense that is allowable that isn't in the P&L. If it is not in the P&L, then it can only be in the additional information. Let's see. Number 1, farm work acquired on 1st July 2020 comprised of the following. Now, farm work that is not in the P&L and it's also not allowed. We said, what do? We claim capital allowance on farm work. Which one? If you go to the capital allowance we discussed earlier on in the previous lessons, so we said granary, that should be 50% without considering time. Even if it was from 1st July, we don't consider time. Labor quotas in farming, remember in farming, is supposed to be 50%. Now, cow shed, that's supposed to be another 50% without considering time. So we claim them. So we are continuing here. On that, we are looking for allowable expense not in P&L. So we have capital allowance. Capital allowance on, we start with granary, which should be 50% of 420. That will be 210,000. Labor quotas, 50% of 1,200. That will be 600,000. Then cow shed, 50% of 160. That will be 80,000. So we are done with number 1. We continue looking for allowable expense not in P&L. Number 2, general expense is in the P&L, including whatever is in there. Substitution, all of them are in the general expense. Repair and maintenance is in the P&L, including whatever is in there. Professional fee is in the P&L. 5 is not an expense. Now that we have not been given capital allowance, and that's the reason why we are computing, you have to come back here and now look for fixed assets so that now you can finish on the capital allowance. We had construction of water tank. That is a structure construction. So that's supposed to be 50%. It is a structure in farming. The other one is construction of chicken sheds. That's another 50%, a structure in farming. And this fencing, if it was not a provision means that they have not yet incurred. They are providing they are going to incur. We don't claim capital allowance. But if it was incurred, we could have claimed 50%. And there isn't any other fixed asset. So you'll come here, a water tank construction of, we have tank which is supposed to be 50% of 240. That will be 120,000. The other one is chicken shed, construction of chicken shed, which should be another 50%. Chicken shed we had for 80. That will be 240. And since there is no other fixed asset and we are done with the allowable expense not in P&L, we get the net taxable operating incomes. So we are going to take this, add, and then minus. So we start 157,000, and then we add to 40,000. We add 350,000. We add 180. We add 156. We add 480. We add 150. We add 129. We add 145. We add 500. And then we minus the 8, it was 820. We minus 210. We minus 600. We minus 80. We minus 120. And we minus 240, which we have 417. So this is 417,000. Now note, this was a company, limited. So we said company, since it is taxed on its own income, we add the taxable investment income. Investment incomes. But if you look at the question, in the income statement, these were the income. Sale of milk, sale of livestock, manure, proceeds from old tractor, discount. There is no investment income. So this would be a dash, meaning the total taxable income. Total taxable income would be the 417,000. So that mark the end of required one. Adjusted taxable profit or loss of Mazao Ranch Limited for that year. Number 2, tax payable or on profit or loss. So in this case, we say this is a company. We say like any other company, corporation tax rate. That we have not been told is an unresident or a foreign company, 30%. So we'll say tax would be 30% of 417,000, which will give us how much? 30% of 417. That gives us 125, 100. And that is the end of that question. So that is how you tax the farming activity. And you would have noted that it's not different from the businesses that we have looked at. You just consider it like a normal business. Sole proprietorship if it's done by a sole proprietor. A partnership is if it's done under partnership. A limited company like the way we have done it there, then you just tax it that way. The only additional thing that you need to know is this additional taxable income and additional allowable expense. So that marks the end of the taxation of the farming activities. And I would want you, below this video, there is an assignment. Kindly go through it, look at it, attempt it, then see if you can be able to do it the way we have done ours here. So for today, we end there. Thank you very much. Hi there, my name is Patrick Kamau. You are a lecturer in public finance and taxation. Welcome to today's lesson. Today, we continue from where we stopped last time. Remember, the topic we are looking at the moment is called the taxation of the business income. And we said that there are 3 businesses that we need to look at how they are usually taxed: the sole proprietorship, partnership, and the limited company. So far, we have looked at the sole proprietorship. Last lesson, we did look at we started looking at the partnership. whereby after looking at how partnership is usually taxed, we went ahead and we used the net profit method to get the taxable income of the partnership. So today we continue with the same lesson, but we look at another question where we used a different approach to answer the same question, a different question using now the gross profit method. Welcome to today's lesson. So we are going to start by reading the question. After reading the question, then I'm going to help you solve the question. So here is the question. This is what the question says. Karimu and Shika commenced trading in partnership as Kashi on January 2019. They share profits and losses in the ratio of 2:1 for Karimu Shika respectively. The partners were to receive monthly salaries of 18,000 and 22,000 for Karimu Shika respectively. The partnership did not maintain complete set of accounting records. The following summary of the bank statement for that year has been presented to you. So we have the receipts consisting of capital introduced, Karimu and Shika, cash sales, receipts from debtors, sale of a van. We go to the payment side. Equipment of office, rent for go down, salaries and wages, purchase of for resale, repair and maintenance, insurance, interest expense, motor vehicle expenses, sundry expenses, motor van purchased, tax penalty, electricity, medical expenses, balance carried forward. Additional information number 1. The following payments were made in cash from the cash sales before banking. We have the motor vehicle expenses per annum, wages per annum, sundry expenses per annum, weekly drawings for Karimu and Shika. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118,000. As at that 1st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. Depreciation was to be provided on equipment at 10% on a straight line basis. As at that 1st December 2019, the amount owed to supplier was 780, while the amount owed by the customer amounted to 1420. An amount of it 2,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad debt. This amount was excluded from the total amount owed by a customer as at that 1st December 2019. Salaries and wages include the salaries to the partners. The go down had been occupied since 1st November 2019 at an annual rent of 450,000. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. The wear and tear allowance, and it's good to note that wear and tear allowance is the same as the capital allowance. So wear and tear capital allowance was agreed with the revenue authority to be 112,000 for the year ended at 1st December 2019. So number 11, closing inventory was valued at 620,000 on 31st December 2019. Assume that year of income had 52 weeks. Required 1. Adjusted partnership profit or loss for the year 2019, and number 2. Distribution schedule of the profit or loss calculated in C1 above. So the first question is to get the taxable income, and we say that whenever you are told to get the taxable income of any business, you either use the gross profit approach or the net profit approach. Net profit approach, we said, is when you have been given net accounting profit or loss or income somewhere. If you haven't been given, you use the gross profit method. So this question, we are not given the net profit or loss or income. So automatically we use the gross profit method. Now gross profit method, we said, we usually start with the sales. We less the cost of sales. Cost of sales, we take the opening stock plus purchases, less closing stock minus any item that reduce the stock. And then we get the cost of sales. We less from the sales, we get gross profit. And the reason why we call it gross profit, we said. And then you add other taxable operating income, and then you less the allowable expenses. So, but we said before you start, always confirm. Do you have the sales? Do you have the total purchases? If you don't have, or you haven't been given, then in that case you have to determine them first. So in this question, we take note that we're starting with the sales. We are given only one, the cash sales. But the cash sales does not represent the total sales. We have to look for the credit sales. We add to the cash, we get the total. So now we are not given the sales, so we have to look for it. The other one is the purchases. Have we been given the purchases? Yes. In the payment, in the statement of bank statement, there is a purchase for resale, but that is a cash purchase. Now, how about the credit? So in this case, we have to determine the credit purchase so that we can add to that cash, we get the total purchases. So this is what we said you normally do. To get the total sales, you do it this way. You say total sales is equals to credit sales plus cash sales. We said for the cash sales you'll be given, if it is there, like we have seen it's already there, the issue is about the credit sales, where you have to determine it. Now, the best way to approach the question, we said, leave a space like 2 lines, where now you'll be able to open the debtors or receivable account to determine the credit sales. So you'll come here and have the debtors stock receivable. You start with balance brought down here, that's what we said, for the debtors. And then jump 4 or 5 lines here, where you'll be posting those items that affect the debtors. And then balance at the end here for the debtors. And then totals will be here. Same case on the purchases, we say total purchases is as a result of credit purchase plus cash purchases. For the credit purchase, we jump a space of 2 or 1 line, and then we have the creditors or payables account, where we will be able to get the credit purchase. Then for the creditors, you start with balance brought down here for the creditors, and then jump 4 or 5 lines, then have the balance carried down for the same creditors. And then you'll be able to post everything and the totals there. Once you have done that, now go through the whole question. If you come across some cash sales here, something affecting the debtors here, cash purchase here, anything affecting the creditors here. So we start. From the first paragraph, the only figures that we have are 18,022, which were monthly salaries to the partner. So those do not affect, so we ignore. We go to the receipt. Capital, introduced, that's not. Cash sales, yes, here. So we post it here, 12,700,000. And then receipts from debtors. Receipts from debtors, we said it reduces the debtors. Here, receipts, which we have 5,200,000. Then sale of motor van, that doesn't affect. We go to the payment side. Equipment for the office, that does not affect. Rent for the go down doesn't. Salaries and wages, no. Purchase for resale, yes. Here, that's a cash purchase, of which case we have 9,900,000. The other one is the repair and maintenance doesn't affect. Insurance, interest, motor vehicle, sundry expense. Motor vehicle purchase, that's a fixed asset, not goods. Remember, what we are looking for are for the goods. Tax penalties, electricity, medical expense, balance carried forward, those do not. Then we go to the additional information number 1. The following payments were made in cash from cash sales before banking, meaning what went to the bank, as we can see, the bank statement was this. But before that figure was posted, not really this one, but the one in the bank statement, we had 12,700, this one. But before they banked the 12,700, they had paid some expenses, meaning our cash sales was more than what was banked. So to get the how much it was, we need to add the one that was sold on the one that was sold on cash and then used to pay the expenses. Which one? Motor vehicle expense. So the key thing there was from cash sales, were paid from the cash sales. Motor vehicle expense per annum, that we had 138,000. The other one is wages, 162, plus sundry expenses per annum, 35. Then weekly drawings by Karimu and Shika. So weekly drawings for the whole year, it has to be for the 52 weeks. So 52 weeks times now weekly for the total, which is 7,200 plus 6,400, and that ends there. From there we go to number 2. During the year, discount received from the supplier amounted to 132,500. Discount received reduces the creditors, so we'll have it here. Discount received, which we had 132,500. The other one, where discount allowed to customers amounted to 118,000. Discount allowed, which reduces the debtors. Discount allowed, which we have 118,000. I want to bring this one a little bit up here, but I haven't changed anything. It's just this, and so we had said the balance carried down for the creditors. We leave it there. So we continue. After that, we go to the point number 3. As at 31st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. That doesn't affect. Depreciation was to be provided on equipment at 10% straight line. No. As at 31st December 2019, the amount owed to supplier was 780. Now this at the end of the year, what the supplier are owing is 780,000. And then while the amount owed by customer 1420. What is owed by the customer is 1420 at the end there. We continue. An amount of 82,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad. This amount was excluded in the total amount owed by the customer as at 31st December 2019. So that's a bad debt written off. Bad debt written off reduces the debtors written off, which we have 82,000. 82,000. The other one is number 7. Salaries and wages include salaries to the partners. That doesn't affect. Number 8, go down had been occupied since 1st November 2019 at an annual rent of that. Doesn't affect. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. Doesn't affect. The wear and tear allowance was agreed with the Revenue Authority to be 112,000 for the year 2019. Doesn't affect. Closing inventory was valued at 620 on that 1st December 2019. Doesn't affect. So we are done. So from there we do the computation. So we are going to add the totals on this side and compare to the total on this side. Actually, we have seen the balance brew down is 0 and also balance brew down here because we started or they started the business at the beginning of the current year. So there was no balances from last year. So it's all about the total on this side would be now the credit sales here. Credit sales. So we add them 5,200,000 plus 118,000 plus 82,000 plus 1420, which gives us 6820,000. And this one 6820 should be the totals. 6820 because we now have written the balancing figure. So then this one we transfer it here 6820,000, which we should be able to add now the cash. So we'll start by taking 7,200 plus 6,400 times 52. So it will be 7,200 plus 6,400 times 52 weeks because that was per week. That becomes 707,200 plus 35,000 plus 162,000 plus 138,000 plus total 700,000. Then now we add this one plus 6820,000. 6820,000 giving us 20 million 2562,200. That is the total. We come here, we add this plus this. This is 0, so that will be the credit purchases. So this plus this 132,500 plus 780,000. So that will be 912,500, which will be here 912,500. 912,500. We transfer that one here 912,500, and then now we add the cash purchase. So plus 9,900, which give us 10,812,500 there. With that one now we can prepare the statement of determining the taxable income. So we'll come here, the name of the partnership is Kashi Enterprise Partnership. We get the taxable income for the year ended 31st of December 2019. So we start with the sales, which we had determined 562,500. Then we less cost of sales. Cost of sales, which we take the opening stock. But here you'll note that we were not given the opening stock because we started the business at the start of this year. So there were no opening stock from last year. So 0 plus the purchases. Purchases is what we have determined here. 10,812,500. Then we minus the closing stock. Closing stock is the one given in point number 11, 620,000. So minus 620,000. And then we also minus any item that could have reduced the stock during the year. Damaged, withdrawn stock, stolen, of which case the whole of this question, we didn't have any stock that was stolen, damaged, or withdrawn by the partners. There was none. Let me confirm properly. There wasn't any. The drawings that we are given in additional information, number 1 was cash drawings, not goods. So in this case, we cross to get the cost of sales. Cost of sales, which will be the 10,812,500, you minus 620,000, and that gives us 10,192,500. And then we can be able to get the gross profit. Gross profit will be, we minus that from 20,562,500. And that gives us 10,370,000. Then we said this, after getting gross profit, and the reason why we call it gross profit method is to add other taxable operating income. Other taxable operating incomes. Other taxable operating incomes. Of which case we said you jump a space of like 3 lines and then you less And to bring this one here, 1,000. So you less allowable expense after jumping around 3 lines. Allowable expenses. So what we do now, we go through the whole question. If we come across a taxable operating income, an allowable expense, we post here. We start from the top. The first paragraph was about the salaries to the partner. We said anything to the partner we don't allow. It's an expense yet, but not allowable, so we cannot post. We go to the summary of the bank statement. On the receipt side, capital is not an income or an expense. Cash sales, we used it to get the sales. Receipts from debtors, we use it to get the sales. Sales from the van, we said income from selling fixed assets, we don't tax, so we cannot post here. We go to the payment. Equipment. Equipment is a fixed asset, which we should claim capital allowance at the rate of 10%. But we won't do that. Why? If you look at additional information number 10, we are told the wear and tear allowance, which we said is the same as capital allowance, was agreed with the revenue authority to be 112,000. So that's the one that we use. Anywhere we require to compute capital allowance, we use that. So we can even post it now. The capital allowance, also called WTA or wear and tear allowance for the year. It was agreed to be 112,000. From there, we go back to where we found that in the bank statement. After equipment, rent for go down. That's an allowable expense, rent expense. But we have an additional information to that rent. If something has an additional information, check it out. In additional information number 8, the go down has been occupied since 1st November 2019 at an annual rent of 450. So annual is per year. And now it was occupied from 1st November. Those are 2 months. So forget about the one that you are given. Use the one that you can get for this particular year. So in this case, we are going to take 2/12 times the 450 because it was only occupied for 2 months to the end of the year in this particular year. So this is going to be 2/12 times 450. That will be 75,000. That is the one that we allow. Any other, we forget. Then we go back. After the rent for the go down, salaries and wages. That is allowable. But we have to check whether it is mentioned somewhere else. Salaries and wages. Yes, it had been mentioned in additional information number 7. The salaries and wages include the salaries paid to the partners. Salaries. And here they have made it very clear that it is salaries and wages. Another place that we have wages now mentioned is number 1. The following payment made through the cash from the banking. So we have the wages. So what do? We'll come here and have the salaries and wages. So we open a bracket. Remember, we want to know the allowable salaries and wages for this year. 890,000. And then now we have to add the one that was paid through the cash. This was through the bank. The cash was 162. And then number 7, it includes the one paid to the partners. So we have to remove because we said anything to the partners we don't allow. To the partners was how much? In the first paragraph is where we were told the monthly salaries to the partner was 18 and 22,000. Monthly, underline monthly. So meaning to get to the whole year, we have to take minus 12 times 18,000 plus 22,000. So that we can get, and since it is not mentioned somewhere else, we do the computation. So we take first of all the 18,000 plus 22,000, and then you multiply by 12 months because it was monthly. We get for 80,000. Then we remove them from this. So we take 890 plus 162 minus 480. That gives us 572. That's the one that we should be allowing there. After that, we go back to where we found the salaries and wages. After salaries and wages in the bank statement, purchases for resale, that we used to get the purchases up there. Repair and maintenance, that is another allowable expense. Repair and maintenance. So we check if it is mentioned somewhere else. There isn't. So we just pick the figure as it is, 860,000. After that, we go back. After the repair and maintenance, there is insurance. Insurance is also a allowable expense. So we have insurance. Is it mentioned somewhere else? Yes. Additional information number 3. As at 31st December 2019, electricity and insurance prepaid. So this was prepaid, and it's at the end of the year. We said prepaid at the end of the year is for next year, not for this. Anything that is not for this year, we minus. So we are going to take the insurance of 62.5, and then we minus the prepayment, which we have 12,800. That will give us how much? This will be 62,500. We minus 12,800. That gives us 49,700. After that, we go back to where we found the insurance. After the insurance, there is interest expense. Interest, we say, is allowable. So interest expense. But it is mentioned somewhere else. In additional information number 9, included in the interest expense is the interest on partner's capital contribution at the rate of 5%. Included in interest. Anything to the partner we don't allow. So we will take this interest, which is 612,000, and then we minus the one that was paid to the partners, which was 5% of the capital. The capital is in the bank statement, where we have for the two partners 3,500 plus we have the 2,500, that is 2,500,000. That. So we add the capitals, which are 35 plus 25 times 5%, which give us 300,000, and we minus from 612, that give us 312,000. That's the one that is allowable, the one paid to the partners. Then we go back after the salary, after the interest, after the interest. Motor vehicle expense. Motor vehicle expense is allowable, and we say that is not the cost of motor vehicle, it's the vehicle expense incurred to run the motor vehicle, fuel, repair. So in this case, that is allowable, not a fixed asset. Motor vehicle expenses, where we are told the motor vehicle expense is 186,500. After that, we have sundry expense. Maybe there is something that I should have confirmed. In additional information number 1, there is more motor vehicle expense. The one that was paid in cash, 138. We forgot about that, so we should add it. So it will be 186,500 plus the one that was paid cash, which we have 138,000. 138,000. We check if it is mentioned somewhere else, but the motor vehicle is not mentioned anywhere else. So what does that mean? Then that means that we do the computation. 186,500 plus 138,000, which we get that 245,000. That 245,100. Then we go back after the motor vehicle expense. We have sundry expense. Sundry expense is an allowable expense, so we continue. Sundry expenses. And this one again, it is mentioned somewhere else in additional information number 1, the one that was paid through the cash. So we'll have 218,000, and then we add the one that was paid through cash, which we have 35,000, which we have 218 plus 35,000, which give us 253,000. Then we go back after the sundry expenses, motor van purchased. That's a fixed asset which we should claim capital allowance. But remember, we were already given the capital allowance, so we ignore. Tax penalties, we said any expense relating to tax we don't allow. Electricity expense, that is allowable. So electricity expense, but we check for the additional information. If you go to the additional information number 3, we had electricity prepaid, and we said prepaid is for next year. So that one we need to remove. We need to minus, because of what was paid this year of the electricity, 45,800, part of it is for next year, and so we should minus from here, where we have the 25,000. That gives us 2,800. Then we go back to where we found that. After the electricity, there is medical expense. Medical expense are allowable unless we are told it was relating to the partner, which we haven't been told. So medical expense. Medical expenses 630,000. Then now we go to the additional information for any taxable, operating, or allowable expense. Additional information number 1, the following payments were made in cash from cash sales. Motor vehicle expense we have considered, wages we have, sundry expense we did, weekly drawings, those are not allowable expenses. Additional information number 2, those are the figures for the balances of debtors and creditors at the end of the year. So they are not incomes or expenses. Number 3, we have already adjusted for them. Number 4, depreciation. Remember, we said depreciation is not allowable. We claim capital allowance instead, which we have been given. Then number 5, as at 31st December 2019, the amount owed to supplier was 780, while the amount owed by customer was 1420,000. That we had said actually, there's something, there's additional information we jumped. We jumped number 2. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118. Discount received, that we know is a taxable operating income, so it should come here. Discount received, that is a taxable operating income. And we have the discount received of 132,500. And then we have the discount allowed. Discount allowed is an expense and it's allowable. Discount allowed. Discount allowed, which we have been given as 118,000. There. From there we continue. We were actually in point number 5. That's where we were saying that we had the balances at the beginning and also at the end. And then from there, number 6. An amount of 82,000 owed by Jamila Mamba, a customer proved irrecoverable, and it is to be written off as bad debt. This amount was excluded in the total amount owed by the customer as at 31st December 2019. That is a bad debt written off, which we said is allowable expense. So we'll have bad debt written off. Bad debt written off, which we have an amount of 82,000. After that, we go to number 7 now. Salaries and wages include the salaries paid to the partner. Now that we had adjusted in the salary here, if we had forgotten, now you should be able to adjust. Number 8, we had adjusted on the rent. Number 9, we had adjusted in the interest. Number 10, capital allowance we had posted. Closing inventory that we used to get the cost of sales here. There is nowhere else it's supposed to be used. Now that is the end. What remains, and this being a partnership, it should end here, is to get the net taxable operating income. So how do you get the net taxable operating income? It is the gross profit plus discount received minus these expenses. So we do the computation. So we start with the 10, 370,000 plus 132,500 minus 112,000 minus 75,000 minus 572,000 minus 860 minus 49,700. Remember this was 7. 49,700 minus 312 minus 324.5 minus 253 minus 2,800 minus 630 minus 118 minus 82,000. That gives us 7,093,500. And that answers required 1, where we are supposed to get the taxable profit of the partnership. With that one, we are supposed to go to the required number 2, where we do the income distribution. So the income distribution schedule, this is what we said, or how it is supposed to look like. So income distribution schedule. We start by distributing the operating income. So we will start with taxable operating incomes, which is the one that we have determined here, 70,93,500. And then now we list the partners that we have, which we have Karimu, Shika, and now the totals. So we go through the question. Remember, we start by looking for the first 4 items that we said: the salary, interest on capital, commission or bonus, less interest on drawings. Those 4. So if you look at the first paragraph, we had the salary to the partner, salary, which we were told it was per month. So the first one was to get 18,000 times 12. The other one was to get 22,000 times 12. Because they were monthly amounts. So we have 18 times 12, which give us 216,000. So 216,000. The other one is 22,000 times 12, giving us 264,000. And now we have the total plus 216, 480. 480,000. Then we go to the capital, to the cash bank statement. In the bank statement on the receipt, we had capital, which is not one of the item we are posting. You go to the payment side, there is none. You go to the additional information, number 1, drawings we said we ignore. Number 2, no. 3, no. 4, no. 5, no. 6, no. 7, we have posted. 8, no. 9, there is interest on capital. So interest on capital, which is supposed to be 5%. 5% of the capital. How much is the capital? In the bank statement, we have capital of 35. And also, the other one is 25 for each. So we start with 5% of 35, which gives us 175,000. The other one is 25 times 5%, giving us 125,000, and the total gives us 300,000. Then After that, point number 10, none, and 11, there is none. So the only remaining one is the fifth one, profit share. How do you get the profit share? We said you take the taxable operating income we have, like in this case we have 70, 93, 500, and then you minus what has been shared already. We have shared the 480,000 and also shared the 300,000. So whatever remains you share according to the profit sharing ratio. And what was the profit sharing ratio? In the first paragraph, they were sharing 2 to 1. So the first one will get 2 out of 3, the other one 1 out of 3. So let's minus 70, 93, 500, we minus 480, and also we minus 300,000. 480,000 and 300,000 give us 6313. So 6313, 500. Then the first one will get 2 over 3. That give us 4209. 4209, 900. 1,000, sorry. And the other one, we can take the 6313, 500 minus what we have given this. 63, 13, 500. That will give us 2104, 500. And now we can get the total taxable operating income. Total taxable operating income. So for Karimu, it will be 216,000. We add 175,000. We add 4209, which we get 4,600,000. The other one will be 264,000. We add 125,000. And then we add 2104, 500, which gives us 2493, 500. And now the total, which would be 480,000 plus 300, and then we add 63, 13,500. Which give us 1793, 500, and which is the same as the operating income we had determined. Remember, if we had an investment income that is taxable for this question, after getting the operating income, we had taxable investment income, and we share and then get total. But the whole of this question didn't have an investment income. So meaning our question then should end here. So this one will give us now the total taxable income, which should end there. That is how we tax a partnership when you have not been given the net accounting profit. So for this question ends here. And now what is remaining is the taxation of the limited company, which we are going to look at in our next lesson. For now, we stop there until we meet in the next lesson. After this video, there is some assignments, questions that you can attempt. Kindly do attempt and then see if you can be able to do the way we have done it. Thank you very much.
Hello learners, and welcome to the Business Data Analytics session. I am your illustrator, Nicholas Sikali. Today, we are going to tackle a question on the statement of cash flows and see how we can be able to solve a question on the statement of cash flows using Excel. The question that we are going to use is the one that was brought by Kasneb through its pilot paper that was released recently. A sample of the pilot paper is what we have before us here. So I'll be opening a sample of the pilot paper so that we can see how it looks like and how your questions are going to look like. So this is the pilot paper. a sample that was just released the other day. The pilot paper for business data analytics, which is a practical paper, consists of 2 sections. We have section 1, which has a total of 40 marks, and it is tested through multiple choices, because in this section, students are required to pick the correct choice from the given multiple choices. Now we also have section 2. Section 2, which is a total of 60 marks, is where now you'll be required to solve much of these questions using Excel. Like there is question 21, which you are required to prepare a spreadsheet showing a forecast statement of profit or loss, of course, for the next 3 years under the scenarios that have been given here. So this is a sample of how you can be able to prepare such a forecast of the statement of profit or loss, of course, using the rates given. Then we had question 22, that is the Rubini Limited, where students were required to prepare a statement of cash flows, of course, for the years ended 30th June 2021 and 30th June 2022, still using Excel. Then there was question 23, where you are required to apply your financial management knowledge to be able to solve this question here. Of course, it has aspects of net present value, discounting rates, and all those other items. Today, we are going to solve the question on a statement of cash flows. This is question 22, where it's reading, you are provided with the following extracts of the statement of profit and loss and the statement of financial position for the Rubini Limited for the years ended 30th June 2020, 2021, and 2022. Of course, this is the statement of profit or loss extract for the 3 years. Then we have the statement of financial position as well for the 3 years. Then we have the required prepare the statement of cash flows for the company for the 2 years ended 30th June 2021 and 30th June 2022. Of course, to be able to do this particular question, especially part A on the statement of cash flows, we will export or convert this PDF file to Excel. So I'll be able to provide or convert this particular file to Excel using the tools that are available. And once converted to Excel, we will be able now to solve it. So here it is. I've pulled the same question. That is the Rubini Limited statement of profit or loss extract for the years ended 30th June, of course 2020, 2021, and 2022. This is the exact question that I've pulled from the PDF format. Now it is in the format of Excel. And having gone through it, we have required prepare the statement of cash flows for the 2 years ended 30th June 2021 and 30th June 2022. Of course, all that gives you total of 8 marks. Your knowledge of preparing the statement of cash flows has it that there are 2 methods of preparing the statement of cash flows. We have the indirect method, and we also have the direct method. Remember, the indirect method is where you are required to adjust your profits, of course, your bookkeeping profit, for the effects of those items which are not cash in nature, like depreciation, amortization, and impairment. You also adjust that for the items or transactions which are not operating activity, things like gain or losses from the sale of non-current asset. And we also adjust it for the effect of accruals. So if there is any accrued expense, you're also supposed to adjust for it for you to be able to get cash generated from operating activity. Then we have the direct method of preparing the statement of cash flows. The direct method is used where all the information that will enable you to get the gross cash receipts and gross cash expenditures or payments, of course, those methods of getting such things have been provided. Now, in our question here, we can be able to use both direct method and indirect method, but I'll go straight and use the indirect method of preparing the statement of cash flows. So cash flows are categorized into 3. We have cash flows from operating activities, we have cash flows from investing activities, and finally we have cash flows from financing activities. So we are going to start with cash flows. cash flows from operating activities. Cash flows from operating activities. That is the first heading of cash flows here. From operating activities. I'll of course make that bold, and I'll also underline that. I'll bring the currencies, or before the currencies, I can be able to bring the years. They said 2021. I'll also bring the other one, that is 2022 as the year. I'll also bring 2022 that way. Maybe I can center that it is well centered like that. Perhaps this could be here, this way, so that I bring the currencies for those respective years that way. This one can also be made to be bold. Then our cash flows from operating activities. For you to be able to get cash flows from operating activities using the indirect method, then it means that we can use any of the profits here. You can start with the operating profit, that is profit before interest and tax if you want. You can start with the profit, this is profit before interest and tax. There is profit before tax. There is also net profit. There are 4 profits here that you can be able to use. There is net profit, there is profit before tax, there is profit before interest and tax, and if you so wish, you can even start with operating profit. So depending on the profit that you start with, of course, that is what will really matter when making adjustments here. Like if you start with operating profit, then there will be no need of making adjustments for depreciation, which we see here. If you start with profit before interest and tax, then of course you must adjust for depreciation. And of course, when you start with the net profit that is below here, then it means you also adjust for so many items there. So I'll pick profit before interest and tax. Profit before interest and tax there. I'll not make it bold. So profit before interest and tax in this particular case, this one for 2021, profit before interest and tax for 2021 is that. Then we also have profit before interest and tax for 2022 is this. So Control V there. So Control V, so that is profit before interest and tax. Once we have profit before interest and tax, of course, we will add back. What can we add back? Profit before interest and tax, we'll add back depreciation. So depreciation was given as 800 and 750. So I'll be adding back depreciation. So add back depreciation. Add back depreciation. Of course, this one is not to be bold. This one is not to be underlined. So depreciation is 800 and 750. So I'll use 800 here, and I'll use 750 there, and 750. So it's supposed to be in bracket. So I'll adjust this. More number formats. I'll go to custom, scroll down, and find the one that is exactly showing that, which is here. I'll click on it, and of course you can see it's in bracket now. So you add back depreciation. You check for any other thing to add back. If at all given in the additional information, there was nothing like that. Of course, for profit before interest and tax, it means finance cost is yet to be deducted. Tax expense is also yet to be deducted. So you won't adjust for those. Then this will give you operating profit. Operating profit before working capital changes. Operating profit before working capital changes. That will be given by this. I think the something is wrong somewhere. We are adding back depreciation. So that is 800. And this one is 750. So yeah, 750. So that you get equal sign. So we are adding it back because it had been deducted before arriving at profit before interest and tax. So remember, depreciation had been deducted, so you add it back. So this is that plus this. Get that. Then again, equal sign, this plus 750. And it will give you your answer of 27,506. So that is profit, operating profit before working capital changes. Now we want to go to changes in working capital. When we talk about working capital, we are referring to inventory, we are referring to receivables, and we are referring to payables. So we are going to look at those items and see how they changed. Of starting with the inventory, and you check 2020, 2021. So inventory here was 15, here it was 21,750. So that is the increase in inventory. So increase in inventory. When you talk about increase in inventory, that one is an outflow. When inventory increases, it means that you went and purchased inventory. So increase in inventory will be given by what we had here. You subtract this, then you'll get your increase in inventory, of course, which is an outflow. So that is increase in inventory. Here will be equal sign. Inventory increased from this minus 27,488, and of course the increase in inventory there is 57,38. Of course, 57,38. So this will be there. That is fine that way. Then there is also receivable. It's also increasing. So we also have increase in receivable, increase in receivables, so equal sign. Now receivables are increasing from this, cost minus this, so that is increase in receivables. On the other side, receivables is increasing from 8750, cost minus 15,460, and that one gives you that increase in receivables. Then we look at payables. Payables, they are also increasing. So increase in payables. Remember, increase in payables are inflows and not outflows. So increase in payables, it means you've received more money, or you went and purchased goods on credit. So that one is treated as an inflow. It will be equal sign, increase in payables. Now we use this minus this one, it's an inflow. The other one will be equal sign here minus this, and that one is increase in payables. So that becomes increase in payables there. After that, we will be getting the cash generated. Cash generated from operations. Cash generated from operations. Cash generated from operations. The spelling of operations looks wrong. That is cash generated from operations. Now on cash generated from operations, it will be the aggregate of what we have here. It's operating profit before working capital changes, plus increase in inventory, plus increase in receivables, plus increase in payables. You'll get your cash generated from operations. The same, equal sign, this plus here, plus here, plus increase in payables. Of course, you get the cash generated from operations. So that is cash generated from operations. Once you have that, of course, we move to finance cost paid and also income tax expense paid. So finance cost paid and income tax expense paid. We check if at all there is any additional information that would affect that to necessitate a control account, but there is none. So finance cost paid, finance cost paid. So finance cost paid here will just be what we have here. Finance cost paid, let's use minus, so the finance cost paid is 7,000 here, 7,000. So you can as well just say equal sign 7,000, equal sign 7,000. The other side equal sign 9,000, so you can see equal sign 9,000, it takes this. So that is finance cost paid. What about income tax paid? Income tax paid. So the income tax paid, the same tune. There is this 43. Then again equal sign 5327. That gives you 5327. So that is income tax paid. This will give you the net cash flows from operating activities. Net cash flows from operating activities, which will be the aggregate of cash generated from operations plus finance cost paid plus income tax paid costs, and you get 2840. The other side, this is 16,389. You add 9,000. You add 52. Remember, the ones that are in bracket are outflow, so it will just deduct and give you the answer. So that is 2062. So that is net cash flows from operating activities. Net cash flows from operating activities. After that, we move to cash flows from financing activities, not financing but investing activities. From investing activities, cash flows from investing activities. And on cash flows from investing activities, of course, we'll be seeing the changes in property, plant, and equipment. Remember, this property, plant, and equipment can only be affected by three things. One, acquisition of new property, plant, and equipment. Two, revaluation of property, plant, and equipment. Three, a disposal of property, plant, and equipment. That is if the PPE has been stated at cost. But if the PPE has been stated at net book value, then depreciation as well will be affecting property, plant, and equipment. So what we have here, reported as PPE, I believe is at net book value, and it will as well be affected with depreciation. Now, the only change here that we are going to get on investing activity will be, of course, whether it's acquisition of property, plant, and equipment. We are going to see that. If this is the opening balance of property, plant, and equipment for 2020, then this is the closing balance, which has increased so immensely. You can see from 25,800 to 45,200. That can only tell you one thing. The business purchased new items of property, plant, and equipment. Remember, there is no revaluation. Under equity here, there is no revaluation, so there was no revaluation that was carried out. So the only thing that affected property, plant, and equipment must have been acquisition and depreciation. So it's acquisition and depreciation. So what we do for you to be able to get what was purchased is that you take balance at the end. Of course, balance at the end. On it, you will add depreciation that was charged. Depreciation that was charged. Then you deduct the balance at the beginning. That will give you what was purchased during the year as far as property, plant, and equipment is concerned. So that is cash paid. Cash paid to acquire PPE, or you can write it in full, property, plant, and equipment, to acquire property, plant, and equipment. So the solution will be equal sign. You take the balance at the end, that is at the end of 2021, add depreciation that was charged during the year. It's better we choose this same as this, yes, but I want to use this because this is what that will be, the one that will give us adding. If you use this, it will be subtracting, which is wrong because they are in bracket. So we'll be using 800. You add 800, so I've clicked on 800. You less balance of PPE at the beginning of the year, which is 25,800. So you click on 25,800. What remains here there is what was paid to acquire. That is the balance on the debit side of PPE account, which gives you 20,200. The same case as this, equal sign. The balance at the end of the year 2022 is 46,700. So you click on 46,700. Add. Depreciation charge for the year was 750. Then you less balance at the beginning of the year, which was 45,200. So we have 45,200 here. Then you enter. That gives you 2,250 as cash paid to acquire property, plant, and equipment. But they're supposed to be outflows, of course. They're supposed to be outflows, so we'll find a way of making them outflows. Let's see. If we go to custom, click on OK, it's still not bringing. So we will find a way of having that. The answer was, let me move back. You can see the answer is 2,200 and 2,250. So 2,200 and 2,250. 2,200 and 2,250. 2,200 and 2,250. So this is 2,250 because it's an outflow. This one should be 2,200. It was 2,200, I believe. 2,200. Let me confirm. Must have been 2,200. Yeah, 2,200. So this one is also 2,200. It needs to be in bracket because it's an outflow, 2,200 and 2,250. So I believe you've seen how we got 2,200 and 2,250. Now there is no any other investing activity apart from that. There are no other non-current asset that we can use. So we'll be getting net cash flows from investing activities, net cash flows from investing activities. Of course, the same answer that we have here. The same answer that we have here, net cash flows from operating activities. I want this bold because it's such a major heading. Then finally, cash flows from financing activities, cash flows from financing activities, cash flows from financing activities. Now on cash flows from financing activities, you will be looking at the long-term borrowings and you'll be looking at the equity, how the equity changed, Now on long-term borrowing, you can see it's increasing. Long-term borrowing here is increasing. When it's increasing, it means it's an inflow. You borrowed more funds, so it's an inflow. So equal sign, that is increase in long-term borrowing, and it will be equal sign this minus the other one, because of course it's an inflow. The other one is also increase in long-term borrowing, 60,000 minus 46. That is also an increase in long-term borrowing. Then we go and check what happened in equity. Paid up capital remained the same, so it means that there was no change. Look at what happened in retained earnings. We want to assess and check whether there was dividend paid or not. Now look at this. There is retained earnings balance brought down of 70/80. Balance brought down of 70/80. Now on this balance brought down of 70/80, the balance carried down was 30/53. So we want to see how. Of course, 70/80, let's just see this one, 70/80. If you add profit for the year, remember there is profit for the year 2021 here. So you click on that, it gives you 3053, which is the 3053 that is here. So it means there was no dividend that was paid. So there will be no dividend. Let us also test the last one. Equal sign. They started the profit of 30. They ended with a profit of 15,482. We want to see how. So balance brought down of 30, 53. Add profit for the year of 12. There's a profit for the year of 12,429. Let's see if we'll get the 15 here. If you enter, the answer is 15,482. So that is fine. Again, there was no dividend that was paid. So it means this will be the only cash flows from financing activities. So that will be net cash flows from financing activities, net cash flows from financing activities, net cash flows from financing activities. Of course, it is the same answer that we have there, the same answer that we have here. The last part is to aggregate all the cash flows and get cash and cash equivalents. Cash and cash equivalents. That way. So cash and cash equivalents for the year is an aggregate of cash flows from operating activities, add cash flows from investing activities, add cash flows from financing activities. So equal sign 2840 plus 2200 plus 13334. So that is 4026. The other one, equal sign this plus that plus this. You will get 13145. Cash and cash equivalents brought down. Then we have cash and cash equivalents carried down. So cash and cash equivalents brought down, because that has been given, equal sign. The cash that you started with in 2021 was the cash that ended in 2020. So cash and cash equivalent here is 0. Add bank overdraft that was here, 5297. Of course, you get 5297, but it should be an overdraft. So equal sign 0 minus this. So it's an overdraft. The other one, equal sign 0 minus 9322. It's an overdraft of that one. Now cash and cash equivalents, when the period was ending, of course this will be equal sign this plus that. 9323. 9323 is the answer. Here you can see that cash at the end of the year, that is 2021. If you move down with the 2021, 0. Then this one is an overdraft of 9322. 9322. So this and this should be the same. They should be the same. 9322. This one is 9323. So they are not. Equal sign. Let us test the other one. This plus this. That is 3823. 3823. 3823. Let us confirm. It is an inflow. There is money. There is cash at the end of the year. 3823. Look at cash. The overdraft is 0. The other amount is 3823. So this is correct. 3823. 3823. You can see 3823. 3823. The other one is an overdraft of 93.22. Overdraft of 93.22. Here we got 93.23. So there's a difference of 1 for the cash flow that you've prepared for the year ended 30th June 2021. So this is how you are supposed to deal with this question on preparation of the statement of cash flows, of course using Excel. The same thing that you know, but can you do it using Excel? That is the big question. Can you do the same thing using Excel? And if you can, then it means that you can be able to prepare a statement of cash flows. In our subsequent classes, we are going to look at other questions that were in that pilot paper, more specifically the question 21 on section 2, which required us to prepare a spreadsheet showing the forecast statement of profit or loss for the year, for the next 3 years under, of course, each of the 3 scenarios. But that will come later. For now, I would like you to comprehend this and see if you are able to repeat whatever happened here. Bye for now, and see you in our next session. Welcome to our another lesson on Introduction to Microsoft Excel. In our previous lesson, we started on working on how to work with basic formulas and functions in Excel. We looked at the formulas, among them addition, we looked at subtraction, we looked at division, we looked at multiplication, and we also looked at power in cells. So these are the formulas that we looked at last time that we had a lesson. Today, I want us to pick up from where we left and talk about more formulas about the same thing. We are going to talk about average. We are going also to talk about maximum. These are now statistical formulas. We are going to talk about minimum. How do you get the minimum value? We are going to talk about count. We are going to talk about mode. And we are also going to talk about some more formulas here. We are going to talk about standard deviation. Standard deviation, and maybe before I forget, there's also median that is to be done under the statistical formulas on basic formulas in Excel here. So this is what we want to cover, and it will be an extension of the work that you already have. Remember, we had this particular work that we used on our formulas last time. So this one is going to be an extension of what we already covered in our previous lesson. Let us begin by looking at average. So how do you get the average of some marks that you have with you? So average is operated the same way as what we did in the other formulas like addition and also getting the product. So you can average in cell, you can also be able to average in range. Let us start by averaging in cell. Of course, every formula is preceded with an equal sign. Then average, then you double click on average, that will appear there. Then you can click on the cell that you want, or you can type it manually. So in our case, let us click on, we want to get the average of Tom. So I'll click on 65. Then now we separate them with commas. So 65, then comma, 84, then comma, 70, then comma, 76. And if that is the end, you close the bracket, shift, and the sign of closing the bracket on the keyboard. After that, you enter, and it will give you the average for Tom for all the units as 73.5. So this is the average, and you can be able to copy it down all the way to the last one, which is not Juliet. I believe there is something wrong there. On our product, in our previous class, I believe we might have included the wrong items. Let me just confirm what we did. Okay, that seems to be okay. It's all fine. So up to the last one, who is Tony. So we've gotten the average of Tom all the way to the average of Tony. I can undo and I can start again by getting the average. Of course, equal sign, then average. You double click on the average. Then after double clicking on the average, you can type manually like B10. You can see it's highlighted, comma, C10, comma. But that is a long way. If you want to move faster, you just click on them. So 65, comma on the keyboard, 84, comma, 70, comma. Remember, if you want to jump one, you can always jump. Assuming that you never wanted the one for auditing, you can always jump and you click on the last one. So this one is now excluded in your average for that particular period, and you can see the average has reduced. So there's also another way, of course, average in range. So again, average, and you just select average in range. You select up to where you want, up to 76, then shift and you close the bracket. So that is average in range. Then you enter to get 73.5, from which you can be able to drag down your formula all the way to what you want, up to Tony, and you'll get all your averages for that particular student. You can also get average here, if you so wish, average and equal sign, or let us use now the other aspects. You can go to the formula place, AutoSum. If you see average, you click on average. There's average here, but this one will pick everything. You can see up to the next place where there's nothing. So this one majorly picks everything, but you can be able to highlight up to where you want, that is up to Tony, and it will give you everything that you want. If you enter, of course, the average is 66.60. You can undo, and again, in the formulas, you can use the insert function. You click on insert function. What do you want? You want average. Like that. So go, and you will see average highlighted here. Just click on it. Okay. Then you confirm whether B17 to B19 is what you want. B17 is just 15 subtraction, then B19 is just this one. So it's wrong. It means you can deduct, or you can do away with it and select whatever you want to get the average of. So you just select, you can see it is moving all the way to Tony, and your average is set. So the average is set. Once you have done the correct thing, you click on OK, and you can see the answer is still 66.6. So whichever approach you use, of course, the average is still going to be the same as in any other case. Average, you can see the answer is still 66.6. So you then drag across all the way to MA, so that you can have your average up to MA. So that is the average of those particular items. Having done the average, the next thing is maximum. Now we want to do maximum. What is the maximum? Maximum is the same as highest. So we are looking for the highest value in our set of data under financial accounting. So equal sign, then max. So you look for the function of max. This one returns the largest value in a set of values, and it ignores values and logical values and texts. Of course, this one is max. Then which one is the highest value? The highest value up to there. Then you close the bracket. This one gives you 88. So you can see in this set of data up to here, 88 is the highest value which has been returned by this. So if you copy across, it also gives you the other highest values in, like in this case is 84. In this case, you can see it's 70 is the highest value here. In this case, the highest value can clearly be seen to be 76, of course. So that is highest value using max. What about lowest value? How do you get the lowest value? Of course, when using the lowest value or getting the lowest value, you use mean. So we are going to use mean to be able to get the lowest value. And again, you highlight all the way to this one, and the lowest value there is that one. So the lowest value is 50. the formula is saying that it's 50. Let us see. The lowest value, indeed, 50. Here there is nothing, so it cannot count that. So 50 is the lowest value. There are two 50s, so it will just pick any. What about these other cases? You can drag across and get your lowest value. Again, here they are saying it's 50. Let us confirm. The lowest value is indeed 50 from this set of data. It's 50. What about 34 here? Is the lowest value 34? Indeed, yes. The lowest value is 34 from this set of data. Even here, of course, the lowest value is 24 from this set of data. It is 24. So that is the lowest if you want to get the lowest value using minimum. Now we want to move to median. How do you get the middle value? Middle value, of course, we'll be using median. Equal sign, then we do median. So you double click on the median and you can be able to get the lowest value in that set of data, median. And that is median. Is it the median? Of course, when getting the median, Excel arranges from the lowest to the largest and then accesses the median value. So if you arrange these items from the lowest to the largest, the median value will be 65. So let us copy across and see which is the median value in the other cases. You can see the median value in these other cases here. So that is median, which helps us to get the middle value or the midpoint. So after the median value, we can also be able to get mode. Mode simply refers to the most occurring. So most occurring, that is mode. Most occurring. So let us see how do you get the most occurring in mode. So you can see mode. The function is available for this one returns the most frequent occurring or repetitive value in any array or range of data. So this one returns the most occurring. So again, we want to select here and get the most occurring in a set of data. And the most occurring that set of data is 50. Let us see if 50 is most occurring from here to here. Yes, 50 occurs twice. So 50 is the most occurring. If you copy across, you can see that it gives you 50 again here. And indeed, 50 is the most occurring, 50 and 50. But here, the answer is not available. That means there is no most occurring. So there is no most occurring here. There is no figure that is repeating itself in this set of data. So there is no most occurring. Even here, there is no figure that appears more than once. So there is no most occurring in this set of data. So that's why the answer here is not available. And indeed, that is the correct answer, not available. After that, you move to another formula. After most occurring, which is mode, we can be able to get the standard deviation. Standard deviation. Of course, standard deviation is equal sign, then STDEV. That is the formula that you use for standard deviation. What is standard deviation? You can see it says estimates the standard deviation based on the sample. It ignores the logical values and text in the sample. So that we want to get the standard deviation of this set of data from here moving the way to this place. Then you close the bracket and this will give you a B10 to B15. If you enter, it returns the standard deviation as what you can see there. So that is the standard deviation. If you copy across, it gives you the other standard deviations from the other set of data there. So those are the other statistical formulas, basic of course for beginners, that you can be able to use in your work. You can be able to use to manage your work, either if you are a student or if you are working somewhere. These are the functions that are usually used when doing a lot of statistical and also mathematical tasks. There's an Excel file that is attached below the video description, which will use for your assignment. So make sure that you go through it and redo almost everything that you've done, almost everything that we've gone through in this particular lesson. Thank you, and see you in our next lesson.
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through equity investment analysis, and what we'll be looking at today is technical analysis. And what specifically we look at under technical analysis, The specifics we will be looking at today include, we will start by looking at introduction, where I will be able to briefly explain the mechanics behind technical analysis. Then, after the introduction, we'll look at the technical analysis principles. What principles guide technical analysis? Moving on, we will move on and look at the logic behind technical analysis. Then, once we've looked at that, we will move ahead and look at the types of charts used in technical analysis. So what types of charts? Specifically, we will look at the following charts. We will start by looking at the point and figure chart. Point and figure chart there. Then we will look at the line chart there. We'll move ahead and look at the bar chart as well. And then we will finalize by looking at the Japanese candlesticks. Japanese candlesticks there. Then, once we've looked at these types of charts, we will move ahead and look at the door theory. Then we will be able to conclude this first lecture under technical analysis. Now, we start off by looking at the introduction to technical analysis. Why is the introduction important? The introduction will form the sound basis as to why we are conducting or understanding technical analysis. Why are we learning technical analysis? The introduction will try and create that or arouse that interest for you, the learner. Now, what I can be able to explain under the introduction goes like so. Technical analysis tries to cover up where fundamental analysis left off. Fundamental analysis looks at the identification of the intrinsic value of a security or an asset. That is what we have been doing by looking at the free cash flow method. We've been looking at the free cash flow method. We have mentioned about the dividend discount model. We've also looked at the price multiples. We've looked at the residual income. Using those models tries to identify the intrinsic value, the true and fair value of a security or an asset. So that once we've identified the intrinsic value, we are able to compare it with the current market price there, such that if we have the current market price, I can put that initials like that, is greater than the intrinsic value, then you are saying that the security or the asset is overvalued. So, if the current market price is less than the intrinsic, it is the opposite of that. We are saying it is undervalued. Current market price is equals to the intrinsic, it is correctly valued, like that. That is what we have been doing by trying to look at those models that govern fundamental analysis. However, what fundamental analysis doesn't do is to try and explain the short-term price movements. What am I saying? These short-term price movements can be able to dictate whether there is going to be an uptrend or a downtrend like that, which we will be able to try and demystify under technical analysis. What technical analysis does, technical analysis tries to step in and tries to identify cyclical patterns in the price movements of securities or assets there. We're trying to identify trends or trend movements. That is what technical analysis does, and it tries to fit in, especially more so in this short-term period, trying to identify which securities to purchase during the short term there. Probably you might have experienced this when going into an investment bank or a stock brokerage firm. You would want to purchase securities for the short term. Fundamental analysis cannot be able to assist the analyst to make a decision and trying to identify the securities to purchase. That is where now technical analysis comes in. And we will be shortly looking at the technical analysis principles so that we can be able to reinforce our understanding of this topic. So we can be able to mention something right here. You can say technical analysis tries to identify or assist the analyst stroke investor in decision making as to which securities or assets they should purchase. They should purchase or sell. Now I'll explain the concept, the mechanics behind fundamental analysis and why now technical analysis tries to fit in the shoes of fundamental analysis. Fundamental analysis only tries to identify an assets stroke securities intrinsic value. And we had explained in the topic under return concept what the intrinsic value is. I'll just recap on what we looked at. The intrinsic value is the true and fair value of an asset. What an analyst believes the value of the security should be based on the four valuation models we had looked at. The four valuation models include, I'll reiterate again, the free cash flow, the dividend discount model, the price multiples, and the residual income. We are trying to identify the intrinsic value, what the analyst or the investor believes the value of the asset should be. And you compare that with what the Securities Exchange provides as far as the pricing of the security is concerned. So if the current market price, which that one that is issued by the Securities Exchange, is if it's greater than the intrinsic value, the one that you've computed, then we are saying that the security is over or undervalued. So we are saying that the fundamental analysis only tries to identify an asset or security's intrinsic value and compare that value with the current market price. The decisions made under this approach is long-term in nature. It's long-term in nature. So when trying to identify using fundamental analysis, you're trying to identify after some period of time, you expect the share price to either be undervalued or overvalued there. Technical analysis, on the other hand, tries to identify securities stroke assets that should be purchased or sold, in the short term. Because you're saying that short-term price movements tend to also impact or create longer-term price movements over a period of time there. So that is the brief introduction that I have under the introduction to technical analysis. We are saying that technical analysis may play a very critical part, especially when trying to identify small short-term movements or movements within the short term, which is say within 1 to 2 years there. So now moving on from the introduction right here, we will be able to move on and look at the technical analysis principles. What principles guide technical analysis? So we say principles of technical analysis. There. Now, having looked at and understood what the introduction or the mechanics behind fundamental analysis and technical analysis, the first principle states like so, that prices are determined. Number one, we can say prices are determined by forces of demand and supply. By forces of demand and supply. So we are saying that the demand for securities, if we have that demand curve here, so we have price and over here quantity like that, the forces of demand and supply. The demand curve is this one. I recall my economics, I remember the demand curve would go like that, and the supply curve would increase. You'd want to supply more to the market if the prices are increasing like that. So that is the demand curve, demand versus supply curve there like that, and that is the equilibrium price. So we're saying that technical analysis is primarily driven by the forces of demand and supply. How many individuals who are demanding the security or the asset versus how many individuals are supplying the asset to the market. So there must be something to do with an equilibrium price, the price that is acceptable to both the buyers and the sellers. Number two, the second principle states as follows, that the demand and supply forces, the demand and supply forces, we're talking about that demand and supply curve there, are influenced by fundamental factors. Forces are influenced by fundamental and psychological factors. Fundamental and psychological factors. Psychological factors. There. We are saying the fundamental factors uses the information that is provided in the financial statements for companies. So the fundamental factors, I've already explained what fundamental analysis only tries to do, tries to identify an asset's intrinsic value there. And psychological factors are the belief that any investor has for themselves, that I believe, for example, that KCB within the short period, within the short run, will be able to increase by say 50% or 70%, like that. That is what you're saying is the individual factors that affect or that influence or support rather technical analysis. The third one, as follows, is that the fundamental factors can be psychological, can be quantified. We're talking about the fundamental factors can be quantified, and the psychological factors cannot be quantified. So we say that the fundamental factors can be quantified, whereas the psychological factors cannot. So the fundamental factors, we're talking about trying to identify the intrinsic value, where we use numbers or figures. We can be able to at least identify that this, you're comparing the current market price versus the intrinsic value there. So at least that one can be quantified and like that, and a decision can be made using that. We are saying that psychological factors cannot be quantified because you cannot be able to identify individuals' perceptions about a particular stock, or neither can you also be able to quantify, say, the behavioral biases, because we are saying that behavioral biases can influence the market trends, either moving up or moving down, like so. Then we can also say that the combined effect of the fundamental factors and the technical factors is reflected in security prices. So I can come on this side over here, say that the combined effect you can say that number 4, the combined effect of fundamental factors and technical factors what can we say? We can say that it is reflected in the price movements of securities or assets like that. That is the 4th principle that guides technical analysis. We can look at the 5th one there, and we say that past price movements assist in the prediction of future price movements or trends there. So those are the 5 principles that guide technical analysis. The first one, prices are determined by forces of demand and supply. The demand and supply forces are influenced by both fundamental and psychological factors. Then I've said that the fundamental factors can be quantified, whereas the psychological factors cannot be quantified. The fourth one here is the combined effect of both fundamental factors and technical factors is reflected in the price movements of securities or assets there. So these technical factors here and fundamental factors work in unison, like that. Then we are saying that the past price movements assist in prediction of future price movements or trends. So we are saying the use of graphs and charts can be able to dictate or provide some bearing as to which direction the share price will move. Is it either going to be 1, 2, or 3 right there? So that is what we're saying. The analysis of past price movements like that can be able to dictate the future price movements in at least the short term. There. Now, having looked at the technical analysis principles that, there, let's look at the logic behind the technical analysis there. Logic behind technical analysis. There. Now, the best way to describe the logic behind technical analysis is to use a graph. A graph of price against time is the best example that we can be able to use to try and understand that concept, the concept of technical analysis. So we are saying this is the price there, and this is time there. So we have the old equilibrium price there. We have it going down like that, and then we have like that. So we can be able to say this is the old equilibrium price, because you are plotting a price against time like that. Then this is the new equilibrium price there. This part right here is when the information is being released into the market. So when the information has been released to the market, investors decide or that they're not going to take up the new security, or the company's mechanics or the specifics dictate that it should be able to go down there, and less demand for that security will reduce the price of that security. So we say here is release of new information. This is just a hypothetical example that I'm explaining. It could be also the other way around. So we could have like that, a graph up to there, then it goes like that, and then we can be able to put it something like that. So we say this is the old equilibrium price is much lower, then we can be able to have the new equilibrium price being much higher as compared to that. But this is just a simple explanation that can be able to guide the logic behind technical analysis. So that is what we have there. Now, having looked at the logic behind technical analysis there, we can be able to look at the types of charts and used under technical analysis. So we move on to look at the types of charts and used in technical analysis there. I hope this has actually provided some guidance. The logic behind technical analysis is simple. You just need to plot a graph of price against time, and you understand the impact of release of new information. Once information has been released to the market, then that creates or arouses some interest or disinterest. Meaning that in this case over here is a disinterest. This first graph that I do over here. So this is the old equilibrium price. The price was much higher over here. Then the release of new information, possibly negative information, reduced the amount of demand for that security or asset, and hence now the new equilibrium price is much lower than the old equilibrium price right there. However, in this dotted line which I've drawn moving up like that, this part over here indicates the old equilibrium price, which was much lower. The release of new information within that part over here aroused interest or aroused some form of some form of demand for that security, so that you can be able to see over here that the new equilibrium price is much higher than this dotted line which began over here. So the logic behind technical analysis is just driven by forces of demand and supply. That is what I can be able to explain under the logic behind technical analysis. Now, moving on, let's look at the types of charts used in technical analysis right there. So I can come on this side here. Look at the types of charts. So types of charts used in technical analysis. Now the first type of chart that we are going to look at is point and figure chart, or rather let me start first of all by looking at the line chart. Yes, let me just start right here. I'll be able to explain all of them anyway. So the line chart. Now a line chart is a simple plot of price against time. Now this is how I can be able to demonstrate a line chart. Now we are saying here we have price, like that, price against time, like that. And as time goes by, the forces of demand and supply changes the price of the security or the asset. So you can begin there, it moves there like that, it moves down like that, moves as it moves up like that. So we are saying this is a line chart there, indicating this as time is moving at this part over here. You can see is different from this part, it's different from here, and so on and so forth, like that. That is what you're saying is a line chart. You just plot the prices against the time, or as time moves on, you can be able to plot the security and price pattern. So this is a line chart there. Now we look at what a bar chart is. A bar chart right there. So a bar chart is a chart that is drawn like so. You can draw it right here. That. Then we can say that this is just the plot of price still against time. That. But now in this instance, what will happen is that we are going to plot now the starting price, the opening price, and the closing prices like that. Here is the midpoint there. Then as we move on like that, we plot like that, a bar chart like that, and so on and so forth like that. So you can be able to clearly see that this is an uptrend, or the trend is moving in that direction. As well in the line chart, you can also see this an uptrend moving in that direction. However, if it's moving down like this, say from over here, we can be able to decide maybe it goes down like that and moves down like that, moves down like that, and this is now a downtrend that is moving like that. That is what we can say is a bar chart. So I can indicate over here, just over here, number 2, bar chart. That. Now, having looked at those two, let's look at now the point and figure chart. The point and figure chart right there. Under the point and figure chart, a plot of only prices is provided, but now in a very different and unique way. The plot against price alone is the one that is used. So we are saying this is what we have like that, and then we don't have an x-axis there. We only have the y-axis here. So here you have price prices of securities like that. And you're saying if you have a rising trend, you can be able to indicate that is for a specific time period, say within 1 hour, and the prices have actually increased up to that level there. So this is, say, for example, 200, 201, 202, 205, 207, 210, and so on and so forth as we increase like that. However, after this 1 hour, you can be able to find that now the prices have begun to reduce. So you find that this is what happens. We can indicate the reduction using circles like that. And if there is an increase in prices as well, we can be able to continue and put X's like that. And if it's a downtrend, then we can be able to indicate like so, and so on and so forth like that. That is what you're saying is a point and figure chart. We can also plot a point and figure chart using the actual prices. So we are saying that over here, if you can be able to have, say, a parallel diagram right just besides this point and figure chart right here, and indicate now the prices over here. So we indicate, instead of having the x-axis indicating the prices like that, we put it now on the graph itself. So we have 200, 201, 202, 205, 201, 210, 210, and so on and so forth like that. Then you find over here now a reduction, 205, 202, 201, 200, 199, 198, 97, and so forth like that. Then we have now 201, 202, 205, 207, 209, and so on and so forth like that. So you can see there's a slight difference between this point and figure chart and this one, but you can be able to induce some kind of or infer some kind of decision over here. You can see this is the congestion area or the concentration area right above this part over here. That's what you're saying is the congestion area like that. Now, having looked at these three, we can say this is the third one over here, point and figure chart there. Then finally, we can look at the Japanese candlesticks over here. Why these are important is because technical analysts believe in the use of graphs and charts to try and identify price trends that can be able to assist them in making decisions as to which securities to purchase or assets to purchase. Number 4, we're talking about Japanese candlesticks. Japanese candlesticks. Now, what you need to understand under Japanese candlesticks is, first of all, the look of the candlestick itself. A candle looks somewhat like that. Here, before I put this wick over here, I can be able to have that body indicating over here opening, price, closing, price. We can have like that, or we can be able to have another Japanese candlestick like this, where we have the closing price and opening price like that. So you can see this is the opposite of this one. Here you have the higher closing price, and here you have a lower opening price like that. Now, putting that understanding onto a graph, this is what we come up with. We have a graph like so. And put it somewhat like that. Then we can be able to identify now, we can draw now that candlestick over here with that and that. What I didn't explain on these graphs is that here you can be able to have the wick over here. You have the highest price, highest price, and here you have the lowest price like that. So you will have candlesticks like this moving in this direction that provide some guidance to the analyst or the investor that this is a bullish trend. A bullish trend means that it is moving in an upward direction like that, with even highest price happening, higher opening prices or even higher closing prices. Remember, if you're looking at it from this perspective over here, you'll have the opening price being over here, the closing price being much lower. But now, this scenario is usually very typical when you're having a bullish trend, where you have a closing price moving higher and higher and higher. So here you have the closing price, closing price, closing price, closing price, and so on and so forth like that. But now when there's a bearish trend over here is where you'll be able to see that the closing price will tend to be much lower than the opening prices like that. So that should be understood from the Japanese candlesticks perspective. So here we have the price, here we have time moving in that direction. These Japanese candlesticks are the most commonly used by technicians because they indicate the closing prices and the opening prices in a probably maybe systematic fashion compared to the other charts that we've actually looked at there. Now, having looked at the four types of technical charts, technical analysis charts right here, now we move on to look at the Dow theory. Dow theory. Charles H. Dow was an editor of the Wall Street Journal between 1900 and 1902. Being an editor, he was the founder of the Dow Jones Industrial Average and the Dow Jones Transportation Average there. Those are indicators that assist technicians or technical analysts to identify price movements. What we need to understand under the Dow theory is that the historical price movements like so, these historical price movements like that can be able to provide an indication for the price trend that is going to occur in the future there. Now we look at the principles backing the Dow theory. Principles of the Dow theory. Now, Charles Dow said that the price movements of securities move in three directions or three movements: the primary trends, the secondary trends, and the minor movements. Take this example. If you have, say, a bucket full of water like that, this bucket and it's full completely, you hit it on the side like that, you will be able to see the ripples moving towards the center like that. Those are representative of the minor movements. You hit it slowly, or if you hit maybe say a cooking pot like that which is full of water, you'll be able to see ripples moving like that. That represents the minor movements. That. Now, the primary movements and the secondary movements, the primary movements are synonymous to what we can be able to say tides, and the secondary movements are similar to waves. Waves are smaller than tides, and the minor movements are the smallest like that. Putting it all together, before I actually come to the principles of the Dow theory, what I can say is this: if you have a price movement moving in that direction like that, this would be able to now indicate that's the actual price movement. So you will find the price movements, or you're saying that we have the primary movements indicative of that movements like that. I should have probably used maybe a fainter kind of marker like that. So this is the security price that is moving in that direction. So we can be able to have like that the price movements moving in that direction. That is what we're saying is the secondary and the primary movements there. The secondary movements are usually smaller like that guide the direction movement of the price like that. The minor movements are indicative of very small movements of prices in that direction, similar direction of those two other trends like that. That is what we're saying is the Dow theory. The Dow theory has got three postulates, and the postulates or the principles are as follows. Number one, we can say like this, that all information that is guiding the Dow theory there is reflected in the averages of market prices. So all information is reflected in the averages of prices, of market prices. And those averages, what can we say? We can say that those averages reflect market movements. Those averages reflect market movements. That is the first postulate like that. I shouldn't have put it in form of bullet. I should have put it like that. That is the first principle. The second principle can come on this side right over here. You can say that the averages exhibit three movements. Averages exhibit number two, pardon me. The averages exhibit three trends, full colon, primary trend, which is representative of tides, secondary trend, this is trend, it represents say waves, and the minor trend, which represent ripples. That. Number three, all the three trends move simultaneously. All the three trends move simultaneously. So those are the principles that guide the Dow theory. This comes to the end of our first lecture of technical analysis. We hope that you can be able to join us in our next lecture, where we will continue with the same topic. Thank you. God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri. I'll be taking you through equity investment analysis, and the topic that we're looking at is technical analysis. In today's lesson, we are going to look at the following. So we are going to look at, the first thing we're going to look at is primary trend. Then we will move on and look at secondary trend. Like that. Then we will move on to minor movements, like that. And these are the principles that underlay the Dow theory: primary trend, secondary trend, and minor movements. Then we will look at the interpretation of trend lines. Interpretation of trend lines, like that. Now here specifically we'll look at uptrend, that. Then we will look at the downtrend and no trend. Down trend, trend and no trend, like that. Then we will move ahead and look at the prediction of the market using the Dow theory. Prediction of the market using Dow theory. That. And then we move ahead, we'll be looking specifically at the Dow Jones Industrial Average and the Dow Jones Transportation Average there. Moving on, we will look at the support and resistance level. Support and resistance levels, like that, and try to explain the reasoning behind the support and resistance levels. Then we move ahead and look at chart patterns. Yeah. Then we'll move ahead and also look at the reversal patterns. Reversal patterns. And finally, we will look at the trend lines. Trend lines, like that. Now, this is what we will look at today. And we start off by looking at the primary trends. Primary trends. Yeah. Now, the primary trends, as explained in lesson 1, we had said that the Dow Jones, the Dow theory is governed by 3 trends: the primary trend, the secondary trend, and the minor movements. And I will be able to demonstrate the primary trend as follows. So we will be able to draw how the primary trend looks like and we'll try and superimpose the primary trend, secondary trend, and the minor movements on one graph, like that. So here we have increasing, like that, the prices. Here we have time, like that. So if we have the primary movements move in form of trade. So this is the security price that is moving like so. For example, it's moving like that upward direction, bullish trend. This is now moving up. Bullish means that it's moving up. Bearish means that it's moving down, like that. So trying to explain the primary trend, it is in form of waves, rather tides, like that. So that is an indication of a bullish trend based on the primary trend. How different is that bullish trend from the primary trend from the secondary trend? Now, the secondary trend is a movement in smaller patterns, like that. So it just follows the primary trend, but now in smaller, what we can be able to call them as smaller waves, like that. Superimposed on this, we can be able to explain the minor movements. So the minor movements now follow the trend, the general trend, but now in smaller, what you can say, smaller movements. That. So you're moving like that. So the primary trend is the bigger wave that moves like that. I can be able to demonstrate right just below this. This is the main graph over here that we're looking at. Wait, you have superimposing, and you have the primary, secondary, and tertiary trends superimposed on each other. But now, trying to explain the primary trend, this is still prices, like that. Here is time, like that. So we can be able to just explain now the primary trend, because that is the major topic that we've actually talked about over here. So if the security price is moving like that, so you can say that this represents primary trends. You can say this is A, primary trends, like that. That is what we have looked at there. B, say this is A, now this is B, secondary trends. So the secondary trends move in smaller prices, time. So if you have, now we can be able to use bearish trend like that. This is bearish trend like that. So we can be able to say now they're moving in small waves like that. This is what we're saying is a secondary trend. It's much smaller as compared to this one. You can see this one is much bigger there. This one is much smaller there. C, so you can say you can use this B, secondary trend line, but here is primary trend line. So you can be able to see it like that, and this is the primary trends like that. Now we can be able to now draw finally the minor movements. Prices, you can put this right here. We have prices. Here we have time. So we can be able to say, if we don't have a trend, we can give another description over here. If the prices are moving somewhat like that, over here we can have very small movements like that, which are indicative of a minor movement. So here we have C, minor movements over here, and we have minor movement line. C, minor movement line, like that. Now, having looked at the primary trend, now here we have the primary trend. This is the major line, here is the primary trend like that. And we are saying that this is now the big tide over here. This is the wave, and this is the minor movement. We can move on to interpretation of the trend line. So you've looked at the primary trend, the secondary trend, and the minor movements there. Now we move on to look at the interpretation of trend lines there. So let's look at that very quickly. We have interpretation of trend lines. Interpretation of trend lines. Interpretation of trend lines. Now here, more specifically, we had said an uptrend, a downtrend, and a no trend over here. And so we are saying in an uptrend, we can show it like this. So if we have prices moving like that, this is prices, this is time here, we can be able to draw a line like that. As well, we can be able to also draw a line like that, and this is an uptrend, bullish trend like that. Now this is an uptrend, so once you see security prices moving in that direction, generally of course you don't expect them to move like this. In practice you might expect them to move somewhat like that, not very straightforward lines like that. This should be indicative of an uptrend like that. However, so you can say this is an uptrend, A here, uptrend like that. B, we have downtrend, downtrend like that, and we draw a downtrend like so. This is prices, this is time. So a downtrend moves now the opposite of, and then we can be able to probably draw what we can call a channel like that. So that one doesn't, not very perfect. It's good to be perfect sometimes, not all the time, but you can try that. So that is a downtrend, what we can call bearish trend there. Now a no trend is where the market moves in a fashion that does not indicate, or in a way that does not provide any indication of a trend. And I will demonstrate that shortly. Where we have like so, we can use this to make sure at least we are accurate, almost accurate. Time, that. This is prices, that. So we're saying if trend moves like that, then we don't have any movement in any particular direction. It's neither is it moving in a bullish trend, neither is it moving in a bearish trend over here. So you can say here, see no trend, like that. Now, having looked at the interpretation of trend lines there, we move on and look at the prediction of the market using the Dow theory. We can look at the Dow Jones Industrial Average and the Dow Jones Transportation Average right here. So this, we've actually done the uptrend, downtrend, and no trend there. So moving on, this Dow Jones Industrial Average, Dow Jones Transportation Average provide an indication of when to buy a security and when to sell a security. So the best way to demonstrate this prediction of the market is to use a graph. So I can use this part right here. Draw it like that. Not be very perfect, but at least I'm trying my best. Prices. Yeah. And here we have time moving like that. Probably that line may not be the best. Let me just redraw it again. Trying to consider that. Yeah, I think that's better. This is time. Yeah. Now, the Dow Jones Industrial Average is usually much higher. It has got generally higher prices as compared to the Dow Jones Transportation Average. Now, we can be able to just draw roughly how the Dow Jones, it's just like an indicator of when to buy securities and when to sell securities, like that. So you can say Dow Jones Industrial Average Index. Now we can have, probably can have something like, this is when to buy and when to sell. Probably it may not be the best. You can just rub somewhere here and maybe change it a bit. Like that. That. Yes, let's put it like that. Draw lines like that. Also like that. So if we can be able to just draw the Dow Jones transportation average right here, like so. So this should be somewhat like, should have been actually at the bottom part, yes, like that before. Now it rises again like that, something like that. So they almost follow each other the same fashion here. So this should indicate a sell signal, and here I'll be able to just draw somewhere like this, like that. This can be maybe I can do it like that, sorry, like that. Yes, this is Dow Jones transportation average there. Right here indicates right this point here indicates sell signal, and here as well sell signal, like that. Meaning what? Meaning that investors have an indication that the market is actually going to start moving down. That is what you need to understand. That this is a sell signal of either you sell the securities that you already have, or if you're intending to purchase, you don't consider purchasing the security at that moment. But however, after a little while, after some period of time, remember this is time like that, after some time, what happens is that the Dow Jones Industrial Average and the Dow Jones Transportation Average provide an indication of when to buy and sell. At this point is where you should have a buy signal, right? That part over here, this part here, buy signal, buy signal, there. So these indicators provide some guide to investors as well as analysts when to buy securities and when to sell the securities. When to buy, you buy low, you sell high. You buy securities at a low price, at the lowest price possible, then you sell once the securities actually reached a very high price there. Now, the Dow Jones Industrial Average, there are times when you find that if the Dow Jones Industrial Average is moving down and the Dow Jones Transportation Average is moving up in the opposite direction, then there is no indication of any trend. So I need to probably highlight that in writing right here. So I can highlight that by saying that when the Dow Jones Industrial Average, or I can put it in full, I think the best thing is to put it in full like that. Dow Jones Industrial Average, Jones Industrial Average, DJIA, is rising, and the Dow Jones Transportation average is falling, rising, falling. There is no trend that exists there. So we are saying if you have a hypothetical graph like this, you find the Dow Jones is falling like that, Dow Jones Industrial Average is falling, and the Dow Jones Transportation, Dow Jones transportation average is rising like that, then there is no indication of a trend that exists there. So there you should not be able to infer anything, and you should be able to probably maybe hold on a bit so that the trend can be able to exist. However, when the DJIA and DJI, the Dow Jones Industrial Transportation Average, DJTA, are both rising, by the security or asset. When the contrary occurs, sell into brackets, do not buy the security or asset. There. This is just a simple summary of this diagram over here, like that. Now, having looked at the prediction of the market using the Dow theory, we can move on and look at the support and resistance levels. Support and resistance levels as used in technical analysis. Now here probably I move on to this other side so that I can be able to draw a very nice graph over here that can be able to explain to us the support and the resistance levels. And the graph that I will draw over here will be indicative of when we as analysts or investors should consider buying once we see or identify such a trend. So we can be able to draw it like so. That. Price, time, that. And we can draw just something like, say, that. Can probably put it something like that. And probably this should rise a bit like that. That. So for us to understand the support and resistance level, we just need to know, just from the terms like that, we know that the support level is down there because it supports and prevents any further downward pressure movement there. So this is the support level, and this is the resistance level. You can say the support level supports any further downward movement, supports level supports any further downward movement in security prices and restricts movement beyond that point. there, restricts movement. So we're saying the support level, so in some, it exerts some downward pressure. It tries to prevent that further downward movement in security prices, and there, that is what you're saying is the support level. The resistance level is the opposite of this, and we can say that the resistance level prevents any further movement upwards of security prices, prevents any further movement of security prices beyond a specified level there. So that is the support resistance level explanation right there. Now, the support and resistance level can provide an indication of trends as well. So if we have, since we're doing support and resistance level, I can use this space over here. If we have support and resistance levels moving like that, we can be able to say that this is a channel moving upwards there like that. And if we have support and resistance levels now, of course, moving like that, then we can see that that is in fact, a wedge. What you're saying is a wedge like that. So the prices are moving very erratic at the initial stages, but now as they come down to the most recent prices, it actually concentrates at one point there. So that's an indication that the security prices are actually moving down there. Now with that, we move on to now the chart patterns. With the understanding that we have done under support and resistance levels, we try and identify which chart patterns can be used to try and identify trends as used by technicians there. So we can have something right here. Chart patterns and the interpretation. Yeah. Chart patterns and interpretation, what we will be able to look at, we will first of all indicate a no trend, a bullish trend, and a bearish trend. That's what we need to understand. We may be repeating some of the items we've looked at, but that is what the technicians actually want us to do. They want us to understand what the principles behind the use of graphs and charts there. So we can have that and that here. So we can indicate that this is a no trend, a no trend there. And then B is a bullish trend. We can be able to draw how a bullish trend looks like. Right, just below that, we just draw a bullish trend. This is prices, time, like that. Prices, time. So we have now the same, rather apologies, this is bullish trend. So we expect something like that. And then we can draw this is B, bullish trend. There. C, we can say bearish trend, which is moving down. So we can just draw the graph right over here. Bearish trend. This is prices against time. So now we can draw it something like that, where we have the security price or asset price moving down like that. So this is C, bearish trend. Bearish trend. Now, once we've looked at those trends like that, we cannot be able to interpret. Remember, it is chart patterns and interpretation. So here we cannot be able to have any interpretation. The interpretation here is a bullish trend, so we should be able to buy. Right over here, buy is the interpretation. Over here, sell, sell or do not buy. Do not buy is the interpretation right there. We can also move ahead and look at configuration or confirmation of a bullish trend. We can use now another graph here to just continue from this. Confirmation of a bullish trend, confirmation of a bearish trend, and no confirmation of a trend there. There, I can use that. I can still draw another one down here, so that all that will be left is for me to just indicate the trend there. So D, confirmation of can say confirmation of a bullish trend, bullish trend. So we have something that moves like that. Then we have like that. Then it moves up in that direction over here. So these are the security prices over here. The security price is moving like that. Then we have that kind of a channel where there is no trend, and then it moves up in that direction. That is confirmation of a bullish trend. Then E here is confirmation of a bearish trend. Bearish trend, where we are saying it was moving like this, then we have the channel existing like that, and then it moves back down in that direction there. Confirmation of a bearish trend. Yeah. Now, since we've already indicated a no trend over there, there is no need to try and draw a graph that indicates confirmation of a no trend. All we need to move on and look at is the reversal of a bullish trend, the reversal of a bearish trend. So let's look at how they look like. Here, I have this graph drawn properly. Draw another one right here, just below it. That. This is price. I not indicated on these other ones over here. This is price still against time. This is also price against time. It's always good. As an analyst, you need to also always be complete in terms of whatever you're doing. Whether it's doing corporate finance, you're supposed to always be complete and incisive. So now we're just trying to see, now that is E, this is F, and we are saying confirmation of a reversal rather. We're looking at reversals. We've already done the confirmations. Reversal, sorry, of a bullish trend. So we have the security price moving down like that. We have no trend existing at that point, and then we find that the security price starts moving in that direction like that. So that is reversal of a bullish trend. It was moving down, then we had a no trend market right over here, and then it changed direction and said moving up like that. Now reversal of reversal of a bearish trend. Now this one will have a reversal of a bearish trend. EF, this is G, reversal of this is bullish trend, this is bearish trend. Bearish trend. So that means it's going to move the opposite like that. So security prices was moving like that, like that. We had the channel existing or no trend existing there, then it came back and went back down like that. Reversal of a, rather, it should be the other way around. Reversal of a bullish trend. Bullish means moving up. This is reversal of a bearish trend. Bearish, apologies. This is bearish. Bearish trend. This is reversal of a bullish. This is moving up is always bullish, then it comes down like that. This is reversal of a bullish trend like that. So this is price, this is time. There. Moving on, we have a wedge. A wedge. And a wedge looks like so. This is still price. This is time. Now you have the security prices moving like so. You have the security prices moving like so, where you'll have it moving, narrowing down towards a point. Have it move in that direction over there as a wedge. Remember, a wedge is something that looks almost like that. So we find security prices being very erratic over here, but now concentrating towards my point there. That is what you're saying is my wedge. That's G, this is H, wedge. Now here we are saying that, especially when it's like this, we are saying that even if it is bearish like that, the security prices become less and less erratic over here. The interpretation can be that the security now is being less traded, is not being traded as much as possible. So that is what you're saying is a wedge there. Now, having looked at the chart patterns, now let's look at something else, and we look at reversal patterns there. So reversal patterns. Reversal patterns, apologies. Patterns. Now, under reversal patterns, what we have, we look at head and shoulders. And shoulder patterns. There. Just use a graph here. So the head and shoulders will just be like that. Then you have, this is price, time, there. So you find these represent the head, the shoulders, sorry, shoulders. These ones, and this represents the head. So it can be an indication of either downtrend, or it can be an indication of a head of an uptrend, especially more so when you have the inverse head and shoulder patterns. So the inverse head and shoulder patterns will indicate an uptrend there. we can say inverse, head and shoulder, inverse head and shoulder. So inverse head and shoulders, just very quickly. It's just the opposite of that. So you have like that. This is now, these are the shoulders, and that is the head, like that. So you can see that this is the pattern is moving like that. So this one is going to be a bearish trend, or it's almost going to be a reversal. And what we had looked at before, reversal, so it's actually a downtrend, then it changed back, it moved and back up like that. Next one is a double top formation. Double top formation. Over here, what we can do, right in a problem, maybe a very not so big diagram here. This is price, time, price, time, like that. So double top formation, if you have a line like that, in that form, so you find the security prices, let me put it like so. So you find the security prices moving like that, then it has like that. You can be able to now demonstrate that here is actually a double top formation like that. So it's double top at the top like that. So we're seeing over here essentially we have the support component existing right there, so it can be able to just reinforce your decision that it's going to be an uptrend there. So that's a double top formation there. Now to conclude this lesson, let's look at very briefly the trend lines. The trend lines are not any new to us right now in this topic review, because we've already looked at the Dow Jones transportation average and the Dow Jones industrial average. So let's very quickly look at trend lines. Trend lines there. So for trend lines, we just have the following. We just need to understand what each trend line indicates in terms of uptrends, downtrends, and like that. So if you find security prices moving like that, and the general trend line is moving like that, in the Dow Jones Industrial Average moving like that direction, that is a bullish trend buy trend. That's when you're supposed to buy. Then if it's moving in the opposite direction, I can put it on that graph like that, and you're saying that the trend line is moving in that direction, and we say it is bearish trend sell security like that. Here we still have prices, and here we have time. That shows continuity in the line there. Having looked at the trend lines, now we can also try and have something like that. There is no indication of any trend line or any direction of the movement in security prices there. So what can we infer from that? We can infer nothing from that particular line. This particular line over here, we cannot be able to infer anything, because there's nothing, there's no movement in any particular direction, either up or down. Having looked at that, we hope that you have enjoyed this lesson. We hope as well that you will be able to join us in our next lesson, where we will still continue looking at technical analysis. Thank you, and God bless you. Hello Lana, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through equity investment analysis, and today we are going to be looking at a new topic. The topic is called equity market equilibrium. Equity market equilibrium. Yeah. Specifically, what we'll be looking at, we'll be looking at the following. Number one, we'll look at the justification, just a brief explanation about the justification for the short term and long term equilibrium. Yeah, just a brief description about that. Of course, this concept has already been covered under economics. I believe once you've reached this level, you must have done economics at some level. Then we will move on and look at the Greenwald-Kroner model. Greenwald-Kroner model. There. This model is useful in trying to estimate the required return within the market, and what we will be able to look at, we will be looking at the formula of how to compute the Greenwald, the required return under the Greenwald-Kroner model. We will be able to specifically look at the inputs there. Then once we look at the Greenwald-Kroner model, we will be able to move on and look at the Cobb-Douglas we're saying economic function, economic function there. Then we will move ahead and look at the macroeconomic forecasts, and we will specifically look at the H model. We will be able to build on the H model. We had looked at it under the dividend discount model, H model there. Then we move on, building on the topic, we will be able to now look at something as the relative equity market or relative measures of the equity market equilibrium. So we say relative equity market valuation, equity market valuation there. Then we will now specifically look at the following. We will first of all look at the Fed model there. Then we move ahead and look at the Yardney model. I'm trying to look at the equity market valuation. Then we move ahead and look at the 10-year moving price, 10-year moving average price there. Now, once we look at these three relative equity market valuation approaches, we will be able to move ahead and look at now asset-based approaches to equity market valuation, equity market valuation there. And specifically, we will be looking at the Tobin's Q. Tobin's Q there. Now, this is what we are expected to cover so that we can be able to go and understand the equity market equilibrium under equity markets or equity investment analysis. So we start off by looking at the justification for the short term and long term equilibrium. So what we expected to understand over here, we expected just to understand the traditional curve over here where you have the price of a commodity. In this case, you're looking at the price of the market here and the quantity produced there. And we are saying we will be able to have an equilibrium price right at this part over here like that. And that is what we're saying based on these curves over here. Sorry, we're saying this is the demand curve there, and this is the supply curve there. So it is expected that this is the equilibrium price that will be accepted by both producers or producers and consumers at which they can be able to buy the product or they can be able to supply into the market. So we are saying the justification in the short run is that an increase or a decrease in the demand will cause some kind of effect that is going to be significant to try and change the equity market equilibrium, say for example to the new equilibrium value over there like that. So we can put it in writing and say something that in the short run, an increase, decrease in demand for assets, securities in the market will cause prices and output to increase, into brackets, decrease, like that. That is in the short run. As well, we can say in the short run, in the long run, apologies, long run, an increase, brackets, decrease in demand for assets, to brackets, securities, will have the same effect in the market like that, will cause prices to increase, decrease, but after some time to be influenced by macroeconomic factors. So such as, I can be able to put it such as the GDP, inflation, interest rates, amongst others. I can put ETC there, pardon me, ETC, and prices will tend to stabilize in the long run. Stabilize in the long run, stabilize to the long run average prices in to stabilize to the long run average prices. There. That is what we just need to understand under the justification for the short term and long-term equity market equilibrium or equilibrium prices. We know very well that the fundamental analysis in terms of looking at the DDM, discounted dividend model, the free cash flow valuation, we also mentioned about residual income, and finally market based valuation, price and enterprise value multiples, all represent fundamental analysis. This is there. So market based valuation there. And this has a tendency, or these decisions based that have been arrived at under the DDM, the free cash flow, residual income, and market-based valuation, will be able to be guided, or will be able to guide an analyst when they're looking at the long run. We are saying under technical analysis, this is an analysis that technicians use to try and make some inferences when buying securities in the short run there. So this is using the graphs, charts, and also market indicators, as well as mathematical indicators to try and predict market movements in the short run there. So it is an important concept that we need to understand, that in the short run, the increase and decreases in demand for assets in the market will cause prices and output to also decrease. As well, for the long run, we'll have a mirror effect as over here, but it will tend to stabilize to the long run average prices there. Remember one thing: marginal revenue should be equals to marginal cost. So that important concept would mean that if the cost of offering securities in the market should be able to be at least as much as, rather, the revenue that is to be earned in the securities market should be almost as equal, or should be able to compensate for the cost of entering the market at any given point in time. So that concept is very important in economics as well as in equity investment analysis. Now, having looked at the justification for the short-term and long-run equilibrium right over here, now we move on and look at the Greenwald-Kroner model that is used to estimate the required return within the market there. So the Greenwald-Kroner model, we say it is a model that is used in the securities market, the securities market. You can see the securities market. To compute the required return, forecasted return, which is what you're saying is the forecasted return there. The formula is simple. We have R is given as D over P, which you're saying that is a dividend yield, D over P plus inflation. Then we add the growth, long-term growth rate component there, which will be given in the question there. And then we minus the supply, the S, or change in supply of the asset, change in supply. Then we add the component of the change in price to earnings ratio there, where R is required return there. D over P, we are saying, is the dividend yield there. I is the inflation component, or changes in the purchasing power of goods and services, inflation. Then G is the growth rate, long-term growth rate. Like that. Once we have the growth rate there, we also have changes in supply of the asset. Change in S is change in supply of the asset, or security in this case, like that. Then we have finally the change in PE. Change in P stroke E is change in the price to earnings, change in price to earnings ratio. There. That is, in simple terms, the Greenwald-Kroner model, where we try and predict or we try and factor in the inflation, the growth rate in the long-term growth rate, the changes in supply of the asset, and also the change in the price to earnings ratio. Remember, we had looked in market-based valuation. We had mentioned the PE as the market price per share divided by the earnings per share. That's how we compute the PE ratio there. Now, we move on and look at the Cobb-Douglas economic function. Why these models are useful under equity market equilibrium is because when trying to predict the point where we have the supply of securities or the asset versus the demand, we need to understand these estimates or the estimates of required returns so that we can correctly predict the equilibrium price of the asset or the security there. Now we move on and look at the Cobb-Douglas economic function. Cobb-Douglas economic function. Cobb-Douglas. Cobb-Douglas, we're seeing economic function. There. Now, what we need to do is that we just need to know how the formula looks like in trying to estimate the economic output of securities, or the general economic output, which is based on total factor productivity and labor inputs there. So we write the equation over here and say that the Cobb-Douglas economic function, before we write the equation, we mention something brief about the Cobb-Douglas economic function. This function is used to estimate the output which are factors, which includes factors of production, which includes factors of production, including, we can say, the total factor productivity, total factor productivity there, which also includes the amount of labor, the cost, the amount of labor. Just pause. Cut. 3, 2, 1, action. So we are saying, once we look at the total factor productivity, the labor, we also look at the capital stock. Capital stock there. So how to measure real economic output, we can't be able to write the equation. The equation is given as follows, where we have y is given as AK. I'll be able to explain all of those inputs over there. Then we have power alpha. Then, of course, this is multiplication there. And then we have the value of L, the labor component, which is given by beta here. Now, this the Y, rather we start with Y, is real output there. Then A, we can say that A is the total factor productivity. Total factor productivity there. And then K, we were saying, is the capital stock. And then we say that L is the labor output. This alpha represents a constant there. So this is a constant, and also that is a constant. These are constants, and also beta is also constant, like that. So those are constants there that relate. This is a constant. Alpha is a constant that relates to capital stock. Then beta is a constant that relates to labor there. So you should be given something that is very specific. This constant relates to the capital stock, and the other one relates to the labor productivity. Now, building on this Cobb-Douglas equation, we will assume that that we will be able to now get the change in y, or we put natural logarithms on this, so that we can be able to try and remodel this Cobb-Douglas equation to become something that analysts can be able to use in the financial services industry to try and predict output, the real output there. So we're saying applying natural logs, we have, so we apply natural logs and we divide each component. So we have change in y over y there, which is given as change in a over a there. Remember, we're applying natural logs, so this one comes down there. So we'll have plus alpha change in k over k, plus we will be able to now be given this constant over here. Now this constant can be expressed in terms of the alpha there. So we're saying where beta can be equal to 1 minus alpha, like that. So that is a very critical assumption that we need to make in the Cobb-Douglas equation. So we are saying that now bringing this component down, we are saying 1 minus alpha. I've already explained that beta will be 1 minus alpha there, and then we multiply by change in labor over the labor output component there. So this is what we're saying is the remodeled Cobb-Douglas equation there. What we can do is that summary, we can be able to say that the Cobb-Douglas equation is given as change in y is equals to change in a plus alpha change in k over k, rather not over k, change in k plus 1 minus alpha change in L, right there. So that is how we are saying it should be the Cobb-Douglas equation. So we try to look at an example that can be able to apply this concept of the Cobb-Douglas equation. The example reads as follows. When performing an analysis of 3 economies, an analyst compiled the growth and elasticity data in the following table. So we have country A, B, C, the percentage growth in total factor productivity 1, 2, and 3, the percentage growth in capital stock, that is the K component, is 2, 2.5, and 8. We have the growth in labor input 1, 4.5, and 2.5. Output elasticity of capital. That output elasticity of capital we are saying is the component of alpha. We have 0.5, 0.3, and 0.7. Required for each economy, determine the expected 10-year average annual GDP growth rate there. And number 2, comment on the 3 economies there. So when you're told to compute the expected or the forecasted GDP growth rate there, then we'll be able to apply the Cobb-Douglas equation. Over here we say solution. There we say based on the inputs, we are trying to estimate change in y. So the change in y in the first case, we can have a summary here. Scenario 1, like that. So we say change in y is given as, now we have the A component. We said A is the total factor productivity over there. So we have 1, which has been given to us. You can be able to see correspondingly there country A there. So we are working with country A there. So we have 1 plus, we say we've already been given the output elasticity as 0.5, so we need to put 0.5 as that alpha component multiplied by the cost, the capital stock, the capital stock which we've been given as 2 there. Then plus, now we have 1 minus alpha there given to us. So 1 minus 0.5, which you're saying is 0.5, and then we multiply by the labor component there. The labor component which you've been given there is 1. So that is the first case. That in the second case, we can be able to first of all combine them, then we'll be able to work them out. Change in y, in the second case, we have 2 given to us plus 0.5 multiplied, rather is it 0.5? I can see it's 0.3, pardon me, 0.3, 0.3, which you're saying is the component of alpha multiplied by 2.5 plus, now we have 0.7, 1 minus 0.3, which you're saying is 0.7 multiplied by how much? You can see 4.5 there. How much do we get? Then number 3, we have change in y given as, we've been given the A component, which you're saying is total factor productivity as 3 plus, I can see 0.7 multiplied by 8 is what you're saying is the growth in capital stock there, plus 1 minus 0.7 there times, we're saying we have how much? 2.5. 2.5. How much do we get in the 3 cases? Very quickly we compute. So we first of all work in brackets over here like that. So we have 0.5 times 2, of course that is 1. So we have here 1 plus 1 plus 0.5 multiplied by 1, which you're saying is 0.5. 0.5. So here we have 2.5. And of course it's percentage. Yes, so that's 2.5% in the first case there. In the second case we have 0.3 multiplied by 2.5. We have 0.75. It's 2 plus 0.75 plus we have 0.7 multiplied by 4.5. We have 3.15. So how much do we get? 3.15 plus 0.75 plus 2. We have 5.9%. So these are the figures that we will be trying to evaluate based on the economies, the nature of the economies based on these inputs, the capital stock, total factor productivity, and the labor output. And we'll be able to make a decision in part 2. Now here we have 0.7 multiplied by 8, we have 5.6. So it's 3 plus 5.6 plus we have 0.3 multiplied by 2.5. We have 0.75. How much do we get? We add 5.6 plus 3. We have 9.35%. 9.35%. So those outputs or those growth rates are the ones which we'll be able to try and describe under part 2. So that is part 1. We've been able to compute the output there. Part 2 is asking comment on the 3 economies. So we're saying that economy A would appear to be a market close to equilibrium. Why? We are saying because the expected annual rate of growth is only going to be about 1%. We've already been given that 1% right over here. So we are saying that that is large developed economy. So that is what an analyst should be able to infer based on the input given there. So you're seeing the total factor productivity as being 1%. You can see the growth in capital stock is almost close to the total factor productivity of 1 as well. We're seeing the growth rate in labor is growing at 1%. We're saying that this one in conclusion would be a large developed economy there, which is close to equilibrium there. In the second case, we are seeing that the workforce growth rate is at 4.5%. That is the growth rate in the labor input given to us there. However, we can see that has an impressive workforce which contributes towards the economy. They significantly contribute towards the economic development, and hence we are saying that this could be a relatively small economy such as Kenya's, where you're seeing a lot of the labor contributes towards economic growth there. You can see even the 5.9% is almost close to what we are seeing our economy is actually growing by, about 5-6% there. Or 6.5% is almost close to this one here. So we are saying that that is a relatively small economy that is driven by workforce. In the third case over here, we are saying the capital stock is expected to increase significantly over the next 10 years, because we are basing our estimates here on 10 years. And we are also saying that the increased economic output, why we are saying the increased economic output is of this component of 0.7. The economic output over here would mean that the economy is larger and more developed, and it is growing at a very fast rate. We are saying the economies such as of Malaysia and Indonesia could be at this level. Over here we are saying is moving at 9.35% there. That is what we can be able to infer based on those computations right there. Now, having looked at the Cobb-Douglas economic function, we can be able to conclude around that point, and we will be able to continue in our next lesson by looking at the macroeconomic forecasts based on the H model and looking at the relative equity market valuation model, where we look at the Fed model, which is used in the US, the Yardeni model, and also the 10-year moving average price. We will be able to conclude our next lesson by looking at the asset-based approaches to equity market equilibrium, where we will be able to look at the Tobin's Q. Thank you for joining me. We hope that you will be able to join us in our next lesson.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Mboya Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Gwiri. I'll be taking you through equity investment analysis, and we are looking at equity market equilibrium. In this second lecture, what we will be able to look at under equity market equilibrium includes the following. I'll be able to first of all try and highlight what we had looked at in the first lesson. We had looked at justification for short-term and long-term equilibrium. Then we went ahead and looked at the Greenwald-Kroner model. Greenwald-Kroner model. We went ahead and looked at the Cobb-Douglas equation, Cobb-Douglas equation, which tries to measure the long-term growth rate in output. And what we will now look at in today's lesson, so these ones were actually covered, that was covered, that and that was covered. Now we will be able to look at the macroeconomic forecasts, macroeconomic forecasts, and we will be able to look at the H model and the H model there. Then we will move ahead and look at something else, including the relative equity market valuation. So relative equity market valuation approaches. And what we'll specifically look at, we will be looking at the Fed model. So we'll look at the Fed model. Then we will also move ahead and look at the Yardeni model. And then finally we will look at the 10-month or the 10 month moving average. So the 10 month moving average, or 10 year rather, it should be 10 year, not the 10 month. 10 month moving average, 10 month moving average computation, or we will be able to just try and provide some summary on this 10-month moving average. Then we'll also move ahead and look at the asset-based approaches. Now the asset model includes Tobin's Q. Asset model, 2 valuation of equity market valuation. Asset model, and we'll look at now the Tobin's Q. Tobin's Q. Now, to start off, we will look at macroeconomic forecast and the H model. Macroeconomic forecasts and the H model. The H model. If you recall, under dividend discount model or discounted dividend model, what we had looked at, we had said that the H model, to determine the price of the intrinsic value of a security, is given as the D naught 1 plus G over R minus GL. This is growth rate in the long term there. Then we add now the D naught, which is the historical dividends, and we multiply that by the half-life in years of the duration within which the security prices or the dividends are expected to decline linearly, and then we multiply by G, the growth rate in the short term, the difference between the growth rate in the short term minus growth rate in the long term, right there. So we are saying the mechanics or the explanation for the H model is that if these are dividends and this is time like that, under the H model, the dividends are expected to decline linearly like so, and then it stops there, and now it now declines or stays stable like that in the long run here. So here we have the stage 1 and here we have stage 2. This is a much more realistic approach to trying to estimate the intrinsic value of a security. Why? Because dividends can be able to decline, or at times they actually decline linearly like that. Under the 2-stage model we had mentioned, we have this approach over here. You have dividend growth rate like that. In the 2-stage, and the dividends are at that level over there, then they just decline suddenly to a stable stage like that. So this is stage 1 and stage 2. This is not realistic. This is of course an explanation in theory. It's not, doesn't happen like that in practice. But here we expect at least this case and the dividends to start declining like that slowly, or what we can say linearly to a stable stage like that in perpetuity like that. So this is what we will be able to build on the H model. Now to apply the H model in macroeconomic forecasts, the formula is as so. You can be able to see the similarities between these. Let me leave that over here. So we are saying the macroeconomic model under the H model will be P naught, will be given as a D naught over R minus GL, that is the growth rate in the long term there. Then we have here 1 minus the growth rate in the long term like that, plus now the half-life in years, which you're saying is N over 2. For consistency purposes, let's explain it in terms of the H part. So it's H over 2 like that. Then the difference between the growth rate in the short term minus growth rate in the long term like that. That is how you compute the price of the equity index, or the changes in the equity index based on the H model. So this D naught we say is dividend, the current dividends there. R is the required return there. GL is long term growth rate like that. Then what we haven't described here is H is the half-life in years, half-life in years like that. Then GS is the growth rate in the short term growth rate. That. P naught is the expected price of the index. So we can be able to now infer something from this macroeconomic focus and the H model. Let's try an example that can be able to reinforce our understanding. So we have an example that reads as follows. Assume that we have the required real return on equity being 10%, a current dividend of 12, the current supernormal growth rate of 10.5%, a long-term sustainable growth rate of 3%, and a 30-year period of linear growth decline is expected to decline. The estimated intrinsic value for the index will be how much? Assuming that the price to earnings ratio is 20.3, what will be the justified PE ratio? So we're saying we try and put the inputs, we try and identify the inputs, we're trying to estimate the P naught there. So we're saying we have D naught, so solution. Here we have D naught over R minus GL. Then we multiply that by 1 plus GL, 1 plus GL right there. Apologies, I must have made a mistake over here. This should be plus. Please change that to plus. Yes, that is 1 plus GL right there. Then plus the half-life in here is H over 2. Then we have GS minus GL right there. So D naught, how much have we been given as the dividends? The dividends, we've been told that the current dividends is 12. So it's 12 divided by the required return. The required return, which we've been told as the real return on equity, is 10%. So 0.1 minus the growth rate in the long term. We have been told that the sustainable growth rate is 3%, 0.03. Then 1 plus the growth rate in the long term, we have it over here, 0.03, plus the half-life in years. We are being told it is a 30-year period, so we just take 30 over 2. Then we take the growth rate in the short term minus the growth rate in the long term. The growth rate, we've been told the current supernormal growth rate is 10.5%, so 0.105 minus 0.03. So how much do we get as our P naught? Very quickly, work it out. So we work the brackets first, and we have, let's work this component first right over here. So we have 30 divided by 2, we have 15, and then we multiply by the difference between 0.105 minus 0.03. We have 1.125. Then we add this part over here like that, 1 plus 1.03. So we add plus 1.03 there, we get 2.155. So we have 12 over 0.1 minus 0.03 multiplied by 2.155 there. So we divide that, then multiply the two components there. So 12 divided by 0.1 minus 0.03, we have 171.428. So we have 171.428 multiplied by 2.155. We have multiplied by 2.155. There we have 369.4. 369.43. Like that. That is the new value of the index there. Now we have also been requested to compute the PE ratio there. Now this being the price, the P stroke E ratio of the index will be the market price per share divided by the earnings value they are given to us. So we are saying that it's 369.43 divided by the earnings, and the earnings we have been given there as how much? 20.3. From the question we've been given 20.3 there. So how much is our PE value? Divided by 20.3, we have 18.189. So 18.198 times, because it is a multiple, we must put times there. Now, having looked at the macroeconomic focus and the H model, we move on and look at the relative equity market valuation approaches right here. So we will look at the Fed model, the Yardeni model, and the 10-month moving average there before we conclude by looking at the Tobin's Q. So we can move on right here. And we look at the relative equity market valuation. Approaches. Equity market valuation approaches. The first one, we will begin with the Fed model. Here. Now, the Fed model is a model that is used by the US Treasury, where they are able to try and predict the valuation or the estimate of the equity market movements. So we are saying the Fed model is given as the following. So we are saying the Fed model ratio is given as the S&P or the Standard & Poor's earnings yield there divided by the 10-year yield, Treasury yield. There. That is how you can be able to get the Fed model ratio, and this Fed model ratio tries to predict the equity market value or the value at any given point in time. Now, moving on, we look at the Yardeni model. There. Now, Yardeni model incorporates a component of risk in the model, but it's still based on the earnings yield as specified by the Fed ratio there. So we're saying the earnings yield E1 over price naught is given as YB minus D represents a weighting factor, and here you have long-term earnings growth component there, where E1 over P naught is the earnings yield there. Then we have now the YB is the corporate bond or the rating of the corporate bond, or the A-rated corporate bond yield there. D represents a weighting factor, usually around 0.10. You must be given that there, or you need to estimate the weighting factor when trying to estimate the earnings yield. And then we move ahead and look at the L tag. There we are saying is the long-term earnings growth. There, the long-term earnings growth there. Let's look at a model, an example that can be able to try and estimate the earnings yield, or we can be able to also estimate the price component there. Assume the long-term 5-year growth forecast is 9.85% and D is 0.1. If A-rated corporate bond yields 6%, determine the fair earnings yield. Part 2 is asking if the current earnings yield implied by the equity index and projected forward earnings is 5.5, determine whether equities are over or undervalued. Part 3 is asking, using the Yardeni model, calculate the fair value of the market PE ratio. So using the model, the Yardeni model, so we say solution. there. Using the Yardeni model, we have it right over here. We have E1 over P naught YB minus D L tag there. So the YB, what is the yield that is yielded, that is being provided by the corporate bond? We're seeing is 6%, so it's 0.06 minus the D component, which we're saying the D represents the weighting factor. We've already explained it over here. We've been given 0.10 like that, and the long-term earnings growth rate we have been given as 9.5%, 0.0985, yes, like that. So how much is the earnings yield? So we're saying is 0.1 multiplied by 0.0985, there is 0.00985. So we get 0.06 minus the answer. We have 0.050, or we are saying it is 5.015%, like that. That is the long-term earnings yield. That is part one. Part two of the question is asking if the current earnings yield implied by the equity index and projected forward earnings is 5.5%, determine whether the equities are over or under valued. So we are saying that the rule of the thumb in equity investment analysis, if the current market price is greater than the intrinsic value is what you believe the value of the equity index should be, then you are saying it is overvalued there. But if it is the contrary, if the current market price is less than the intrinsic value, undervalued, like that. So in this case, we are comparing the 5.5%, 5.015, which we are saying is 5%, and the 5% or 5.5%, which have actually been given there. So we are comparing this with the 5.5%. So we are saying that the 5.5%, the current market earnings is 5.5%, and this would imply that the Yardeni model, based on the Yardeni model, it is undervalued. So what happens is that we are saying that the intrinsic value is 5.5% there, and this one, the current market price, is 5.015. You can see the current market price is less than the intrinsic value, and hence it is undervalued there. Part 3 was asking, using the Yardeni model, calculate the fair value of the market PE ratio. Remember what you're saying, the PE ratio is the market price per share divided by the earnings per share. So what we just need to do is that we just get the inverse of this value. Let me explain it like so. So we're saying here we have part 3. We have E1 over P naught. Now the inverse of this, we are saying, will be the P naught over E1. That is the PE ratio. So from your calculator, you can just get the inverse value of 5.015, or we are saying you can get 1 over 0.05015. We'll be able to get the P stroke E value. In this case, how much is that? So 1 divided by, so we are saying we get 19.94. 19.94 times. That is the PE ratio there. Having looked at the Yardeni model, done the Fed model, the Yardeni model, and the 10-month moving average, what we just need to understand under the 10-month moving average is that it is not usually used, because the 10-month moving average requires an individual to just get. So we're saying we get the 10-month moving average. What we need to do is that we get the earnings for the 10 months. So January, February, March, April, May, June, July, August, September, and October there. So we're saying this represents 10 months. So we get the earnings yield for this period over here, and we compare them with the previous 10 period moving average there, and with that will be the estimate of the market. Is it going to be a positive increase in the value, or is it going to provide a negative value? Now you're comparing this for the current period versus the previous 10-month period and trying to determine whether it has actually increased or decreased. That is what you're saying is the 10-month moving average in trying to estimate the equity market or determine the equity market evaluation for the market there. Now moving on, we will now need to look at the asset model. In this case, the asset model is based under the Tobin's Q here. So we say the asset model there. This model is based on the computation of Tobin's Q. Now, what we need to understand under the Tobin's Q is that it is the difference, rather, it is dividing the asset market value with the assets replacement costs. So, assets market value divided by the assets replacement cost. That is how we get the Tobin's Q there. And now breaking it further, we need to get the market value of debt plus the market value of equity. Then we divide by the assets replacement cost, so that we can be able to determine the value of the index or the value of the equity market there. So we can be able to break it further here. You say Q is equals to market value of debt plus market value of equity divided by the assets replacement cost. Assets replacement cost there. Having looked at all of these components, this brings us to the end of equity market equilibrium. We hope that you have enjoyed this lecture, and thank you. God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tomboya Street, Pioneer House, 3rd floor, opposite Fire Station.
Hello learner, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri. I'll be taking you through equity investment analysis, and we are looking at technical analysis. In lesson 1 and lesson 2, we had looked at the mechanics that drive the technical analysis and also looked at the door theory, including the postulates of technical analysis. In lesson 3, we will specifically be looking at the following. Analysis. There. We will be looking at the moving averages. So under the moving averages, we are looking at the mathematical indicators. These mathematical indicators are what technicians use to try and infer an uptrend or a bullish market or a bearish market. We had already explained that in our previous lessons. Now, under mathematical indicators, we will specifically be looking at moving averages. That's the first kind of mathematical indicator. Specifically, we'll be looking at the simple moving average. There. And then we will move ahead and look at the exponential moving average. Exponential moving average. There. Once we've looked at those two moving averages, we will be able to now look at the oscillators. oscillators, and specifically now we'll be looking at the rate of change. Yes, we'll be looking at the rate of change, like that. Once we've looked at the rate of change, we will now also move ahead and look at the relative strength index. Strength index there. And then finally, we will be looking at the moving average convergence divergence. Moving average convergence divergence. There. What technicians call MACD. MACD. Moving average convergence divergence there. Now, having looked at the mathematical indicators, we will look at the market indicators there. So we look at market indicators there. Now, under the market indicators, we will be looking at the breadth of the market, Then we'll move ahead and look at something else that talks about new highs and new lows. New highs and new lows. There. New highs and new lows. These are indicators that technicians use to try and predict the strength of the market or the strength of a particular trend. Now we will also move ahead and look at short selling there, and we will conclude this topic by looking at the odd lot trading. Odd lot trading, like that. Now these indicators right over here are important for technicians, because these are the ones that guide them to infer or make very critical decisions as to whether to buy a security or actually sell a security. So moving on, we will now start off at the mathematical indicators. Mathematical indicators. Yeah. Now the mathematical indicators, as described over here, and we will first of all begin with moving averages. Now under moving averages, there is the simple moving average there, a simple moving average, where we are saying is a description of where you will be able to have, if you have the period given to us there, and then we have the price of the security over here, and we're saying that the period 1, 2, 3, 4, 5, 6, 7, let's go up to 10, 9, 10, like that. The prices here you have 20, 23, 25. These are just hypothetical examples. 24, 28, 26, 25, 23, 20, and 21, like that. For you to conduct a simple moving average, say for example a 5-period or a 3-period moving average, what will happen is that you will be able to take any 3, like that. You get you sum them up, and you get the average of those prices, and you plot them and you put them right over here. So you say, in this example, you say 3-day moving, 3-day moving average, 3-day moving average, like that. Now the 3-day moving average, what we're saying is that you'll add these 3 here. So let me pick my calculator right over here, and we say that now in this case we'll have 20 plus 23 plus 25, like that, equals, you divide by 3, because you're looking for the 3-day moving average. You have 22.67. 22.67. Notice where I'm putting the 22.67. It's at the midpoint right there. So the next figure, we get 23. We'll get now these 3 right there. So we have 23 plus 25 plus 24. Divide by 3, we have 24. Like that. Now these 3 again, we continue like that. 25, 24, and 28. 25 plus 24 plus 28. We have 77 divided by 3. We have 25.6. 25.6. Notice what we are doing. We are conducting a 3-day moving average for each 3-day period, so that now when we are plotting now the price over here, the price against time, like that, what happens is that we will be able to now plot, first of all we'll plot the period against the price there. So probably you'll be able to have something like that. Just for example, that's what you're having. And then this 3-day moving average is what is going to reinforce the investor or the analyst in terms of whether there's going to be an uptrend or a downtrend. That is the way it is going to appear, like that. So it will have to start from some point in the middle over here. It will not start from the grid like that, from the x-axis, rather from the y-axis over here. It's just going to begin from the center and trying to be indicative of a trend, either up or down, like that. That is what a simple moving average is. So now we can be able to put it in writing and say is that it represents an average of the security prices over time, and is useful to analysts and investors who would be able to infer a trend. Brackets you can put bullish, bearish, or no trend. So once we have that now, we are saying that this can be able to assist technicians as well as investors to try and infer either bullish, bearish, or no trend. Now this is very useful, especially when you want to determine the strength of a trend. This case you are not, you cannot be able to infer anything because this represents the congestion area where you're saying it's actually oscillating, moving up and down like that. So you can't be able to infer anything from that. Yeah. Now, having looked at the simple moving average, let's look at the exponential moving average right here. So we are right here, exponential moving average, exponential moving average, exponential moving average. Now, under the exponential moving average, you will be able to have to apply a formula that can be able to assist us to compute or get an indication of whether the strength of the market is actually moving up or moving down. Now, what we need to do is that we need to determine the following. We need to first of all get the formula for computing the exponential moving average, and the formula is as follows. We are saying the EMA, which you can be able to say is exponential moving average, right there, right there, is given as, and the first value we need to identify is we need to look at the previous EMA, exponential moving average. Previous, I will be able to explain exponential moving average, like that. Once we identified that, then we move ahead and we add the closing price. We add the difference between the closing price and the previous exponential moving average. So we add the difference between the closing price minus previous exponential moving average, and then you multiply by a constant there, which you're saying is f there. Now f is given as, so f is given as 2 over n plus 1, like that, where we are saying n represents the moving average that we're actually looking at. We've already explained the simple moving average. We said we use the 3-day moving average, so we can be able to have some hypothetical data over here so that we can be able to demonstrate how to compute the exponential moving average. So we are saying we've got period 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10, like that. We have the price, like that, 20, 22, 23, 25, 22, 26, 29, 20, 22, and 21, like that. That is just a hypothetical example. Now, in this case, to compute the exponential moving average for the first period, what we need to note is that for the first period, we will assume the price to remain the same over here as 20, like that. Now, once we have that, for every first period when computing the EMA, we will always assume that. Now, coming back to the formula, when come to the second period over here, we are saying we have the previous EMA, which we are saying the EMA previously. We're in this period right over here, period 2. The previous EMA is 20, right over here. If you'll allow me, you can use the formula, compute the formula right over here, or rather down over here. We can say the EMA is given as, now we are coming here, the previous EMA we've been given as 20, plus, now, the difference between the closing price right there, the closing price right now is 22 minus the previous EMA. The previous EMA is 20, like that, and then this component f, or the factor, the constant f is considered. We are saying we are going to try and consider a 3-day moving average. So we are saying it's 2 divided by 3 plus 1. So we are saying it is 2 divided by 4, which we are saying is, this is 1, this is 2, which is 0.5, like that. So that is how we compute the f over here. So the f we can say is 0.5. So to compute the EMA, the current EMA for today, how much do we get? Okay, we have 22 minus 20. We have is 20 multiplied by 0.5. We have 11, then plus 20, like that. Plus 20, and we have 31. Let me confirm that again. It's 22 minus 20, and we have 2, times 0.5, and we have 1, and then plus 20. Plus 20. That's why it's always important to always confirm. This gives me 21. Like that. Assuming now we continue like that, that's for the second period. For the first period, we have is 20. For the second period, we have as 21. For the third period, how much do we have? We are saying we'll have the previous EMA. The previous EMA is 21, plus the closing price is 23, minus the previous EMA. The previous EMA is 21, multiplied by 0.5. Notice the 0.5 will be constant because you're saying is 2 over 4, which you're saying is 0.5 there. So how much do we get? We say we have 23 minus 21, like that, and then we multiply by 0.5, then we add 21. We get 22. And so on and so forth. That is how you get the exponential moving average. So in trying to plot the price against the price against the period over there, like that, and you're saying over here you have something like the price here against time, which you're saying is the same as the period. You will be able to plot this against the price, which will move like something like that, for example, and then we're saying the EMA will start from somewhere over here and move like that. That is a mathematical indicator that is used as well by technicians. Now, having looked at that, that's this brief description. That is how we are expected to compute the exponential moving average there. I don't need to put any description. It is pretty direct. You just need to understand the formula, the previous EMA plus the closing price, and the difference between the closing price and the previous EMA multiplied by a constant, which you're saying is F, and N represents the number of moving averages there provided there. Now those are the two. This is B right there. A is simple moving average, B is exponential moving average. Now we move on and look at the oscillators right over here. Now under the oscillators, you're trying to see whether how erratic a given market is. So we can say provide an indication of how erratic the market is provide an indication on how erratic the market is based on some computations, including the first one which you're saying over there is the rate of change. Number one, rate of change there. Now, looking at the rate of change as a way of trying to provide an indication of how erratic the market is, we are saying it is given simply by, this you can say is ROC, is given by, ROC is given as the current price divided by the price prevailing in period N plus 1. Price prevailing N periods ago multiplied by 100, like that. That is why we can be able to compute the rate of change. So you need to have the current price given to us over here, the price prevailing, say maybe 1 year ago, like that. You divide by that and multiply by 100, you see the rate of change. Has it increased or has it decreased there? That provides an indication of the oscillation within the market there. Having looked at the rate of change, we now look at the second one, number 2, and based on our summary here, having looked at the oscillators, we've looked at the rate of change there, the relative strength index, Now, the relative strength index needs us to compute the relative strength of the market. And how do we compute the relative strength? We are saying, first of all, RSI, or the relative strength index, is given as 100, like that. Then we minus 100 divided by 1 plus the relative strength. Yes, the relative strength, like that. So this is minus there. So this is 1 minus. The RSI is 100 minus 100 over 1 plus the relative strength gives us the relative strength index. Now, how do we compute the relative strength? The relative strength is the average gains. RS is given as average gain per day divided by average loss per day. That's how we compute like that. So if we have a listing, if you'll allow me to just try and put something over here, you have period 1, 2, 3, 4, 5, 6, like that, and you have them on day 1, maybe there's a gain of 5, a gain of 6, a gain of 2, and like that. Then on period 4, from period 4 to period 6, you had losses. So we're saying the losses include maybe say loss of 3, loss of 2, and loss of 2 there. So what we're saying is that you first of all compute the relative strength, like that, the average gains over the average losses. So how much are the total gains? This is 5 plus 6 is 11. This is 13. That is in terms of gains. 5 plus 6 plus 2, like that. And then here we are saying you get the average losses. So it's 3 this is 5, this is 7, like that. So it's average gain over average losses. So in this case, the average, so we're saying is 13 divided by 3 and 7 divided by 3, and we divide those two, we get the relative strength. Once we have the relative strength, we come and plug that inside this formula over here. That will be able to help us and provide an indication of the oscillation within the market. So we get 100 minus 100 over 1 plus the relative strength. So let's just do it over here so that we can be able to understand how we compute the relative strength index. So we are saying the average gain, we have 13 divided by 3 right there. I have the calculator right here with me. 13 divided by 3, you get 4.33. So it's 4.33, which is the average gains divided by the average losses. So we have 7 divided by 3, like that is 2.33. 2.33. So how much do we get? 4.33 divided by 2.33, and we have 1.86. 1.86. Now that is the relative strength, and we come and plug that in there like as I was saying. So RSI is given as 100 minus 100 over 1 plus relative strength. 1 plus the relative strength is 1.86 there. Remember the law of Bodmer's? That brackets should begin first. So we're saying we have 100 divided by, open the brackets, 1 plus 1.86. 86, close the brackets, equals, we get 34.96. So 100 minus 34.96, which we're saying is how much? 65.03. That is the relative strength. We are saying that the market is fairly strong, because you're saying the 50-point mark. 50-point mark is where now it's the middle ground between whether the market is actually weak, and on this other side is where the market is actually strong. So you can see 65 has actually passed the 50-point mark, and that's indicative that the strength of the market is fairly strong there, like that. So having looked at the relative strength index, we can move on and look at the moving average convergence divergence, Mark D, which you're saying is a very important oscillator for technicians. Moving average convergence divergence, into brackets Mark D. There. So the moving average convergence divergence is a pretty simple concept, because it tries to indicate the strength of the market. And how do we compute the moving average convergence divergence? We are saying we just need to understand the strength of this indicator by looking at the strength or the premise behind the oscillators. We are saying the premise behind the oscillator provide an indication of how erratic the market is based on some computations, including those ones there. So we're looking at short-term exponential moving average, and that the difference between the short-term exponential moving average and the long-term exponential moving average gives us the moving average convergence divergence. So we're saying short-term, put it like so, short-term exponential moving average, or we can say, yeah, exponential moving average, like that, minus the long-term exponential moving average gives us the moving average convergence divergence, or what we're seeing the Mark D there. Once we look at that, then we're seeing that will be an indication of the market oscillator, or the market, how erratic the market is there. Now, once we've looked at the oscillators, the mathematical indicators, now we move on and look at another concept that deals with the market indicators. This was the mathematical indicators. Please note, this is mathematical indicators. All these, we're talking about moving averages. And then now we're looking at the oscillators there. Mathematical indicators, now we're looking at the market indicators. The market includes either the fixed income market or even the equities market there. So we'll move on this side. Now, market indicators. The first one that we will be able to look at is the breadth of the market. The market. Now, the breadth of the market means what? It means that we are trying to look at how the market is, or the composition of the market. And it's a very simple concept where we are saying the information ratio is given as the information coefficient times the breadth of the market. That is the simple relationship that you need to understand as an equity expert. Where we're saying IR is the information ratio, that is the information about the market, and which is comprises of the information coefficient, there, and BR represents breadth of the market. Now, how do we get the breadth of the market? It is just the difference between the average gains divided by the average losses in a given day. That is how we can be able to get the breadth of the market. We are also saying that the breadth of the market can also be gotten by the number of securities within the exchange. So we are saying the breadth of the market represents the number of securities traded in a securities exchange. Number of securities traded in a securities exchange. That is the breadth of the market. The information coefficient is the represents the skill of the manager, represents the skill of the manager in trying to predict the market up or down. That is the information coefficient. The information ratio is the ratio that relates to the information about the market, or you get an inference about the market there. So we can say information ratio, you can say information ratio provides an indication to technical analysts, to technicians about the factors that contribute to the factors that contribute to the return of a market. Return of a market. There. So we are saying the information ratio is linked with the information coefficient and the square root of the breadth of the market. The breadth of the market represents the number of securities. The information coefficient represents the number of skills, or the skill, how skillful the manager is in trying to predict either uptrends or downtrends. So the information ratio is also given as active return over active risk. There. This is the return beyond the benchmark, which you can be able to run RP minus RB. This is the return of the portfolio. This is the return of the benchmark. Then we divide that against the active risk, which you are saying is the standard deviation of returns between the portfolio and the benchmark there. The difference in the risk between the portfolio and the benchmark. That's how we also get the information ratio coefficient. Now, having looked at the breadth of the market, let's look at new highs and new lows. Look at the breadth of the market, we look at new highs and new lows. And new lows. Every time a technician tries to perform a trade within the market, what you need to understand is that the market will provide new highs and new lows every time, or every say 5 or so days, like that, because of what you're saying, the end of week effect, end of month effect. Those are calendar anomalies that affect securities exchanges all over the world. So this concept of the new highs and new lows is a pretty old concept, but it has an impact on trying to predict the market as whether it's going to move in an uptrend or whether the market is going to move in a downtrend here. So we say the new highs and lows is important in the prediction of market movements up or down, and we can say represents an indication, an indication of potential strengths in trend movement, indication of potential strengths in trend movement for, we can say, for technicians. There. That is what we say about the new highs and the new lows. So if you keep on finding a securities market, if you can be able to probably use this other side to try and demonstrate or expound on that, what we can say is that if we have every time this is the price and this is time, and we find every time you find a new high every day like that, you find every time you're moving like that you find a new high like that, it means that that is indicative of an uptrend like that. So this is a bullish market. So you find new highs every single day like that for, say, consistently for the past 1 month. That should indicate a bullish trend. However, if you have the contrary view or contrary opinion, where you have new lows every time that you are trying to identify the market trend like that, that indicates a bearish trend. That's why new highs and new lows is important for technicians to try and determine the nature of a given trend there. Now, having looked at new highs and new lows, let's look at short selling. Short selling there. Short selling is a concept that is pretty new in our market here in Kenya, because we are saying that the short selling regulations are being introduced by the Capital Markets Authority, where securities can be sold short. How does that happen? This is the exchange there. This is your firm. It is a dealer with the exchange, like that. And these represent investors right here, both institutional investors and individual investors there. This firm can say, probably maybe we have another firm right over here like that, and this is the broker. Apologies. Broker. So this is your firm right here. You go to a broker, you tell them, okay, that you need some to buy 1 million shares of KQ, Kenya Airways. The broker comes and tells you that fine, we will be able to offer you the shares, but we need to have a contract written down, and you need to sign, and we also need to sign, so that the contract can become binding. So the broker goes to the exchange, buys the 1 million shares like that, and now the shares are now with the broker. The broker can now offer them. Remember, there has not been exchange of money here. So they offer the shares to the exchange, to this company over here like that, at how much? So we're saying it's 1 million shares at, say, maybe 4.5 shillings like that. That means that shares worth 4.5 million shillings have been transferred from the broker to this firm here. Once those shares are received by X, they now avail them to these investors at a premium. Probably it is 1 million shares, 1 million shares at maybe say 11.5, or let's say 10 shillings. Let's just, for convenience purposes, let's put a 10 shillings there. So we are saying that 10 million will move from these institutional investors or individual investors back to this firm. But remember, this firm right here had been provided or had borrowed shares from the broker over here like that. So now, since the proceeds are with firm X there, or this company here, what happens is that 10 million is with the firm, but what it did is that it borrowed from the broker, so it needs to pay up 4.5 million there. So now from the 10 million, it using this dotted line overhead, gives 4.5 million. That is the principal amount that had been provided by the broker. So 4.5 million, but there needs to be some form of interest that is paid from the proceeds there. So we can say plus an additional maybe 2 million. So we are saying this is the principal 4.5 plus the interest of 2 million. So now total comes to 6.5 million like that. Now the remainder of the balance, which you're saying is 3.5, remains with firm X there. So firm X has made a profit from the usage of shares, or from the transfer of shares from the broker, which it did not ordinarily have. Well, that is what you're saying is short selling. Selling securities that do not belong to you. So we can be able to put that explanation in writing here. It is the process of selling securities that do not belong to you. Put it like that in quotes. It is the process of selling securities of selling assets based on borrowed funds or assets. There. So I've already explained what short selling is. Now trying to link it with the market indicators, we may not be having these short selling regulations having been finalized, but what we need to understand is that those short selling regulations, if an increased case of short selling actually happens, then that indicates the vibrancy of the market. So we can say if short selling is rampant, then the market is said to be very vibrant and is in an upward spiral, that saying bullish trend there. That is what you're saying is short selling. But of course, the contrary is where we are seeing the bearish market will actually happen. Now, having looked at short selling, we move on and look at the odd lot trading. Odd lot trading. Every securities exchange has an odd lot segment where you have securities that are not in multiples of say 100. For example, if you want to buy, the securities market is providing that the bid price is 4.5 for KQ. This is the buying price for KQ. You must come in multiples of 100 shares. So that means you can, for the minimum you can be able to buy in the main market segment is 4.5 times 100. You must spend 4,500 so that you can be able to buy 100 shares like that, or 450 rather, like that. It's 450, sorry about that. So this times 100 is 450, like that. For companies say which have got maybe say like EABL or East Africa Breweries Limited, which are going for so to the tune of maybe 320 shillings, you must come with 32,000 so that you can be able to buy 100 shares there. There is another segment apart from this main market segment where you must buy in multiples of 100, which we're saying is the odd lot segment. The odd lot segment now is where the shares are traded in multiples less than 100. You can find 99 shares, 96 shares, 98 shares there, 93 shares, 53 shares, or even 5 shares are actually traded in that market. This is where investment banks and stock brokerage firms usually buy shares at a low price. The rule of the thumb is technicians need to buy shares at the lowest price possible and sell the shares at the highest price possible. So you are supposed to try and ask your broker, stock brokerage firm or investment bank, how much are the shares for Kenya Airways or for KQ going under the odd lot segment. Please don't go buying shares at the main market segment. Insist that you want to buy shares under the odd lot segment there. That is what stock brokerage firms and investment banks don't tell you. And it is unethical for the investment community to actually allow that to happen. What should happen is that I am telling you right now, you need to go and ask for the odd lot segment and buy shares right there. So odd lot trading is the process of buying and selling securities in the odd lot segment of an exchange. It is the process of buying and selling securities in the odd lot segment of securities exchange. That odd lot of segment of securities exchange, like that. Now that is what you're saying is the odd lot trading. You need to note and you need to underscore that or underline this statement, that under the odd lot segment you will be able to find a significant discount in the prices of securities. A significant discount of securities prices are provided for under the odd lot trading. This brings me to the end of this topic review, and before I end, I need to give you a series of questions that you should be able to try and look at. The first question was tested in November 2016, question 5B. It reads as follows: explain the term technical analysis as used in equity valuation. Number 2, discuss 3 principles underlying technical analysis. Now, there is also another set of questions which I'll give you, and these questions came in May 2016, question 4A. It reads as follows: examine 4 principles of Doe theory in relation to technical analysis. Number 2, explain the reasoning behind support level and resistance level in relation to technical analysis. And finally, part 3, the exhibit below relates to Fairmore Limited, a company quoted at the Securities Exchange with a 50-day moving average and relative strength compared to Standard & Poor's S&P Industrial with 50-day moving average for the year 2014 and 2015. So you have the graphs indicated there. Required: interpret the chart output lines labeled 1 to 4 in A3 above. Thank you for having me as your guide. We hope that you can be able to join us in our next lesson. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tomboya Street, Pioneer House, 3rd floor, opposite Fire Station.
Hi candidate, welcome to another session of Manifested Online Classes. So in this session, I want us we continue with the topic number 1, and specifically I want us we look on the subtopic of deferred tax. So this, first of all, is an extension of what you covered in financial reporting and analysis, intermediate level, where you did something to do with the accounting for current taxes and also accounting for deferred tax. So at the advanced level, you need only to cover the concept of deferred tax, but at the advanced level, also the examiner will test the concept of group account. For example, you need to know how to compute things like the unreleased profit and so on, because the examiner may give you some goods which were maybe sold by the parent company to the subsidiary, and you're told some of the goods were not yet sold at the end of the year. So basically, you have to be able to determine the cost of those particular goods, and for you to do that, you must be in a position to determine the unreleased profit. So therefore, at this level, you just need to cover the concept of deferred tax, but now with a group with a group aspect. Now, I want us to look on some few illustration questions, but before you do that, I want us to look on a quick recap of basically what you need to know as far as the deferred tax is concerned, so that we can be able, we can be on the same page. So first of all, a deferred tax, basically we say this is a provision created by the company during the current financial year for a tax which is supposed to be paid by the company in the future, or a tax which is supposed to be recovered by the company in the future. So equally, when computing for the deferred tax or determining the amount of deferred tax which is to be provided for in the income statement, we have 2 approaches which may be used by an entity. Number 1, we have the income statement approach, whereby the deferred tax to be charged in the income statement, to be taken into account in the income statement, is computed using something called the timing difference. The timing difference is the difference between the accounting profit and taxable profit, and which give rise to deferred tax. But now, International Accounting Standard number 12 do not do not prefer entities to use that particular method, and therefore the other method which is recommended by IS 12 is the balance sheet method, whereby the deferred tax is computed based on something called the temporary difference, based on something known as the temporary difference. So what is a temporary difference? A temporary difference basically is the difference between carrying amount and the tax base of the asset and liability. So, of which in this case we have two types of deferred temporary difference. We have the taxable temporary difference and also the deductible temporary difference. Maybe we can just start our recap there. We say that deferred tax, this one, according to the balance sheet, maybe you can just say according to a balance sheet or statement of financial position approach, and which you have said is a method which is recommended by International Accounting Standard number 12. According to balance sheet or statement of financial position approach, deferred tax is computed using temporary difference. Difference, which is abbreviated as TD. And what is a temporary difference? A temporary difference, this is the difference between the tax base and the carrying amount of asset and liabilities. So temporary difference, which is abbreviated as TD, is the difference between the carrying amount, which is abbreviated by CA, and the tax base. So when talk about the carrying amount, we have to recall what you covered in the lower level. Carrying amount is the value at which an asset or even a liability is recorded in the company's statement of financial position. For example, when talk about the carrying amount of PP, we are talking of the net book value. So on the other hand, when talk about the tax base of asset and liabilities, this is the value of an asset or liability for tax purpose. For instance, equally when talk about the tax base of the PP, we are talking of the written down value. Written down value, which is computed by taking the cost of the PP minus the total capital allowance, or minus the total wear and tear allowance. So that is the first thing you need to recall, that what is carrying amount and also what is tax base. Now in this case, this temporary difference can either be taxable temporary difference, or deductible temporary difference. Taxable temporary difference, abbreviated as TTD. Deductible temporary difference, abbreviated as DTD. So a temporary difference is taxable whereby the carrying amount of asset or liabilities exceed the tax base. But on the other hand, if the carrying amount of an asset or liability is less than the tax base, then you get something called a deductible temporary difference. Now, a taxable temporary difference, this one gives rise to something called a deferred tax liability. Deferred tax liability, abbreviated as DTL. And therefore, to compute the deferred tax liability, we take the taxable temporary difference times the tax rate. Abbreviated by TR. So this taxable temporary difference times what? Times the tax rate. But on the other hand, a deductible temporary difference, this one gives rise to something called the deferred tax asset. A deferred tax asset is a tax which is recoverable by the company in the future. Deductible temporary or deferred tax liability is a tax payable by the company in the future. So how do we therefore compute these deferred tax asset? To compute the deferred tax asset, we take the deductible temporary difference, DTD, equally times what? Times the tax rate. The tax rate. So therefore, this is the first thing you need to recall from basically what you covered in financial reporting and analysis intermediate level. And I think with that particular small recap, we can be able to proceed and look on a question from a past paper, and basically this is a question which was tested in the sitting of August 2022, and specifically it is question number 2B. So we go through the question, we see what we are told, and it reads, T Limited, a public limited entity, is a holding company in a group of companies. The following transactions related to deferred tax or the foreign transactions relating to deferred tax were extracted from, for the purpose of finalizing a group financial statement for the year ended 30th April 2022. Number one, you're told T Limited own property, plant and equipment that cost shilling 625 million when purchased. Depreciation of shillings 250 million has been charged up to the reporting date of 30th April 2022. The entity has claimed a total capital allowance on property, plant and equipment of shillings 300 million. And then you're told on 30th April 2022, the property, plant and equipment was revalued at shillings 575 million. Number two, we are told on 31st of October 2021, the company completed a development project and incurred a cost of 200 million, which it capitalized in accordance with IS 38. The estimated economic useful life of the intangible asset was 5 years at 31st of October 2021. Then you're told the company obtains a full tax relief for research and development expenditure on cash paid basis. Number three, we are told during the year which ended 30th April 2022, T Limited transferred goods worth shillings 1,500 million to one of its subsidiaries. T Limited made a gross profit margin of 20% on its sales. And then you're told a third of these goods remained unsold by the subsidiary at the reporting date of 30th April 2022. And then number four, we are told the trade receivables were carried in the consolidated statement of financial position at shilling 480 million. This was after allowance for doubtful debts of shilling 60 million and unrealized foreign exchange gain of shillings 80 million. The allowance for doubtful debt and the foreign exchange gain stroke losses are only allowed for tax purpose when realized. And then you're told number five, the balance on the deferred tax liability account of T Limited as at 1st May of 2021 was shillings 25 million. And then number six, we are told the income tax rate applicable to T Limited for the year which ended 30th of April 2022 was 30%. So what are we required to do? Roman 1, compute the relevant temporary difference as at 30th April 2022, and Roman 2, we are required to prepare a deferred tax account. So basically this is a question for deferred tax, but as you can see from the information which is provided here, this is information relating to a group of companies. That's why we are saying at this level, the questions which will be tested for deferred tax, they do have the aspect of the group. The aspect of what? Of the group. So let's start with Roman 1 of that particular question, whereby the examiner was requiring the candidates to compute the relevant temporary differences. So how do we prepare these temporary differences? We need to prepare something called a schedule of temporary differences, a schedule of TD, temporary differences. So this in this schedule, we need to have a number of columns. So the first column here will be for the various items of asset and liabilities which are provided. And then the next column here will be for something called the carrying amount. Carrying amount abbreviated as CA. We have another column here for tax base. Tax base, and the last column here for the difference between the tax base and the carrying amount, which is the temporary difference. Also, if you check on the figures which are we are given in that particular question, those figures are in million of shillings. So we need to indicate that our figures here will be in million of shillings. In million of shillings, like that. Yes, so what we need to do, let's start with the information which is given in note 1. And in note number 1, we are given information about PP. So therefore, what we do, we first of all record that item here. You're given the item of PP, property, plant and equipment, and you're told that the cost of this property, plant and equipment was 625 million when it was purchased by the company, and then you're told it has been depreciated, or the depreciation which was charged as at 30th April of 2022 was 250 million. In other terms, this is the accumulated depreciation as at that date. And then you're told the entity has claimed a total capital allowance on property, plant and equipment of 300 million. And then you're told at the end of the current year, this particular property, plant and equipment were revalued at an amount of how much? 575. Now, as far as the PP is concerned, we are given three values there, or basically we can be able to determine three values. Number one, we can be able to determine the net book value of this PP, which will be equal to the cost minus accumulated depreciation. So the costs of this particular property, plant and equipment is 625 million, and you're given the accumulated depreciation of 250 million. So we need to get the net book value. Remember, the net book value is the same with the carrying amount, or basically, yes, this will be the same with the carrying amount. And then also we are given the revalued amount. We are told these items of PP were revalued at the end of the current year at an amount of 575 million. And also from the information which you are given in that question, we can be able to get something, or to compute something called the written down value. The written down value, this one is equal to the cost minus the total capital allowances. Capital allowances which have been claimed by the company. So we know the cost is 625 million, and then the total capital allowances claimed by this company is 300 million. So this will give us 325 million. So this 325 million, maybe to start with that, that is what if far as the carrying, not the carrying rather, this is the tax base. This is the tax what? The tax base. So the value of an asset, or basically those particular assets which qualify for capital allowance, their value for tax purpose is always equal to the written down value, which is equal to the cost minus the capital what? Allowances. So therefore 325, that is basically the tax base. Tax base. Remember, the tax base is the value of an asset or liability for tax what? Purpose. So therefore, the value of these items of PP for tax purpose is written down value. What about the carrying amount? Now, for carrying amount, here we have two values. We have the net book value and the revalued amount. Now, a question arises here. Whenever the company has revalued the asset at the end of the year, those particular assets in the statement of financial position, are they supposed to be recorded there at net book value? Are they supposed to be recorded there at the revalued amount? So automatically, anytime the company revalue the asset, those assets are recorded in the statement of financial position at the revalued amount, not at the net book what? Value. So therefore, the carrying amount, which is the value at which these particular items of PP will be recorded in the statement of financial position, is what? 525. So, and then what we need to do is basically to get the difference there. The difference, or the temporary difference, this is equal to this minus that, which will give us 250. And because it's a positive figure, we refer to that as taxable temporary difference. If you get a negative figure, it is a deductible temporary difference. But it's also important to note that from the information which are given here, you can see these items of PP were revalued to 575. But in this case, we have the carrying amount, or basically the net book value, I think, which we needed to compute here. So this will give us 375. So that was the net book value of these items, but they were revalued to an amount of how much? 575. Automatically, what that means is that there was a revaluation gain equal to the revalued amount, 575 million, minus the net book value, 375, and basically this should give us 200 million. So 200 million, this is a revaluation gain. And according to IAS 12, anytime the company revalue items of PP, and that give rise to a revaluation gain, then the entity should do what? Determine something called the deferred tax expense. So how is this deferred tax expense accounted for? We take the revaluation gain times the tax rate. So the revaluation gain in our case is 200 million. And then the tax rate, as per, we are given the tax rate in the additional information number 6, 30%. So this will give us 60 million. So how is this deferred tax accounted for? The deferred tax expense accounted for. This deferred tax is accounted for by debiting the account called the revaluation reserve account, and then we credit an account called the deferred tax account. So when answering, or basically when preparing the deferred tax account as required in Roman 2 of that question, that is the moment you're going to take into account that particular word, deferred tax expense. That deferred tax expense will be credited in that account. But what we need here is the carrying amount and also what? The tax base. So let's move to point number 2 here. And in point number 2, we are given information about the development project which was undertaken by this company, where we are told the company incurred a cost of 200 million and capitalized that cost in accordance with IS 38. So anytime the company is, for example, developing a certain product and so on, and the company has incurred some development cost, that development cost should be capitalized. In other terms, it should be treated as an asset. Now, in this case, what we need to do is to determine the carrying amount and also the tax base. Now, the carrying amount, or basically the amount at which this particular development cost will be recorded in the company statement of financial position, is always equal to the cost. So the carrying amount of this development cost is equal to the cost. This is the carrying amount is equal to the cost minus the accumulated amortization. Amortization is the amount which has been written off. So we know the cost is 200 million. And then in this case, we are told that this particular development project was completed on 31st of October 2021, meaning that this 200 million, it was capitalized from that date. Or in other terms, it was treated as an asset from 31st of October 2022. But in our case, we also know that the current year is ending on 30th of April 2022. We are told this cost was capitalized from 31st of October 2021. So how many months do we have here? So we have November, December, January, February, March, April. 1, 2, 3, 4, 5, 6. So mean that we have 6 months. Or basically this development cost was capitalized 6 months now to the end of the year. And the reason why that is important is because the amortization we are going to deduct from this particular cost will not be for the whole year, but rather it will only be for 6 months. So therefore, what we do to compute the amortization, we take the cost which was capitalized 200 million, we divide that with the estimated useful life of this asset, which are 5 years, and then this will give us amortization for the whole year, but in our case, we are only interested with amortization for just 6 months. So this will give us 40, and then half of that is 20. So this will give us 180M. 180M is the carrying amount. What about the tax base? Tax base, in this case, is equal to the amount which will be around for tax purpose in the future. There is some information which you are told in this question that the company incurred this particular development cost during the current year, or basically before the end of the year, 6 months to the end of the year. And then in the last sentence, we are told the company obtained a full tax relief of research and development expenditure on cash paid basis, meaning that anytime the company has incurred development cost or even the research cost, that amount will be treated as an allowable expense once it has been paid. Paid. So mean that this development cost has already been paid. Then the tax base, in this case, we are saying will be the amount which will be treated as an allowable expense in the future. and take into account the full amount has already been treated as an allowable expense. So the amount which will be treated as an allowable expense in the future will be what? 0. So therefore that is the tax base. So we get the difference here, which is 180, still a positive, and that is a taxable temporary difference. So let's move to point number 3. Where we are given some information. We are told during the year which ended 30th of April 2022, T Limited transferred some goods worth 1,500 million to one of its subsidiary, and then you're told T Limited made a gross profit margin of 20% on its what? Sales, on its sales. And then you're told a third of these goods remained unsold by the subsidiary at the reporting date. Now, from that particular point, what we are, our interest is the inventory. Basically, what we know is that, or what you are told is that the parent company, which is T, sold some goods now to the subsidiary, and basically some of those particular goods had not been sold to third parties. So meaning that some of the goods remained in the inventory or were part of the closing inventory of the subsidiary. That is our interest here. How much goods were not yet sold by the subsidiary at the end of the year. And in this case, we can be able to determine their value because here we are told the goods which were transferred by the parent to the subsidiary, they had a value of 1,500 million. But now the goods not yet sold at the end of the year, we are told they were a third. A third of that is what? Is 500 million. So this particular 500 million is basically the cost to this company. Is the cost to this what? To this company. But now what we know is that this particular goods have an element of unrealized profit. Have an element of unrealized what? Profit. So what we need to do is basically we take 500 million, we less the unrealized profit. How do we less the unrealized profit? The unrealized profit, this one is computed by taking the unsold goods, the unsold goods 500 million, 500 million times the gross profit margin. That is how we compute the unrealized profit from what you have covered in the topic of group accounts. So what we do, we take 500 million minus the unrealized profit, which will be equal to unsold goods 500 million times the gross profit margin. The gross profit margin in our case we are told is 20%. So this will give us 100. So 100 million. So therefore this will give us for what? This will give us for 400 million. 400 what? Million. So this particular 400 million is basically the cost. And basically what we know is that anytime a company is preparing, or even a group of companies preparing the consolidated statement of financial position, the inventory should be recorded there, mostly at the level of the net realizable value and the cost. So we know the selling price is 500 million, but the cost is what? Is 400 million. So therefore, this particular good here will be recorded in the statement of financial position at what? At that particular amount which you have computed there. So therefore, in our case, we have the tax base, which is now 500 million. But we have said in the statement of financial position, this particular inventory will be stated there at what? At the cost, which is 400 million. And basically, we get the difference, this minus this, which will give us 100 million. And because it's a negative, that is a deductible temporary difference. So we are through with point number 3. Let's move to point number 4, where we have information about the trade receivables. So for the trade receivables, we are already given the carrying amount. The amount at which the receivables are carried is the statement of financial position. No problem with that, which is 480. But we are told this figure was arrived at by this group of companies after making allowance for doubtful debt of 60 million and including unrealized foreign exchange gain of what? Of 80 million. Now, for you to be able to know how to determine the tax base of the trade receivables is always equal to the gross amount, because now what you are given here for 80 is the net amount. So this net amount of 480 is arrived at by the company after having deducted a provision for doubtful debt of 60 million, and also after including 80 million 80 million, which is unrealized, unrealized foreign exchange gain, unrealized forex what? Forex gain. So this unrealized forex gain is like an accrued income. It has been added in arriving at the figure of 480. So how do we get the gross amount? Because we are saying this is a net. Whatever you have here is a net. And we are saying that the tax base of receivables is always equal to the gross amount. So the gross amount in this case will be equal to 480. And then we add what has been deducted, 60, and then we less 80, which has been what? Added there. So that is how we arrive at the gross amount, which you are saying is what? Is the tax base. So this is like 480, and then we deduct 20, which will give us 460. So 460 in our case is what? Is the tax base, Yes, so I think we are done with that point. And then in point number 5, we are given the deferred tax liability at the start of the year, which we are going to use in Roman 2, and also in part 6, number 6, we are given the tax rate. So tax rate, basically, we are going to use it here. So therefore, what we need to do, we get the difference, this minus this, which will give us 20, a positive, and is a positive, so mean that that is a taxable temporary difference. So take into account we don't have anything else or any other item of asset or liability which you are provided with. So what we need to do is basically to get the net amount here. So we add off that. We see what it will give us. So we have what? We have 250 plus 180 will give us 350, which is a positive figure, and we refer to this as net taxable temporary difference. Difference. So that is it, that what was required in part A of that particular question. And basically by doing that, the marks allocated there were 6. And generally what is marked in such a question are these figures here. These are the figures which are marked. Basically by doing that, a candidate was supposed to get 6 marks. So let's move to Roman 2 of the question. And in Roman 2, we are required to prepare the deferred tax account. Deferred tax account. Deferred tax account. So this one is basically quite simple. Because what we first of all record here is the deferred tax asset or deferred tax liability at the start of the year. And if we go back to the information we have in note number 5, we are told the balance on the deferred tax liability account of this group at the start of the year was 25 million. So I hope you can see we are told that is a deferred tax liability. So, and because it's a deferred tax liability, we record it as the opening balance in this account. On which side? On the credit side, because we know all liabilities have an opening credit balance. So the balance brought down is 125 million. There is also something else we also need to remember here. Okay, before we record this item here, remember there is an item which we said will be recorded in this account here, this one. So before we record that item, so first of all, we need to determine the amount of deferred tax at the end of the year. And take into account at the end of the year, there was a net taxable temporary difference. You have to recall what we said here, that a taxable temporary difference give rise to something called a deferred tax liability. So what we need to do is to compute the amount of deferred tax liability at the end of the year, which is computed by taking the taxable temporary difference, which is 350 million. We multiply that with what? With the tax rate. Tax rate we know is 30%. So this will give us now the deferred tax liability at the end of the year. So we have 350 times 30%, and that will give us 105 million. 105 million. So this is the deferred tax liability at the end of the year, and such deferred tax liability at the end of the year, we record it on the debit side of this account, but down here. So the deferred tax liability at the end of the year is 105 million. So the other item which we need to record is what we have here, the deferred tax expense on the revaluation gain, which we said in the deferred tax account will be that will be what? Credited. So we have the deferred tax expense, deferred tax expense on a revaluation gain, which is computed as a figure of 60 million. And then from there, what we need to do is we balance our account. We balance our account, of which now the balancing figure in this account is the amount now which will be taken to the income statement. Is either deferred tax income or a deferred tax expense. I think what we have on the debit side is more 105 million. 105 million. So mean that we're going to have a balancing figure on which side? On the credit side, which will be equal to 25 plus 60. Basically 85, we deduct that from 105. 105, which will give us 20 million, and this will be taken to income statement, of which a balancing figure on this side, this one is known as a deferred tax expense. A deferred tax expense. But if the balancing figure was on this side, still we take it to the income statement and we refer to that as deferred tax income. We refer to any balancing figure on this side as a deferred tax income, deferred tax income. And basically that is it. That's what was required in that part. And the marks allocated here were four marks. So the items now which were marked, or the items which were marked are those 4 items. Opening balance, this deferred tax expense on the revaluation gain, the amount of deferred tax expense to be taken to the income statement, and this figure. So a candidate in that case was supposed to get to how many marks? 4 marks. So basically that is it. That what was required as far as that illustration is concerned. So once we come back in our next session, still I want us to look on another illustration from the same topic. Hi candidate, welcome to another session of Manifested Online classes. My name is Joseph Kimani, your lecturer for financial reporting and advanced financial reporting. So in this session, I want us to look on topic number 4. And in this topic, the topic is analyzing financial statement. So in this topic, you're going to look on 4 subtopics. The first subtopic you're going to cover is the topic regarding computation of earnings per share in accordance with the International Accounting Standard number 33. Subtopic number 2 is related party disclosures, where we are going to define who are related parties, and also we see the information which a company is expected to disclose as far as the related party transactions are concerned. Subtopic number 4, we are going to look on preparation of a segment report in accordance with IFRS 8. And then finally, we are going to look on financial reorganization and reconstruction. And basically in that particular subtopic, you're going to look on 2 ways in terms of how the company may restructure. That is the internal reorganization or the capital reduction, and what we refer as the internal reorganization or that is external reorganization, or basically the external reconstruction. So therefore, here we are going to look on those 4 topics. So I want us to go straight to topic or to subtopic 1, which is regarding the computation of earnings per share, that is EPS. And in this topic, we're going to look on a number of issues. One, we are going to define what is earnings per share. Number two, we are going to look on the significance. What is the benefit of the company computing the earnings per share? And then from there we proceed and we look on the two types of the earnings per share to be computed and disclosed by the listed companies, and that is the basic earnings per share and the diluted earnings per share. So mean that by the end of the day, once we are through with it, with this particular topic, you must be in a position to define earnings per share, to know the significance of earnings per share, and also to compute the basic and diluted earnings per share. But I want us to start by defining what is earnings per share. And EPS basically refers to the amount of profit or the amount of earnings which is attributable to each ordinary share issued by the company. Is the amount of profit which is attributable to each ordinary share issued by what? By the company. So therefore, here we can say EPS, this is amount of profit, amount of profit or earnings attributable to each ordinary share, issued by a company. It is the amount of earnings, or basically the amount of a profit which is attributable to each ordinary share issued by what? By the company. Basically what you have said is that all listed companies, and these are those particular companies whose shares are trading in the securities exchange market, it is a requirement that they must compute and also disclose the earnings per share as part of their notes, as part of the notes to the financial statement. So we can say listed companies are required by IAS 33 to compute and disclose earnings per share. So by disclosing mean that this particular earnings per share which is computed, it should be part of the notes to the financial statements. Now, what are the significance, or basically what are the importances, or what are the benefits of this particular earnings per share? So let's look on the significance, or in other terms, we can say that these are benefits of earnings per share. So once this earnings per share is computed, how is it important to the company and also maybe to the shareholders and other stakeholders? Number one is that earnings per share helps to compare financial performance of an entity over time. Basically what that means is that as a shareholder of a company, you can be able to use this particular earnings per share to compare the performance of the company over a number of years, basically to know or basically to compare the profitability, how the company has been performing over a number of years. Number two is that this particular earnings per share also helps to compare, maybe we can talk of profitability of different entities, to compare performance of different entities. So mean that the earnings per share can also be used in terms of comparing performance of company A and performance of company B. Number three is that the earnings per share is also used, we can say it is used in computing, the price earning ratio. So the price earning ratio, this is basically a ratio which is computed by taking the market price per share, and then we divide that with the earnings per share. So to compute that ratio, definitely you need to have the earnings per share. And also this earnings per share, we can say, is used by shareholders to know the amount of profit generated for each share held, in the company. So as a shareholder of the company, you can be able to know the amount of profit that particular company was able to generate for each share held in that particular company. So therefore, those are basically some of the significance, some of the benefits of the earnings per share, which we are saying must be computed, disclosed by all the listed companies. So before we look on how we compute the earnings per share and also the different types of earnings per share, first of all, I want us to look on definition of various terms. So some of the terms we need to define here. Number one is something called the potential ordinary shares. This one are abbreviated as POS. And this refers to any contract which has been entered into by the company or any other form of financial instrument issued by the company and which requires the company to issue ordinary shares in the future. So we can say it is a contract or financial instrument requiring an entity to issue ordinary shares in the future. So examples of these include stock options. Stock option is a contract between the company and the employees that for the company to issue shares to the employees in future at a price below the market price. Another good example of this is convertible securities. Convertible securities, e.g. convertible debentures. If you acquire convertible debentures of the company, then you have the right to do what? To convert them into ordinary shares. Those are good examples of the potential ordinary shares. So the other term which you also need to define here is an option and warranties. So options and warranties, on the other hand, these are those particular contracts which requires the company to issue ordinary shares in future at a price which is below the market price. A good example is whereby the employees of the company will be given a privilege or basically a right to buy the shares of the company in the future at a price below the market price. So therefore, we can say that this is a contract requiring an entity to do what? To issue ordinary shares in future at a price below market price per share. Per share. So that is basically the other term which you must be in a position to define. The other term is something called the contingently issuable shares. So when we talk about the contingently issuable shares, basically we say that these are those particular shares which are issued by the company in the future, either at no consideration or at nil consideration or at retro consideration once certain specified conditions have been met. For example, in this case, the company can promise to issue shares to its executive or basically to the executive managers if the profit of the company exceed a certain amount. So mean that once the profit of the company exceed a certain amount, then the senior managers will be issued with the shares of the company free of charge. So basically, this is something which is exercised by most of the companies. For example, if you check company like Safaricom, company like Equity Bank, they ordinarily issue shares to the senior managers once the profit of the company exceeds a certain what? A certain amount. So therefore, we can say that these are shares. These are shares issuable in the future or issuable at nil, or yes, at nil or retro consideration once specified conditions are met. Once specified conditions are met. Once specified conditions are met. Yes. So that is the other term. The other term we need to define here, number 4, is the term dilution. So dilution, basically these to dilute is basically to reduce the effect of something. So therefore, this is the reduction in the earnings per share, or basically the increase in the loss per share, on the assumption that the potential ordinary shares, e.g. convertible debentures or maybe stock options, have been converted into ordinary what? Shares. So therefore, you can say that this is the reduction in profit, or basically let's talk of in earnings per share, or increase in loss per share on the assumption that potential ordinary shares which are abbreviated as POS have been converted into ordinary shares. We refer to that as dilution. The other term is anti-dilution. So anti-dilution now is the direct opposite of dilution. So mean that anti-dilution now is the increase in earnings per share or decrease in loss per share, on the assumption that POS have been converted into ordinary shares. So we can say that this is a increase in earnings per share, that is EPS, or decrease in loss per share on the assumption that potential ordinary shares, POS, have been converted into ordinary shares. Ordinary shares. So basically, these are some of the terms which you must be in a position to define. You may come across a question whereby the examiner is requiring you to define some of this particular word term. Like there was a question which was there in the past papers, and that question was requiring the definition of the potential ordinary shares and the contingently issuable shares, and still the question there was requiring the definition of the term what or the explanation of the term what? Dilution. So therefore, you must be in a position to do what? To define any of those particular word terms. Equally, you should be able to remember those particular word significance. So here is today's assignment. Question number 1. Why is earnings per share EPS considered a crucial metric for investors when evaluating companies' performance? Number 2. How does earnings per share help shareholders in assessing the profitability and growth potential of company over time? 3. What factors can influence a fluctuation in earnings per share and what implication does this fluctuation have for investors? Question 4, explain the concept of potential ordinary shares and how they impact the calculation of earnings per share. 5, what are options and warranties in the context of EPS calculation, and how does they affect the number of outstanding shares? The other question, define contingently issuable shares and discuss their significance in calculating the diluted earnings per share. The other question, what is meant by dilution in context of EPS, and how is it important for investors to understand its implication? The other question, how does stock option, warrants, and convertible securities contribute to dilution, and how is this reflected in earnings per share calculation? The last question, explain the concept of anti-dilution and provide examples of measures companies might take to prevent dilution of earnings per share. So that is today's assignment. I want us to take a short break, or basically we take a break. Once we come back in our next session, we are going to look on the types of earnings per share to be computed, and then from there we start by looking on the computation of the basic earnings per share. Hi candidate, welcome to another session of Manifested Online Classes. And I want us to continue with the topic of earnings per share. So this is our lesson number 3. In the previous lessons on the same topic, we defined what is earnings per share. We looked on the significance, or basically the benefit of earnings per share. And also we were able to define some few terms. In lesson number 2, we defined what is basic earnings per share, and actually looked on how basic earnings per share is computed. And also we discussed on some of the reasons as to why the number of ordinary shares issued at the start of the year may change. So in this session, I want us to do an illustration question regarding the computation of basic earnings per share. And that illustration question is based on a past paper question, and the question is November 2019, which is question number 5A. So we go through the question and then we see what the examiner was requiring. So the question reads, Dakika Limited has prepared its consolidated financial statements for the year which ended 30th September 2019, extract of which are shown below. Also provided below are extract of the consolidated financial statement for the year to 30th September 2018. So we are given some information for 2 years, the year which ended 30th September 2018 and 2019. So number one, we have profit before interest and tax. We have the finance cost. We have the tax charge. We have the ordinary dividends paid, preference dividends paid, and profit attributable to non-controlling interest. And then you're told you have also obtained the following information in respect of company's share capital. Number one, you're told the ordinary shares as that is ordinary share capital as at 1st of October 2017 was shillings 15 million, made up of shares of shillings 5 per value. Number two, you're told Dakika Limited issued some 500,000 shares at full market price on 1st of January 2018. And number three, we are told Dakika Limited also made a right issue of 2 new ordinary shares of 2 new ordinary shares for every 10 ordinary shares held as at 1st April 2019. The right issue price per share was shillings 42.5. Market value per share as at the same date was shillings 48. Number four, we are told Dakika Limited also had 1 million 6% shillings 10 per value non-redeemable shares as at 1st of October 2018. So from that particular information, what the examiner was requiring, number one, is we compute the basic earnings per share, BEPS for the year which ended 30th September 2018, and number 2, we compute the diluted, not the diluted, sorry, the basic earnings per share for the year which ended 30th of September 2019. So here we are required to compute the BEPS, basic earnings per share, for 2 years. And what we said is that in computing the basic earnings per share, we take the profit attributable to ordinary shareholders, we divide that with the weighted average number of ordinary shares. In other terms, we take the PATOS, divided that with what? With the one-offs. So that is the first thing we need to have here. That is the formula for computing the BEPS for the first year which ended 30th of September 2018. So the formula here is that we take the PATOS, which in full is the profit attributable to ordinary shareholders. We divide that with one-offs, weighted average number of ordinary shares. So we need to compute these two items. We start by determining the profit attributable to ordinary shareholders. And we start with that for the first year, which ended 30th of September 2018. So in terms of how we compute this, we said we take the profit for the year, or the profit after tax, less the preference dividends for that year, and then we less any profit attributable to non-controlling interest. So what you're given in that particular question, we don't have the profit after tax, but we have the profit before interest and tax. So what we need to do for us to get the profit after tax, we take that profit before interest and tax, we less interest, and also we less now the tax, so that we get now the profit after tax. So to get the profit after tax, so we're going to take the profit before interest and tax, and we are starting with the year 2018, which is given as 7012. So to this we less the interest, which in other terms we refer to as the finance cost, and then we less tax, which is 1264, and that now will give us the profit after interest and what? After interest and tax. And then to this we also less the preference dividends. Preference dividend. You also have to recall what we said in our previous session, that if the preference shares issued by the company are redeemable, we don't less their dividends here, because they have already been deducted in arriving at this particular profit as part of the finance cost. But in the additional information number 4, we are told that preference shares issued by this company, they are non-redeemable. They are non-what? Redeemable. So therefore, you're going to less those particular dividends here, and you are given the dividend 60,000, and then to this we also less the profit attributable to non-controlling interest. We have that particular figure as a figure of what? 160. So whatever you're going to get here is what we refer to as the PATOS, the profit attributable to ordinary shareholders. So let's compute that, but we need to first of all determine the profit after tax, which is 7012 minus 60 minus 160. Okay, sorry. We take 7012 minus 987 minus 1264. So that will give us a figure of 4761. And then we less these two items. We less 60 and also we less 160. So we get 541. So 4541, this is what? The profits attributable to ordinary shareholders. So in our case, we already have that. So next, what we need to do is to determine the weighted average number of ordinary shares. And for us to compute this, that is the weighted average number of ordinary shares, we said we take the ordinary shares issued and fully paid at the start of the year. And this particular year, which was ending 30th September 2018, this year started on 1st of October 2018. That is when the year started, not 2018 here, but 2017. And that year ended 30th of September 2018. So therefore, to compute the one-off weighted average number of ordinary shares, we take the shares issued at the start of the year, and then we add the other shares which were issued during that particular year. In our previous session, we also discussed on how we treat the various types of shares which are issued during a certain financial year or in a certain financial year. So you have to recall what we discussed in our previous session. So what you are given, if you go to the note number 1, you're told the ordinary share capital of this company is at 1st of October 2017 here is 15 million, made up of shares of 5 shillings per value. So basically what you're given here is the share capital of the company, which was 15 million. So therefore, to compute the one-offs, we take the shares issued and fully paid at the start of the year, which we are saying started on 1st of October 2017. So, and the shares issued and fully paid at the start of the year, we can refer to that as balance brought down. So what we do, we work with our figures still in thousands of shillings. So for us to be able to determine the shares issued and fully paid at the start of the year, we take the share capital, and we have to be very keen that 15 million, these are not the number of shares, because our interest here are the shares issued and fully paid at the start of the year, but this is the total value of the shares. So therefore, for us to get the shares issued and fully paid, we take 15,000 divided that with 5, which is the par value per share, and basically this should give us 3,000. So those are the shares issued and fully paid at the start. Then what we have to do is we check during this year, were there some shares which were issued? So let's check the information which are given in note number 2. You're told Dakika Limited issued 500,000 shares at full market price on 1st of January 2018. 1st January 2018. So you can see 1st January 2018 is within the first year, because here we are given information about 2 years. So you have to check whether that transaction occurred in the first year or in the second year. So therefore this one occurred during the first year. That is the 1st January 2018. So we say there was issue of shares, or basically ordinary shares, at full market price. Issue at full market price. Now, these particular shares which are issued at full market price, we said in terms of how we treat them, for the purpose of computing the basic earnings per share, we weigh them on time basis. We multiply them with the proportion of time they were held during that year. So these shares were held from January of 2018, actually 1st January, to the end of or to 30th September. So here automatically we have 9 months, because from January to the end of September, 9 months. So therefore what we need to do is to multiply these particular shares on time on time basis, or basically based on the proportion of time they were held during that year. So we have 500,000 times 9 divided by 12. That will give us 375. So and then from there we have the other transaction, note number 3. We are told Dakika Limited also made a right issue of 2 new ordinary shares for every 10 ordinary shares as at 1st April 2019. 1st April 2019, is it within the first year here? No, that is not within the first year, because we also have to recall we are given information for second year, which ended on 30th September 2019. That is September 2019. So therefore that transaction regarding the right issue is a transaction for the second year. So we are going to consider that in computing the BEPS for year 2. And then note number 3 is about the preference shares. Do we consider the preference shares here in computing the basic earnings per share? No. So therefore in our case we can get now the one-offs. The one-offs by adding these two, which will give us 33.75. So in our case, it basically means now we have the 2 items which we require. We have the patos, and then we have what? The one-offs. So having that, we can then proceed and we compute the basic earnings per share, which will be equal to patos 45.41 divided that with one-offs 33.75, and that now will give us the earnings per share, the basic earnings per share. So the basic earnings per share will be 45.41 divided by 33.75, and this will give us shillings 1.345, which is shillings per per share, shillings per share. So basically that is it, that what is required as far as Roman 1 is concerned. And you can see the marks which were located there are 4 marks. Mostly what will be marked here is the pathos. Were you able to get that figure correctly? And also this. Were you able to determine the shares issued and fully paid at the start? And also were you able to treat or basically to deal with those particular shares issued at full market price? Basically by doing that, you get your 4 marks. You get your 4 marks. So let's move to Roman 2 of that particular question there, whereby we are required to compute the basic earnings per share for year 2, which ended 30th of September 2019. So Roman 2, BEPS, basic earnings per share for the year which ended 30th of September 2019. So the formula for computing this remains the same. We take the pathos all of our notes. We don't need to repeat the formula because the formula is not marked. So but what we need to do is to determine these 2 items, the pathos and one-nos. So let's start by determining the pathos for the second year. So the procedure is the same. Take the profit after tax minus preference dividends minus the profit attributable to ordinary shareholders. So the profit after tax, equally this one is not given, but we are going to compute it in the same way. We take the profit before interest and tax, which is given as 830 minus the finance cost or minus the interest, 1045 minus the tax charge, which is 1718, and basically that will give us the profit attributable to ordinary shareholders. Not the profit attributable to ordinary shareholders, but the profit after tax. And then to this we less the preference dividends, the preference dividend, and also we less the profit attributable to non-controlling interest. So the preference dividends still is a figure of 60 as the first year. The profit attributable to non-controlling interest is 180. So this will give us now the pathos. So let first of all we work out the profit after tax, which will be 830 minus 1045 minus 1718, so which will give us 67, and then to that we less 60 preference dividends and profit attributable to NCI, which will give us 5827. So in our case we already have now the pathos. Next we need to proceed and we determine the one-nos, weighted average number of ordinary shares. So we know that the second year here started on 1st of October 2018. That is when the year started, 1st of October 2018. So what we need to do is to determine the shares issued and fully paid at the start of the second year. So this is something which the examiner will not have given you. Anytime you're given information about 2 years, is upon you to determine the shares issued and fully paid at the start of the second year. Where do you get that information? That information is not in the question. You get it from the computation you did in the previous year. So from the previous year, we know the shares which were issued and fully paid at the start were 3,000. So you take those shares, 3,000, and then you check during that year, were there other shares which were issued? Yes. So we have these shares, 375. But now what you do, you take the actual shares. The actual shares were not 375, but the actual shares were 35, because those shares as at the start of the second year will be issued and fully paid. So therefore, you take the actual shares and basically you add them to the shares issued and fully paid at the start, which will give us 35. And then you check during the second year here, was there other shares which were issued? Yes. So in note number 3, we are told on 1st of April 2019, there was a right issue. Remember, you said in our previous session that this is a very, very common concept a very, very important concept which is tested in almost all questions for earnings per share. So, and what we said is that during a right issue, the company issues additional shares to the existing shareholders of the company at a price which is below the market price. As a result of that, we said those shares which are issued to the existing shareholders of the company, some of them are deemed to be issued free of charge, whereas others are deemed to be issued at full market price. And therefore, we said these shares issued during the right issue, we have to split them into two components, into shares issued at full market price and the shares issued free of charge. But for us to do that, we need to compute two items. Number one, we need to determine how many shares were issued by the company during the right issue. And number two, we also compute something known as theoretical ex-right price, which we said is the expected market price per share after the right issue. I gave you the formula for computing the same. So therefore, what we need to do as far as this right issue is concerned, we need to compute two items. Number one, the shares which were issued by the company during the right issue, because we are not given that. How many shares were issued during the right issue? So as per the information we have in note number 4, we are told during the right issue, the company was to issue 2 new shares. The company was to issue 2 shares for every 10 shares, which were held. For every 10 shares which were held. So what we need to do is to ask ourselves, before this particular right issue was made, how many shares were held? And equally, you can't get that in the question, you can only get that from your computation. So before this right issue was made, you can see the shares which were held or which had been issued by the company were 3,500. So those are the shares which were held. So we need to determine how many shares were issued during the right issue. We cross multiply, then we divide 2 times 3,500 divided that with 10. So this will give us 700 shares. So these are the shares issued by the company during the right issue. Those are the shares we are going to split into two components. Shares issued at full market price, shares issued free of charge. But before we do that, we need to compute something known as theoretical ex-right price. This is something which the examiner will not have given you. You have to compute that. So there is a formula which we use and which you covered in FM, Financial Management Intermediate level. But I gave a very simple approach of computing this in the previous session, because if you go back to the information which we have, there is some information or some details I want us we get there from note number 3. We are told in the last sentence of note number 3, the right price per share was 42.5. So mean that because during the right issue, the company was to issue 2 shares for every 10 shares which were held before, these 2 shares which were to be issued by the company during the right issue, each share was to be issued at 42.5. But now, the shares which were held, or basically the market price per share before the right issue was 48. So that information, we need to have it here. So and therefore, once you have that information, we said you come here and you say, before the right issue, if you held 10 shares, and each share was trading at 48, that's what we know, then during the right issue, as a shareholder of this company, you are to be issued with 2 shares. Record the shares there, 2 shares at a price of 42.5. At a price of 42.5. So basically what that means is that after the right issue, as a shareholder of this company, will be holding 12 shares. If you held 10 before, after you'll be holding 12 shares. And what will be the total market price of these 12 shares? To get the total market price of those 12 shares, we need to multiply this and this, which will give us 480, and then 2 times 42.5, which will give us 85. So and then we add the 285 plus 480, which will give us 565. So basically what that means is that after the right issue, a shareholder will be holding 12 shares, and the total market price of those 12 shares is 565. So what is our interest? Is the market price of one share after the right issue. So which is equal to the price of 12 shares, and then we divide that with the 12, so that we get the market price of one share after the right issue. So that will give us 47.083. So this is basically the theoretical right price, the market price per share after the right what issue. And I think having that now, what we need to do is we proceed and we split these shares into two. The shares which were issued during the right issue, we split them into two components. Number one, we determine the shares issued at full market price. And we said in terms of how we compute this, we compute, first of all, we determine the amount received by the company from the right issue, which will be equal to the shares issued during the right issue, 700, times the amount which was to be paid per share during the right issue. The shareholders were to pay 42.5. Then divide that with theoretical ex-right price, which you have computed down there, 47.0833, that is 0.83. And because these particular shares are issued at full market price, the rule is that they should be weighted on time basis. They should be multiplied with the proportion of time they were held. So these shares were held from April to September. So how many months do we have there? Those should be 6. So we have April, May, June, July, August, and September. So we have 6 months out of 12. Make sure your computation there is correct. And then finally, we compute the bonus shares. Bonus shares, these are shares issued free of charge. We looked on the formula and we said we take the total number of shares which were issued during the right issue, 700, minus the shares issued at full market price. The shares issued at full market price is what we have here. Not the final answer you get here, but what you have here. In fact, just transfer this here. These are the shares issued at full market price, 700 times 42.5 divided by 47.083. And equally, we said that these particular shares, we don't weigh them on time basis. We don't weigh them on time what? Basis, because they are shares issued free of charge. Yes, so let's first of all determine the shares issued at full market price, 700 times 42.5 divided by 47.083, which will give us 631. 631. Okay, let's take that again. So we have 700 times 42.5 divided by 47.083, okay, times, or basically divide that with 2. So that will give us 315.9. 315.9. Can we take it to as 316? Yes, let's take it as 316, and then we compute the bonus element here. So we have 700 times 42.5 divided by 47.083. Okay, and then we deduct that from 700, which will give us 68, around 68 to the nearest whole number. Remember, these shares are not weighted on time what? Basis. Yes. And I think now with that, we can be able to get the one-offs, the weighted average number of ordinary shares, by adding all what we have there, 35 plus 316 plus 68, which will give us 3884. 3884. Basically, what that means now, we have the one-offs, we have what? The patos. Having that, finally, let's compute now the BEPS, the basic earnings per share, which will be equal to the patos, profit attributable to ordinary shareholders. We divide that with the one-offs, which we have here, 3884. So this will give us what? This will give us an amount of what? Okay, that is 5827 divided by answer, which will give us 1.5. 1.5 what? 0. So that is it. Basically, that what was required as far as that question says is concerned, and how many marks were allocated in that particular question there? 6 marks. So definitely 1 mark, or basically this was one of the items to be marked there. The profit attributable to ordinary shareholders, and determining the number of ordinary shares issued and fully paid at the start of the year, and also computing the number of shares issued during the right issue, splitting them into 2 components, into shares issued at full market price, the bonus element, and also this particular price here, the theoretical ex-right price, mostly that is allocated a mark, because most of the students have a challenge in terms of how to compute what that, and basically by doing that, a candidate secured how many marks? 6 marks. So therefore, that is it. That what the examiner was requiring as far as that question for November 2019, question number 5A is concerned. And that is all about the computation of the basic earnings per share. So once we come back in our next session, I want us to discuss on the second type of earnings per share, the diluted earnings per share. We look on how it is computed, why companies are required to compute the diluted earnings per share. And then from there, we look on an illustration question, which is also based on a past paper question. So see you in the next session. Hi candidate, welcome to another session of Manifested Online Classes. So in this session, I want us to continue with the topic of earnings per share. And specifically, I want us to discuss on what is diluted earnings per share and the computation of the same. So diluted earnings per share, this is the earnings per share which is computed by those companies which have issued potential ordinary shares. So potential ordinary shares are what? These are those securities which will have been issued by the company at the end of the year, or contracts which the company will have entered into, and which requires the company to issue ordinary shares in the future. A good example of a potential ordinary share is convertible securities, like convertible debentures, or stock options which are granted to the employees and which are to be exercised in the future. Definitely, once these particular potential ordinary shares are converted into ordinary shares of the company, then the interest of the original shareholders will be diluted. And therefore, International Accounting Standard number 33 requires any company having potential ordinary shares to compute diluted earnings per share and disclose that as part of the notes together with the basic earnings per share. So therefore, it is important to note that this diluted earnings per share is only computed by those companies which have the potential ordinary share. So therefore, we can say that DEPS is computed by entities which have potential ordinary shares, e.g. convertible debentures, comma, share or stock option, options, etc. So the reason why these companies are required to compute now the diluted earnings per share is because once these potential ordinary shares are converted into ordinary shares, then the interest of the original shareholders will be what? Will be diluted. That's why we are saying is a requirement by IAS 33 for these companies to do what? To compute the diluted earnings per what? Per share. So we can say IAS 33 requires companies or entities having potential ordinary shares, that is abbreviated as POS, potential ordinary shares. IAS 33 requires entities having potential ordinary shares to compute and disclose and disclose DEPS together now with the basic earnings per share. So this diluted earnings per share, we said it must be disclosed as part of the note now to the financial statement. So therefore, any company having POS is a requirement. It has to do what? To compute and disclose what we refer as what? The diluted earnings per share. Why? This is because once the POS, the potential ordinary shares, are converted into ordinary shares, the interest of original shareholders will be diluted. Will be what? Will be diluted. And therefore, by computing now the earnings per share, the diluted earnings per share, what the company will be doing, it will be communicating to the shareholders of the company of the earnings per share, will basically the effect of the earnings per share, the effect on the earnings per share once these potential ordinary shares are converted into ordinary shares. If, for example, a company has issued convertible debentures, we know that the holder of these particular debentures will convert them into ordinary shares. So once they convert them into ordinary shares, so what will be the implication of that to the earnings per share of the original shareholders? That's why we are saying that these particular companies which have potential ordinary shares is a requirement under IAS 33 for them to compute and disclose what we refer to as the diluted earnings per share, together with what? The basic earnings per what? The basic earnings per share. So how is diluted earnings per share computed? So maybe you can just look on the computation of diluted earnings per share. How do we compute the diluted earnings per share? So in computing this DEPS, we compute it, or basically it's computed on the assumption that the potential ordinary shares of the company were converted into ordinary shares. Basically what that means is that if, for instance, you're given some information, you're told the company has issued convertible debentures, then for you to compute DEPS, you do what? You assume they were converted into ordinary shares during the current year, and now you ascertain the implication, or basically the effect of that conversion of convertible debentures into ordinary shares on the earnings, or basically the profit attributable to ordinary shareholders, and also you ascertain the implication, the effect of that conversion on the weighted average number of ordinary shares. So that is very, very important, that this earnings per share is computed on an assumption that the potential ordinary shares were converted into ordinary shares. So that is maybe the first important point we can say, that DEPS is computed on the assumption that potential ordinary shares were converted into ordinary shares during the current year, And once that particular assumption is made, then I've said that we need to ascertain, or basically an entity will need to ascertain the implication of that. If this convertible, for example, the convertible debentures were converted into ordinary shares, so what would be the implication of that, both to the profit attributable to ordinary shareholders, and also what would be the implication of that to the number of ordinary shares issued by what? By the company. Like, maybe let me just illustrate what I mean by that. Let me illustrate here. We assume that a company, or we are given some information that a company has issued, for example, 8% convertible debentures convertible debentures, debentures having a value of like 5 million shillings, 5 million shillings, 5 million. So for us to be able to compute now the diluted earnings per share given such information, then what we do is that we assume that these particular convertible debentures were converted into ordinary shares during the current year. If that was the case, then that would have or that will affect the profit attributable to ordinary shareholders, and two, the number of ordinary shares issued by this company will do what? Will reduce. Sorry, will increase, that is. And therefore, what you do once you assume that this particular convertible debentures were converted into ordinary shares, you proceed, you compute two items. One, you determine something called the increase in earnings. And number two, you also determine something called the increase in number of shares. So first of all, when we talk about the increase in number of shares, we are referring to the number of ordinary shares which would have been issued by the company on the assumption that these particular convertible debentures were converted into what? Into ordinary shares during the current year. In terms of how we compute this, is very simple, because what you just do, you use the conversion rate. Use the conversion rate which is provided to you by the examiner to compute the number of ordinary shares which would have been issued on the assumption that those particular debentures were converted into ordinary shares. Then also determine something called increase in earnings. What is increase in earnings? Increase in earnings, this refers to the amount by which the profit attributable to ordinary shareholders would have increased with, on the assumption that these particular debentures were converted into ordinary shares. And if these debentures were converted into ordinary shares, it means that the interest payable on these particular debentures, that interest would not have been paid. In other terms, the company would have saved because that interest would not have been paid. And therefore, the profit attributable to ordinary shareholders would have increased with the interest which was paid by the company during that year. Interest paid, and because this particular interest paid is tax allowable, then we take that interest net of tax. So to get the interest net of tax, we multiply that with 1 minus what? Tax rate. So therefore, what we are saying here is that in computing the diluted earnings per share, we assume that the potential ordinary shares were converted into ordinary shares during the current year. Once you make that assumption, then go ahead and determine the amount by which the profit for the current year would have increased with. And number two, you determine the number of ordinary shares issued by the company would have increased with how many shares. And once you determine these two items, then you proceed and automatically compute the diluted earnings per share, of which to compute the DEPS, we take the PATOS, profit attributable to ordinary shareholders, which is used in the computation of basic earnings per share, and then to this you add the increase in earnings. Increase in earnings, I've explained what we mean by that there, and then divide that with 1/0, still used in the computation of basic earnings per share, and then to this you add increase in number of shares, and equally I've explained what we mean by increase in number of shares there. So that is the general formula, or basically the formula which is used in computing the DEPS. In computing what? The DEPS. Now, from there, we proceed and we look on specifically how we deal with the various types of potential ordinary shares in computation of diluted earnings per share. And I want us to start by looking on the treatment of the first type of potential ordinary share, and that is the convertible debentures, or convertible bonds, or even convertible own stock or own notes. So these ones are treated in the same way when computing the diluted earnings per share, because these are types of potential ordinary shares. So if you come across some question and you're told the company had issued convertible debentures, convertible bonds, convertible own stock, the first thing you need to recall is that this is a potential ordinary share. These are financial instruments issued by the company, which require the company to issue ordinary share in what? In the future. For you to compute the diluted earnings per share, you basically assume that this particular convertible securities were converted into ordinary shares during the current year. Once you make that assumption, then you proceed, you compute two items. The increase in earnings, this refers to the amount by which the profit for the current year would have increased with on the assumption they were converted into ordinary shares. And in terms of how we compute this, we take the interest which was paid, or compute the interest which was paid by the company during that year, and then you multiply that interest with 1 minus tax rate. Reason being that this interest is tax allowable. That's why we are getting that interest net of what? Of tax. And then also you compute something called the increase in number of shares. Increase in number of what? Shares. So, and to compute the increase in number of shares here, I've said just use the conversion rate provided. Use conversion rate provided. Use the conversion rate which is provided. But in this case, in computing this particular increase in number of shares, it is also important to note that if these convertible securities issued by the company were outstanding at the start, meaning that these convertible securities had been issued when the year was starting, then we assume that the conversion equally would have taken place from the start of the year. And that means that those shares which would have been issued on conversion, the number of ordinary shares which would have been issued on conversion would have been held for the whole year. For the whole what? Year. So those particular shares, don't weigh them on time basis because they would have been held for the whole year. But if a convertible security was issued in course of the current year, for example, the company issued convertible securities, convertible debentures, maybe 6 months to the end of the year. 6 months to the end of the year. So in that case, we assume if they were converted into ordinary shares, they would have been converted from the date of the issue. Meaning that the number of shares which you are going to get, which would have been issued on conversion, you have to do what? You have to weigh them on time what? Basis. You have to multiply them with the proportion of time they would have been held, because automatically those shares would not have been held for the whole what? Year. They would have been held from the date of conversion, which is the date of the issue, to the end of the year. So that is how first of all we treat the convertible debentures, convertible bonds, convertible loan stock in computing the diluted earnings per share. Number two, we have convertible preference shares. Preference shares. So this is still a potential ordinary share. Reason being that these preference shares are convertible, means that the holder of these particular preference shares can convert them into ordinary shares. So equally, if you come across a question, you're told the company had issued convertible preference shares, for the purpose of computing DEPS, you assume those convertible preference shares were converted into ordinary shares during the current year. As a result of that, you proceed equally compute the two items. You compute number one, increase in earnings, of which the increase in earnings here is equal to the preference dividends, paid during that year. Preference dividends paid during that year. And then number two, you determine the increase in number of shares. So equally to determine this increase in number of shares, what you do, you equally use the conversion rate. Use the conversion rate provided. Use the conversion rate which is provided. And equally, what I've said here, if the convertible preference shares were issued in course or during the current financial year, you assume the conversion would have taken place from the date of the issue. Basically, what that means that the number of ordinary shares we are going to get as the shares which would have been issued on conversion, what you do, you have to weigh them on time basis. You have to multiply them with the proportion of time the shares would have been held during that year. Then let's proceed and look on how we compute or how we treat the other type of potential ordinary share in computing DEPS, and that is the share or stock options. Share or stock option. So when talk about the share or stock option, we know that this basically a privilege is a right which is given to the employees of the company to buy the company shares in the future at a price which is below the market price. Equally, in computing the diluted earnings per share, we assume that these stock options or the share options were exercised during the current year. The employees of the company bought the shares of the company during the current year, but at a price below the market price. So therefore, what you do, you equally have to proceed and you determine the two items. Number one, increase in earnings, increase in earnings, of which the increase in earnings, as far as this potential ordinary shares is are concerned, then increase in earnings is always equal to 0. Reason being that here the employees of the company are just granted an option or a right or a privilege to buy the shares of the company in the future at a price below the market price. As a result of the employees being given that right, they are not entitled to any form of return until the time they buy the shares. So therefore, even if they bought those particular shares of the company during the current year, that action by the employees will not affect the profit attributable to ordinary shareholders simply because they are not entitled to any form of return. So by exercising that option, the company will not save anything, so the profit attributable to ordinary shareholders will not be affected. It will not increase. That's why we are saying increase in earnings for stock option is always equal to 0. And then number 2, we determine the increase in earnings. Remember, the increase in number of shares, not increase in earnings. Increase in number of shares. This one we have said refers to what? To the ordinary shares, which definitely would have been issued to the employees of the company, assuming they exercise this right, this privilege during the current year. And what we know is that if the employees exercise their option during the current year, then they would have been issued with the shares of the company at a price below the market price. So therefore, what we do here is, number 1, we determine the shares which would have been issued to the employees at full market price. That is the issue at a full market price, assuming they exercise the stock option during the current year. And in terms of how we determine these shares issued at full market price, first of all, we compute the amount which would have been received by the company from the employees, and then divide that with the average MPS, average market price per share. Now, these particular shares, because they are issued at full market price, these shares, we say they are not dilutive. Not dilutive. So, not dilutive means that they do not reduce the earnings per share. These are the shares the company issue. The company receive additional resources, receive an amount of money from the employees. That money is invested. By the end of the day, the profit of the company do what? Increase. And equally here, the number of shares increases. So here we are increasing both profit and also the earnings per both the profit and the number of shares. So therefore, these shares issued at full market price, they do not reduce the earnings per share. And therefore, these shares here, for the purpose of computing the DPS, are ignored. So these shares are ignored for the purpose of computing DEPS. We don't consider them. So what we consider is now the other element, number 2. And the other element, number 2, is what? Is the bonus shares. Bonus shares. So the bonus shares, this refers to those particular shares which would have been issued to the employees of the company, assuming they exercise the stock option, the right, during the current year, but free of charge. So how do we compute this? So number 1, we take the total shares which would have been issued to them, assuming they exercise the stock option during the current year, and then deduct the shares which would have been issued to them at full market price. And the shares issued to them at full market price is computed using this formula. So we deduct issue at full market price. Now, these particular shares are the ones which are dilutive, So meaning that these shares reduces the earnings per share, because what happened here, the number of shares issued by the company increases, there is no any increase in profit. So generally we know in computing the earnings per share, you take the profit attributable to ordinary shareholders divided that with number of ordinary shares. So here we are saying the company is just increasing the number of shares issued, but the profit remains constant. The profit does not change. What is the effect of that to the earnings per share? The earnings per share automatically will reduce. That's why we are saying those shares are dilutive. And therefore, these are the shares which are used in computation of the diluted earnings per share. Diluted earnings per share. So therefore, the increase in earnings here, as far as the stock or share option is concerned, we say this is equal to the bonus element or the bonus shares. So those shares which are issued free of charge are the ones which are considered here. And you also have to remember that the bonus shares, how do we compute them? We take the total shares which would have been issued to the employees, assuming they exercise the stock option during the current year, minus the issue at full market price. And also it is important for me to mention here that these particular bonus shares, we consider them as dilutive. We don't treat them as shares issued free of charge. Here, for the purpose of computing the diluted earnings per share, we treat them as what? As dilutive number of shares. So meaning that if this particular stock option or the share option was granted to the employees during the current year, then the dilutive number of shares which you get here, which are equal to the bonus shares, those shares will also be weighted on time basis. If the share option was granted to the employees during the current year. So that's basically how we deal with the share or the stock option. And then next we have number 4, we have partly paid shares. Partly paid shares. So partly paid shares, these are those shares issued by the company at full market price, but at the end of the year, the shares will not be fully paid. So these particular shares are only considered to be potential ordinary shares, if by the time the shares will be fully paid for, the market price per share will have increased. That is the only time we consider them to be potential ordinary shares, and therefore we use them in computing the diluted earnings per share. But if by the time the shareholders will be fully paying for these shares, the market price will not have changed, they are not considered to be potential ordinary shares. So therefore, they are only considered to be potential ordinary shares when or we can say they will only be considered to be potential ordinary shares if by the time the shares will be fully paid for, the shares will be fully paid for, the market price per share, will have increased. Market price per share will have what? Will have increased. And therefore, in such a case, what you do is that you compute those particular shares which will be issued free of charge. Because if, for example, the shares were issued to the employees, to the shareholders, or even to the members of the public at a price of like 20 shillings, and maybe at the end of the year, the shareholders will not have fully paid for their shares. Let's assume that those shares which will not be fully paid for at the end of the year are 1 million. So, but now at the time they will be paying for these shares, the market price will have increased to 40. So remember here the shareholders will still pay the price of 20 because the shares were issued to them at a price of 20. But at that time, the moment they are fully paying for their shares, the shares are trading at a price of 40. So meaning that they will pay a price which is less than the market price per share. And basically the concept for share or stock option also applies here. Some of the shares will be deemed to be issued to them at full market price, whereas other shares are deemed to be issued free of charge. So therefore, what you consider here are the shares which will be issued to them free of charge. You consider the bonus elements. or the bonus shares. So in the bonus shares, the formula is just the same here. So the total shares, which will be paid for, total shares to be paid for, minus the shares which will be issued at full market price. So assuming this is the information we are given, the shares now which will not have been paid for are 1 million. So these are the shares now to be paid for by the shareholders, and then to this you less the shares which will be issued to them at full market price, which will be 1 million times the amount they are going to pay per share, and then divide that with what? With 40. So these are the shares which will be issued to them at a full market price. Automatically, that means that the other shares, which I think should be what? Should be 500,000. So these particular shares will be issued to them free of charge. And these are the shares now which we consider in computing the diluted earnings per share. So therefore, as far as the potential, the partly paid shares are concerned, it is important to know that these are only considered to be potential ordinary shares if by the time the shares will be fully paid for, the market price will have increased. If that is the case, it means that the shareholders, the existing shareholders or the shareholders issued with those shares, they will pay a price which is less than the market price, and therefore you have to determine how many shares will be issued to them free of charge. And basically what you do, that is what you consider the bonus shares. And automatically here, because this we are saying is equivalent to stock option or share option, the increase in earnings for such shares, shares is always equal to zero. So finally, I want us to look on how we treat the other type of potential ordinary share, and that is the contingently issuable shares, which should be number 5. Contingently issuable shares. So this is something we defined in our first class, or in our first lesson of this particular topic, and we said contingently issuable shares. These are those particular ordinary shares to be issued by the company in the future upon fulfillment of certain conditions. For example, in this case, we said the senior managers of the company can be promised to be issued with the shares either free of charge or at a little consideration upon satisfying certain conditions. And therefore, these particular shares will only be considered to be potential ordinary shares, and therefore used in the computation of basic earnings per share if two criteria have been met. Number one is that the condition agreed between the company and the senior managers, that condition has been met. If the condition was that the senior managers will be issued with the shares either free of charge or at nil consideration once the profit of the company exceed a certain amount, for these shares to be considered as potential, that condition must have been met. The profit must have exceeded that particular amount. And number two, or the other criteria, is that the shares have not been issued. Shares have not been issued. And in most of the cases, because now these particular shares will be issued at a price which is below the market price, we treat these particular shares, contingently issuable shares, as an equivalent of share or stock option. So mean that in computing the diluted earnings per share, we assume that these shares were issued during the current financial year to the, for example, senior managers. As a result of that, you compute the two items, the increase in earnings, which will automatically be zero because we are saying this is equivalent to a share or stock option. Here the shares are issued to the senior managers at a price below the market price. So the increase in earnings is equal to zero. What about the increase in number of shares? Increase in number of shares is also equal to the bonus element. Those particular shares which would have been issued to the senior managers free of charge, free of charge. The formula for computing the bonus element remains the same as the ones we have discussed here. So the total shares which would have been issued to the senior managers minus the shares which would have been issued to them at full market price. So basically that's how we treat different types of potential ordinary shares in the computation of diluted earnings per share. And those concepts we have discussed here are very, very important because you need to recall them in tackling any question for DEPS. So I want us to stop at that point. Once we come back in our next session, we are going to look on an illustration question which is based on a past paper question. Hi candidates, welcome to another session of manifested online classes. So we are still soldiering on with the syllabus coverage, and in this particular session I want us to look on a subtopic 3 of topic number 5, which is to do with the determination of impairment loss for what we refer as non-cash generating asset in accordance with the IPSAS 21. Now, this particular standard here, that is the International Public Sector Accounting Standard number 21, basically requires public sector entities to do an impairment review at the end of the year if there is some indication, or basically if there is some evidence showing that the non-cash generating asset owned by such an entity could be impaired. Could be what? Could be impaired. So at a later stage, we are going to look on some of the factors, some of the indicators which shows that an asset could be what? Could be impaired. Now, why is an entity required to do that? Generally, when any entity is preparing the statement of financial position, the assets should be recorded in the statement of financial position at an amount equivalent to their recoverable amount. So mean that that value at which an asset is recorded in the company statement of financial position, and basically we know that assets are recorded in this statement of financial position at a value which is called the carrying amount. This standard requires that this particular carrying amount should always be equal to recoverable amount. So what is the recoverable amount? Recoverable amount essentially is the amount at which now an entity can be able to receive if it sells an asset currently. But in some cases, it may happen that this particular recoverable amount may be less than the carrying amount. If that is the case, then this particular standard comes in and it requires now a public sector entity to reduce the carrying amount to an amount which is equal to recoverable amount, of which now the difference between those two values, carrying amount and recoverable amount, is then known as the impairment loss. But we're going to look on how we determine that. Let's first of all, we do some introduction here, and we say that IPSAS 21, IPSAS 21 requires public sector entities to carry out impairment review if there is evidence showing that assets or its assets could be impaired. And this particular standard here, that is IPSAS 21, it basically relates now to impairment review on what we refer as non-cash generating assets. So what are non-cash generating assets? Non-cash generating assets are basically those particular assets which are owned by the public sector entities and which are not expected to generate any commercial return. So therefore, this standard requires that if there is some indication or basically some evidence showing such asset could be impaired, then this particular entity should go ahead and do what? Carry out an impairment review. So basically this impairment review entails comparing two values. So we can say this entails comparing the carrying amount carrying amount of an asset, and specifically in this case we are referring to non-cash generating assets of a non-cash generating asset and its recoverable service amount, and if the recoverable service amount, maybe we can abbreviate the recoverable service amount using this abbreviation, recoverable service amount. So if the recoverable service amount is less than carrying amount, equally we can abbreviate this carrying amount here using capital CA for carrying amount. And if the recoverable service amount is less than a carrying amount, then the asset is impaired. The asset is what? Is impaired. So, and if the asset is impaired, what a public sector entity should do is basically to proceed and determine what is known as impairment loss. So, how is the impairment loss determined here? So, let's look on the formula for that. So, impairment loss is equal to carrying amount, which is also known as the net book value, abbreviated as NBV, minus the recoverable service amount. We are going to define some of these particular terms here. So therefore, the impairment loss here we are saying is the difference between those two values, the carrying amount, which is also the net book value, and the recoverable service amount. Maybe we can look on before we look on basically how we determine this particular impairment loss using various methods. Maybe first of all we can define some of these particular terms here, and we say carrying amount is the net book value of a non-cash generating asset and cash generating asset, i.e. it is the value an asset is carried in the statement of financial position. So therefore we are saying that the carrying amount, that is CA, is the same with the net book value of an asset, and we are saying that this is basically the value at which an asset is carried in the statement of financial position. So how do we compute this carrying amount, or how do we compute this particular net book value? So let's have the formula for that here. Net book value, or the carrying amount, this one is equal to the cost minus accumulated depreciation. So that is how we determine the carrying amount. Then from there, here we are also talking of another term here, which is the recoverable service amount. We have a recoverable service amount, and actually this is defined under this particular standard here to be the higher of two values. So we say that the recoverable service amount, this is the higher law of non-cash generating assets and cash generating assets. Number one, we have something called the fair value less cost to sell. Fair value less cost to sell, which is also known as NRV, net realizable what? A value, or number 2, something called the value in use. The value in use, of which in this case when we talk about the value in use, this is defined differently from the definition of value in use under IS 36. So value in use under IPSAS 21, this one is defined as what? As the present value. So we can say that this is the present value of remaining service potential, potential of a non-cash generating asset. A non-cash generating what? Asset. So that is the definition of value in use, which is basically different from how we define the same term under IPSAS what? Under IPSAS, not IPSAS rather, but under IS 36. So therefore what we have said here is that this particular standard, IPSAS 21, requires any public sector entity at the end of each year to determine or to carry out impairment review if there is some indication or basically some evidence which shows that such asset could be impaired. So we are saying this particular impairment review entails comparing two values. The first value is the carrying amount and what? The recoverable amount. In this case we have said if the recoverable amount, this one, is found to be less than the carrying amount, it is obvious that that asset is impaired. What an entity should do, what a public sector entity should do, is to determine the amount of impairment loss and also recognize that impairment loss as an expense in what referred as a statement of financial what? Performance, statement of financial performance. So, but equally, it is also important for you to know how do we determine these two values which you are comparing here. The carrying amount, recoverable service amount. Carrying amount, we are saying, is the same with the net book value of an non-cash generating asset, which is equal to the cost minus accumulated depreciation. And then how do you determine the recoverable service amount? We are saying you take the R of two values, the fair value less cost to sell or net realizable value, and then the value in use. Now, value in use, we are saying, is the present value of the remaining service what? Potential of non-cash generating asset. And therefore, this particular standard here, IPSAS 21, basically provide three methods, or in other terms, three approaches, which can be used by a public sector entity in terms of determining what referred as the value in use. But we are going to look on those particular approaches, those particular terms, which may be used in terms of determining the value in use at a later stage. But before we do that, I want us to look on, or we define some additional terms here. We look on definition of additional terms here. Definition of terms. Basically, these are additional terms we need to define, because already we have defined some few terms here, like carrying amount, like the recoverable service amount, and so on. So the other term we need to define here is something called a cash generating asset. Cash generating assets. So when talk about the cash generating asset, as the name suggests, this is basically any asset which is held by a public sector entity and which is expected to generate some commercial returns. Which is expected to generate commercial what? Returns. So therefore you can say that this is an asset held by a public sector entity, and which is expected to generate commercial returns, to generate commercial what? Returns. So in this case, when we talk about an asset generating commercial returns, it means that that particular asset generate now cash flows. Generate what? Cash flows. And generally, these are those particular assets which are owned by some entities which are under the control of the government, which are known as government business enterprises. Government business enterprises are those particular entities which are under the control of the public sector entities and which operate in the same way, just like the profit-oriented entities. Profit-oriented what? Entities. Maybe a good example of this, we can talk of something like Kenya Railways. So Kenya Railways, basically we can say it operates like any other profit-oriented what? Entity, though that particular entity is under the control of the government, is under the control of what? The public sector entity, because we know something like Kenya Railways is not reliant on continued government funding for it to be a going concern. So it is expected that the revenue which is generated by that entity, Kenya Railways, is able to sustain its operation. So therefore, that is a good example of a government business enterprises. And therefore, the asset which it owns, e.g. the trains and so on, those assets are basically regarded as or referred to as the cash generating what? Assets. Simply because you are saying those particular assets are expected to do what? To generate some commercial returns, or in other terms, they're expected to generate some what? Some cash flows. So we know that if, for example, today you want to travel from Nairobi maybe to Mombasa using a train, you have to pay for that. So basically it means that Kenya Railways generates now some revenue from those particular what? From those particular trains and so on. So in this case, we proceed and we say that holding an asset, holding an asset, we have a full stop there, holding an asset to generate commercial returns, means that the asset is deployed in a manner consistent with that of profit-oriented entities. Profit-oriented entities. So holding an asset to generate commercial returns means that that particular asset is deployed, or in other terms, it is used by that public sector entity in a manner which is consistent with that basically deployed by what? Profit-oriented entities. Profit-oriented entities are those particular entities which operate with an objective for making profit, and anytime such an entities own an asset, those particular assets are deployed, are used in a manner, or basically they are used in order to generate what? To generate cash flows. To generate what? Cash flows. So maybe further we can proceed and we say, that holding an asset to equally generate commercial returns, returns indicates that the entity intends, number one, to earn commercial returns from the asset, number one, earn commercial returns from the asset, and number two, that the entity or basically in this case earn commercial returns which is equivalent, or basically which reflect, maybe you can just put it like that, which reflect the risk involved in holding that asset, risk involved in holding the asset. Holding the asset. So mean that holding an asset to generate commercial